Welcome all of you to the session. Guys, excuse me, excuse me, excuse me, can you come? Okay, thank you guys. Welcome to you all for this session. And again, thanks for
Mike.
hello, hello. Am I audible? All right. Okay, welcome you guys. I hope you had a little bit of breakfast, tea, coffee. You're all set. It's a lovely day, and first off, we're starting with the whole angel investing session. The topic that I'm trying to cover, tell me if I'm coming in the way, otherwise we can move it to this side, on this side. So yeah, I mean, first off, we're taking a session on portfolio construction and then valuations, and then I'll spend a little time on investing through ICO. So again, welcome. Let's look at portfolio construction in the first half, and then happy to take questions in between also. Please kindly feel free to stop me for any questions at any point, and I'll try to address it. Otherwise, I'll also keep 5-10 minutes later, close the session for the Q&A, right? So, any question that happens in an investor's mind is, how do I start investing? I know some of you already invest, so you already figured the answer to that question out. But whenever somebody starts angel investing or investing in startups or investing in any asset class for that matter, you obviously ask a question as to how much do we invest, right? Asset allocation questions always come in our minds, and typically multiple asset classes, right? And since we are only talking about startups, I'll restrict my conversation only to startup portfolio construction. Why is it important? Obviously, when you start investing, you start looking at opportunities, whatever comes first, 2, 3, 10, you start taking a call, try to get a thesis around it. A lot of things come to your mind, right? So we'll address all of that. And believe me, I've tried to kind of make an extensive one. So probably I'll address most of your questions, but please feel free. So how much to invest in startups, right? That's the standard question. There's no really right answer to it, but a certain percentage would be better, right? And we'll talk about more on that. So these are certain questions that come in your mind, right? How much do you invest? How do you arrive at a value? You know it's an early stage, guys are yet to build out the product. Probably they built out the product, but not really gone to the market yet. Some people would have launched, some people wouldn't have launched, and some people are grappling through their community. Okay, finding out the co-founders. That's what pretty much stage. This is very early stage we are talking about. Right? However, little bit more reward startups, you would see slightly more maturity. And again, the question is how much to invest. How many years you can stay invested? What's the time period? This is a highly risky asset class, as you would know. The longer you stay, and depending on how the startup performs, you have to take your call to stay in that company to the optimum time. And it's very easy to say this, but very difficult to implement. But when you track the company closely, you will typically figure out when to exit. Sometimes it's a post exit. We'll talk more about that later. Typically, what angel investors face when they invest and then they wait for the exit, all that happens. Right? So those things. When do you need liquidity? Right? Those are the questions. How many companies you should invest? How much equity should you buy for whatever amount that you? What's the IRR? Any investment would obviously expect a return. If you make an investment, what's the return? Right? And then typically when do you exit? What's your exit strategy? Will you be wanting to exit to somebody larger investor? Would you find an investor? Would you want founder to get you an exit? Which is typically happens in the early stage startups. So yeah, coming to the answers one by one, our experience is, for the whole team, is pretty much experience on the angel investing. We'll share a few things that we've come across. Our experience is, it generally takes between 3 to 10 years. When you invest early stage, you typically end up with a horizon of at least 2 to 3 years to begin with. Then depending on how the startup is tracking, you take your call. You decide whether to stay, not to stay. Sometimes exits are not easy. This is an illiquid asset class, right? Let's understand that. So it takes a while. Generally, depending on what opportunity window you get to exit, a lot of things depend sometimes externally. Not everything is in your control. So, but still, this is a broad horizon. How much money can you afford to lose? Now, this is an asset class which typically, being very risky, you need to allocate some capital which you can definitely lose and not lose your sleep, right? So don't invest, don't over-invest, because the returns can be hard to get. The returns can take longer. So you may have thought, "Hey, yaar, मैं डालूंगा पैसा, 3 years I'll exit. This is, I have to get my son married. So maybe 3 years I'll get a good exit." Won't happen. Uh, your child comes into college, won't happen. So put that capital that you can afford to lose and not really want it badly after 3 5 years. So typically 5 to 10% of net worth is what we recommend. So that, and then slowly, depending on once you know it, once you know the game, once you've got a few exits, then yes, start allocating more capital. Once you've learned the game, right? Once you've understood how it works. And again, how much time will you have to spend? That's a big one. We'll talk more about it. Since once you invest, there are no other cash flows that go out. You got to track the company, you got to spend some time. So efforts go in, and we'll see how. Again, this is standard. Okay, now what you see on the slide is a very generic expectation of a return on a portfolio of stocks. Uh, and don't be disheartened by some numbers here, because when you start investing in 10, 20 startups, this is how your exit scenario will start looking like. Okay? So 50-60% में पैसा जाएगा. Okay, so be very clear. Don't get disappointed. Don't get disheartened. 50 to 60% of the portfolio will probably at some point go downhill. Some will go early because maybe they have pivoted, they have run out of cash. Various reasons will come to that as well. I'll try to cover that in my slides. But yes, some of them will give you average returns forced exit होएगा, maybe you get your capital back, not a very good outcome. But those 5-10% of the portfolio, those are your outliers. Those have to be the outliers. And maybe you won't know it now, but you will get a feel of it, as you get the updates, as you find out about the company's future fundraisers. Founders are hustlers, they will get to it, they will get more rounds done, valuations will go up, and hence those multiplier exits, which you normally read about in media now, are all happening within that 5-10% band. People don't talk about the 95%. People only talk about the winners. That's what happens. But then expect a gross IRR of 30 to 60%. Why? Because this is a risky asset class. Right? अगर मैं FD में डालूंगा तो मुझे मालूम है 6-7%. लिस्टेड कंपनी में शायद 10%, आजकल नहीं, पर पहले ही है. बट थोड़ा ज़्यादा चाहिए, right? As the risk goes up, you're obviously the weighted average cost of capital is higher. The risk premium is higher for those finance bucks here, but that's exactly what happens. So expect a gross IRR return of 30%. Otherwise, it doesn't make sense to invest in startups. Right? Then you might as well invest in conventional asset classes. Right? So that's the expectation because a lot of risk is being taken away. So as we all know, right, I'm just reinforcing the message. This is of business of seeing into the future. There'll be something available to you to see, but not too much. So a lot of it is unseen. A lot of it is not really known to you. You'll get a hunch. It's about as much you can predict about the future. Right? So it's all about seeing in the future. Every investment you need to make, diligence it properly and believe that it's going to be a home run. Right? It's going to be an outlier. While at least making the investment, you have to believe. If you have 5% doubt, do not invest. Nobody is forcing you to take a call. Right? Unless you really believe it's a home run, there's no point. This is something that some people get confused about, right? Why should I feed the winners? Why should I spend more time on the winners? Dada hai investment to yaar chalna hi chahiye. Let's work hard. Beyond the point, you will know in your portfolio who are the winners, who are the losers, right? Try to get out of the losers as fast as possible because the window of opportunity will be very limited in case of losers. And something is losing, something is going downhill. It's better to get out early than later. And you might be wrong. You might see a U turn around in the story. Just as bad, right? Forget about it. It's okay. It happens even in listed companies. Right? You enter it to the bottom and suddenly you exit. The stock goes up. Same thing with startups. But try to work on the winners, try to find out ways to extend the run so that's called feeding the winners. So we, in our own venture capital investing, this is what we learn. You have limited amount of energy. You must be doing 10 things on the side. You have very limited bandwidth for the startups. Because eventually it's 5-10% of your portfolio, right? So 90% पे तो ध्यान देना ही है. 5-10% का effort is available. So there, what happens is put that energy into whichever are the winners. That will give you more optimum outcomes. Just an example, I don't know, most of you know this, right? The whole Facebook investor story. Peter Thiel was the guy who invested in Facebook very early on. उसने पैसा डाला, like first raise, $5 million का raise, valuation. This guy put in like $500,000. And this is something that will tell you about the exit strategy of angel investing. How the exit strategy happens, right? So after the investment, you know what Facebook became, but very few people know how it actually happens. So this is the slide that tells you what actually happened with TL. As Facebook grew, there were multiple exit opportunities for investors. And TL was smart, and I like this strategy immensely. You start exiting part, right? You start exiting as the company grows, you get some opportunity, right? Start exiting a little bit. Maybe sometimes you're forced to exit full, but that's something that's not in your control. If it's in your control, put slow exits with some parts. So Peter Thiel kind of exited twice, as you can see, right? One at a fancy valuation of $1 billion, then kept on adding. He actually made $1 billion from that 500. Okay. 2000x. 2000x in startup investing, we don't talk percentage returns, we talk X returns. So kitna multiple हुआ capital का, right? That's the discussion that we hold. So phased exit, right? This is a proven phased exit strategy. Brilliant. I mean, you keep on exiting, take your money off the table. So Rajpur India आएगा, you made like 20x from your 30%. कुछ भी होएगा चलेगा ना, let it go down. Who cares? But of course, it was Facebook, so he cared. And he eventually, I don't know if he still holds some shares, but last we know he did have some shares. So the share price of Facebook today is about 200 bucks. I don't know whether he holds it, but he's already made his bill. From a fan. This is typically, again, a winner story, but in case of a winner, how to exit. This thing just tells you that. Any questions at this point? Like, we're just stopping here because slide 9 or 10. Just taking a pause. Any questions so far? All right, let's go ahead. So, how do you really make it happen, right? Most of you are actually thinking right now, even I'm thinking that as we do. But this is how typically it might work out. It's the power of aggregation, right? You aggregate a lot of stuff. The more you aggregate, the more powerful it becomes. So, aggregating your investment dollars, right? Keep your dollars, slowly keep entering into companies. Don't put all your capital in one company and then another good opportunity walks in. You're actually out of money. You wanted to invest, but that's not. So, again, aggregate knowledge, experience, whatever you've learned in your life, unless you deploy, unless you aggregate as a group, make it happen for the startup, it's going to only affect your outcome. So sometimes people think, yeah, I've given one advice, this guy is not following up, let's just dump him. Right? The founder, the tsunami, a lot of things happens. We have faced that too. We've had 70 investments in 100x. Happens to us all the time. But that doesn't mean you stop advising, you stop working. It's your hard-earned money that has gone into this startup. You have to start aggregating your network, bring around your connections, make it happen for the founder. And if it's a good founder, he will make it happen for you. That's what typically happens. Right? Aggregating network, business connects, offer business connects as much as you can to the founder. You've got nothing to lose. You just have to give him connections. He'll do the rest. He'll figure out, right? But give him an opportunity to do so.
Sorry, just quickly, two cars are parked outside the Dargah, MH01DK 9185 and MH01BY 0554. If the owners are here, please move them, have them parked somewhere else. Again, DK 9185 and BY 0554. Thank you. Sorry.
Thank you, sir. So let's continue. Again, aggregating high quality deal flow, all of that is important. These are the risks, right? Some of them I already spoke about, but highly risky asset class, filled with uncertainty, right? Highly illiquid market. Multiple variables lead to failure. Lot can go wrong. Lot can go wrong and does go wrong and will go. So embrace it, be it as a part of your journey. That's what you have to do. Again, these are underdeveloped markets. We are just growing. India is actually evolving. We are not the US where people breathe and live and walk and talk startups. We've just learned. This is probably our wave 2.0. Right? The first wave went 10 years. A lot of stuff happened. We are looking at a different 10 years now. So think about that. Again, but the beauty is after all these risks, your risk is 1x. The 1x is your capital investment. All you can go wrong is your capital. That's all right. Or to put a little bit of sleep if it doesn't perform well, but that's all. But the potential is immense. The upside is unlimited. If a Zomato happens to someone or if a Nike happens to someone, imagine it's the whole PTCL Facebook story back again. Right? That's what a lot of people do. I see some friends who are already smiling, so they're all sitting on some portfolio. याद आ रहा है यहाँ ये वाला है मेरा unlimited. All you do that all the time, right? It's very natural. Obviously, everybody when you put your hard-earned money, you obviously try to help out. And I know a lot of you, we all know a lot of people put in their energy, people put in their hard work, guide the founders as much as they can absorb. Right? You can only give them so much, but it's upon them to absorb as much as you can and they can. That's Again, outcome based, if your portfolio is doing well, you are a successful investor. Right? You all know Sanjay, who's been investing for the last decade, has brilliant outcome of portfolio. His IRR is off the charts. I don't even want to talk about it. It's not in that 30-60%, it's above it. So a VC is always known and investor is always known by the portfolio. It's not known by the number of investments you do. It's by the outcome you've got, it's by the portfolio performance that a VC is known. That's what happens. Again, word of caution, Indian investors have to enjoy both the journey, the process of investing. It's so much learning experience. You get across to founders, they talk something that probably you don't know. Half the time you don't, believe me, we don't. We don't know anything when the founder comes to us. We pretend we know, but we don't. Okay, but we're learning from them. They are the ones who have put their heart, sweat, 2 years, 1 year, got the product out. We are learning from them. So learn that journey process of investing. Have the whole journey with the founder pleasant. Okay, so make it as much as possible. There's no instant gratification. We all know it. We already discussed it. Long time, 3 saal, 5 saal, 10 saal. Enjoy the journey. And exit will happen. Sometimes, mostly it's not in your control, but very few times in your control. So yeah, these are the kind of characteristics. Again, just kind of rounded off, visible, right? So yeah, you need people skills. You just don't need capital. You need that temperament to deal with that entrepreneur. Every entrepreneur is different. You've got to adjust your level to discuss with their founder. Founders are very, very close to, they carry their plans, they carry their product close to their heart. So listen them out, see there will be always some brilliant thing that they are doing. So you've got to be open to ideas, very high tolerance to risk, we've already spoken about that, high tolerance for failure, self-discipline, you yourself have to be also disciplined, right? If a founder is sending you updates, it will lie in your inbox, right? But you might not have time, and you'll say, "हाँ मैं बाद में देखता हूँ." If you see some time, take some time out, read that, invest time, be disciplined into responding. At least you can do. I have to just quote you one thing here. If a founder has done a good job sending you some good updates, just send him a one line saying "great job." You don't know how much that means to the founder. Okay, it just increases your relationship with the investor, right? Just like 2 lines, "great job," great presentation, all the best, ready your slides, keep going. All you can do is that, and then that's all the dose they need. Right? So that's also when you have to really do that. It takes some time, some effort, but keep doing that. And that's calling about having respect for the founders. So how many types of investors are there? Okay, so now I'm already seeing faces, they're trying to put themselves into the one of the 4 categories. But typically it could be either or it could be all. Opportunistic guys invest in whatever comes, makes sense to you. Right? अच्छा लगा, समझ में आ रहा है, डालो. लिस्टेड कंपनी में तो पता है, ट्रैक रिकॉर्ड है, ब्रोकरेज रिपोर्ट्स है, रिसर्च रिपोर्ट्स है, यहाँ पे नहीं. If you like something, you invest, you probably find co-investors at your stage, talk to multiple people who have invested, are investing. So you'll probably deliberate on all of that. Again, some are thesis-driven. I know media very well, right? I know entertainment, I know edutech. So let me just keep myself restricted to edutech. I know that, so I can add value to the founder. Right? Otherwise, there's no point. Everything is good in this world. India has anyway, it's a sea of opportunities. It's just emerging. Every sector will look sexy, right? But eventually, how much can you add value? Ask yourself that question. So that is going to become relevant after you invest. And that is why thesis. Sector expertise, technology, media, telecom, people have within the TMT expertise of tech. If you understand tech, then A, you will learn from the founder who is a tech guy, and second, you will contribute to the guy in dumping in his journey. Right? Maybe you will find him a CTO. It will add value to your investment. People don't realize. Sometimes people end up hiring the wrong people. You refer to somebody who you already know, right? We have a large network. We all of us have large networks. But we don't put to use to our founders whom we invest in. We end up not doing that, and that could be your Facebook, right? That could be your Zomato, and you don't realize. You realize it only after you've gotten out of it and somebody else has a higher exit than you. Again, trend focus. Very trend focus. आज अभी क्या चल रहा है? Crypto, Not so much now, but yeah, last year crypto. Now it's Web3. Half of it people don't understand, but it's Web3, right? But so try to learn things, try to do research, and then invest in that trend, right? Try to spend some time, okay? Then invest. Trend based is good, but trends don't remain permanent, right? And edtech, maybe in edtech right now for 4 or 5 years, but may not be later. So realize that every tech sector will have a cycle as well. I mean, this is very interesting, guys. I mean, these are the stages. So depending on which stage you are investing, very early stage, literally pre-seed, it's a clear product risk. बनेगा कि नहीं प्रोडक्ट कोई मालूम नहीं है. आई एम पुटिंग इन मनी बट माय फेथ इज कि बना लेगा यार ये कुछ कर लेगा. He'll get the product out. He'll launch soon. If you want slightly lesser risk, product आने दो, let him get the product out. I can see the product. Now I'm okay to invest. दिख रहा है product सामने है. Live है, app live है, I can engage with the product. I get more confidence. But remember, seed round पे थोड़ा सा valuation ज़्यादा हो जाएगा. Along with the risk comes valuation. Easily, the valuation will not be the one that will be on pre-seed. So the stage and risk go hand in hand. As you go along, you get into team risk. बना लिया founder ने, but now he has to create a second layer. The second layer is the most difficult. Your own vision, your own alignment, to pass on to your team. You all have made successful businesses. You all have run. You know how important team building is. It's not easy to create a team and more importantly pass on that passion. You cannot pass on your passion unless you have guys who are made of that same fire that you guys are made of. So again, team building, and then again growth stage, PE stage is just a function of capital, guys. I mean, I believe that. I may be wrong, but typically after you've gone a good journey, you know where the GTM is, where your market is. It's just about pumping in more capital and give you results. That's why higher PE companies, growth companies expect 3-4x what हो गया at that stage because they are entering at a different stage. Yeah, this is just I'll kind of we'll anyway send this presentation out to you. There's a lot of stuff here that I thought I'll put in. Two types of mindsets, right? Again, as I said, one mindset is पैसा डाल दिया, the founder is supposed to perform. Right? I will sit and watch. I'm closed. You do all the shit. I mean, I need the returns. Stay out, don't be as committed. This is exactly opposite. Collaborative investor will always help the founder work together. Think future, keep on adding more ideas to the founder. Two types of investors again. Again, when founders talk, what do we analyze? Like, what do we think? Founder अपना story बोल रहा है, मैं सोच रहा हूँ कि बस पैसा बनेगा. Right? When he's telling me the idea, the whole market size, I'm saying, is there a money to be made in this particular opportunity? Now, when it comes to the team slide, tells you this we are the best team. You are thinking, is he the right guy for me? Is this market opportunity अच्छा है? But will this guy crack it? Right? Both the magic formula has to work. The opportunity has to be right. The founders have to be right. And why should the founder do it? I mean, has he done something? Has he really spent time? Has he done research? Guys do research for 3 months and say, sir, we've been working on the product for 3 months. Here it is. It may be brilliant, but not too much can happen in 3 months. If he has really worked on it, pivoted a couple of times, then you know the guy has done mistakes, right? And then he's come up with this product. Chances of error come away. So this is what you do, yeah? And then obviously when you talk about terms, investment, valuation, kitna paisa, kitne pe, then you know what kind of exit returns you can expect. Again, primary round, secondary round, I'm sure most of you know, but I'm just touching this upon like 2 minutes. Primary round is investor puts money in the company. पैसा अंदर जा रहा है company में. So founder dilute हो रहा है, investor is getting a stake. It's called a primary round. A secondary round is typically when, let's say we all invested in startups, the bigger guys come in, the VCs come in, they start investing. They have multiple strategies. They have clear known in their mind कि इतना stake चाहिए. They will put some money inside, but then they also want to buy out secondary. And I'm sure some of you would have faced the situation already. Those are the kind of post exits I'm talking about. Founder को बोला लगा, boss, I want this much stake, I'm putting in this much money, but it's not enough. Get me something from the existing capital, from the existing shareholder. That's when a secondary round happens. Typically, we've seen secondary rounds happen at a slight discount because it's a secondary round. The money is not pumping growth and expansion. And hence, there is a tendency of offering a discount by the new investor. Need not be the case, need not be the situation. If you are given an offer, at that point, don't sit and think, no, मेरे को तो उतना ही valuation चाहिए जिसपे नया पैसा आ रहा है. Sometimes it may be offered to you at a discount. If you take it and it still gives you a good multiple X, why not? You're getting an exit. It's a limited window. So think about that and decide. Those are secondary rounds that keep happening. Same thing like private investing and public market investing. I know most of you might be investing in public. Udhar T+1 hai, aaj becha, tomorrow money is in the bank. Not so easy in this space, right? Takes time. Yeah, I mean, types of exits typically for us, for early stage investors, is three things. Most ideal, VC आया, उठा लिया आपका stake. VC का valuation is like fancy. You get fantastic returns, you are happy. Go home, thank your stars, focus on the next opportunity, right? The second one is not so optimal. The founder is hustling, reaching somewhere, but वो VC नहीं आ रहा है. ठीक है? So now what do? You basically start thinking, चलो ठीक है यार इसको help करते हैं. I mean, you really need to work on this second thing. The third thing you can't do too much because it's gone. Money is down the drain and probably you may not even get your principal back. But the second one is where sometimes the effort is made. You might know a corporate who can actually hire these guys or take the entire company with the investor. At that point, it is still some upside. You might get 3x, 4x, 5x, 10x, right? But then that lot of effort is to be needed. If somebody else is doing the effort, fine. But if not, then it's your investment. Even if you own 2% of the company, your effort will be 100%. Because you need to get exit for your 2%, right? I don't care about those 98% there. I want my 2% out. वो 2% होएगा नहीं जब तक 50% का deal नहीं होएगा. So now start working with the founders, making sure that boss, there's no way out. Let's talk about an M&A. Let's talk about corporate association and nothing wrong. When founders have prospered with M&A, tons of examples, right? Good outcomes. Everybody doesn't become a Zomato, Nykaa, right? In between, there are a lot of stopovers. You could want to start working with a large corporate, which is tons of capital, tons of resources. That's the kind of the second one, always important to keep in mind. Again, probably a little bit of repetition, but yeah, small investments, try to put 5, 10 lakhs, 2 lakhs sometimes, works okay if the founder is taking it. Start dabbling if you are a new investor. Start dabbling into investments. Understand how it works. You won't know unless you are in it. कितना भी पढ़ो social media, कितना भी exit पढ़ो नहीं समझना. You have to invest to know the journey. Unless you invest, you will not know the journey. So start investing early. Get 1 or 2 deals every quarter. Don't be heavily investing. Don't do 50,000 and 10 deals. Won't work. 50,000 that founder won't even pick up your call. Okay, so don't do it. Do 2.5, 3 lakhs, 5 lakhs. Begin with. People will look at you, talk to you regularly. Keep that engagement is everything. If he sees value in you, he will engage. And he will, by the way, and please remember, at the time of exit, the founder will remember. That is something that you have to keep in mind. Reserve funds for follow-on, very important. I don't know how many guys do this, but if you invest one, keep some money out for your next round. You never know, like more capital at work is lovely. I mean, winning guys, just try to put more capital. Right? That's what you want to do. So keep some money. ऐसा नहीं डाल दिया अभी पैसे नहीं बचा वो other founders you put in. Now you have no money left for the ride. The main ride which happens, right? Stupendous valuations happening every 6 months, and you don't have money to it. It's unfortunate. That's typically how a strategy should be made. Try to stay longer. I've already said winners you will easily know. After you invest, after a point of time, you will know who's a winner. Try to extend your runway. Try to extend your holding. Don't sell out cheap. Don't sell out early unless you are made to. Sometimes you are made to, which is fine. Then it's not in your control. Yeah, this is the standard typical graph. Like everybody loves this. The flat, the elbow, and the wall. When you invest in the flat, it's risky, uncertain. A lot of things are not known, which is why the valuations are less. So typically, entry valuations are low. Once you reach the elbow, this is the interesting one, right? This is where the hockey stick happens. So that's the best time. That's the time you want to double down. You already put some small capital. You know this guy is going to fly now tomorrow. At that point, bridge round, whatever round is happening, participate. That's doubling down and that's the elbow stage. And then the wall. Wall is for bigger guys. Unless you have tons of capital, appetite to lose, don't enter into the wall. Wall is the time when you actually exit. Right? That's typical. You want to make money and then move on, start investing in other stuff. So a little bit too much on investing, a little bit on founder experience, which kind of founders you really want to back. This is very standard laundry list, but it's a checklist. It is a checklist. You should look at it. You should know all these qualities. There have to be complementary skill sets. There have to be market validation. ये नहीं कि सुना अच्छा crypto web3 I need some shit NFT because I can talk more about it. It's a good startup to invest. No, unless you know the outcome, where is the vision going? What is the benefit to the consumer? Sometimes investors don't even ask that. Put yourself in the consumer's position. See whether he is able to explain you as a consumer. If the founder is able to explain you as a consumer, as a customer, it's a deal you want to be in. Right? Because he knows his customer. You are only facilitating with capital. But if he knows his customer well, that's where you want to use. Of course, all these are, you need communication skills, you need articulation, everything revolves around that. Right? You know how to present, you know how to talk, you know how to articulate your idea. Unless you articulate your idea, nobody's going to invest in it. Oh, by the way, just one thing here. Sorry, I missed. Yeah, nothing is coming up in the next one. Yeah, certain weightages, like in your mind, these are very early stage kind of weightages. Right? Founders typically have the highest. Everything usko hi karna hai. So 60% typically lies on founders in early stage. This is true for early stage investing. Others are typically 10, market opportunity, sales, focus, business model, all of that. Other factors are all 10%, so nothing much, but yeah, founders. Also, we've seen a lot of women founders adding to our portfolio now. We've seen, women have, not women here, not women, but big drive on women. I have seen, we work with women founders, 20% of our portfolio is women. Fantastic. They are so dedicated. Sorry guys, but more dedication than men sometimes. But a lot of passion there. Sincere, honest. You should back as many women founders as you can. Yeah, so at 100X we see these things, right? Pretty much. Founding team, most important factor. We spend a whole lot of time on founders before even we get to the. In fact, some of our pitches. If you talk to our team outside here, we tell them to present themselves first. No pitch, first 2 minutes, talk about yourself, talk about your journey, talk about what you did, how you met, what all you thought about, and eventually the idea. The idea comes next. Only then the pitch deck starts. You want to know the guy, you want to know the people who are running it. That's your 55%, remember? So that's it. Opportunity, yes. In India, probably everything seems like a big opportunity. But narrow down your focus. Please ask what is the target segment. The TAM, SAM, SOM, everything makes a lot of sense. Spend time. It's very easy to make a slide as a founder. I can make a brilliant slide, all of that. But very few people diligence it. What is your target audience? Which is the addressable, obtainable market? That is important. If that is not there, then everything looks sexy. Business mode, you need to know eventually how to make money, how to make the customers pay. Users after a while are okay, 100,000 users is fine. But where are you going to start making money? Business model is very important. And of course, as early we go, conviction of 20x returns. I'll kind of start moving a little bit on and then we'll catch up with some of valuation stuff because I know a lot of people are waiting for that. Some of the broad reasons on why startups fail. We've seen most of them don't plan cash very well. They're not able to understand numbers. They don't understand their runway. Cash is out. Suddenly, in between, and then they hustle, and then suboptimal investment comes from the investors. Heavy initial dilution. Again, very, very heavy dilution in favor of certain mentors, advisors. Good to have mentor advisors, but leave out small equity for them because they are going to be riding the wave all along. You don't need to give, like as founders, don't need to give a whole lot of percentage to their advisors because then the future rounds won't happen. The future investor के लिए तो बचा ही नहीं ना कुछ. So I mean, heavy dilution initial, bad thing to happen. To founders, you should not invest in company which is initially very heavy dilution. Because then you won't get the PE guy or the big guys to come in. Some of the things. And yeah, of course, this is ideally the stage that we know prototype is customer discovery, MVP is customer validation. You don't have customers, you start validating them. This is exactly where seed stage investing should happen. And then, of course, it's a function of product market fit, very commonly used term but not well understood. Product market fit, what it is, this could be a separate presentation on that. But guys get infatuated by saying, 4 customer mila, I have got product market fit. Doesn't happen. So product market fit is very difficult to achieve. Very again commonly abused word, used term by founders. Don't get into the trap. Understand what they are into and then decide. Growth scaling, very easy guys. You are just building dollars on top of your success story. So nothing big there. Okay, valuation, the second part of our presentation. How to value startups? No formula, no magic pill. You will just know, right? There is no rule. It's more an art than chemistry or than math because ultimately a lot of things are unknown. You start working on Excel sheets when there are known, right? Unknown variables, everything is an assumption. Then it's more art than science. Price is not always the value. Very important thing. The value that you are getting sometimes and most of the times is intangible. The price that you are paying is tangible. So there's a little bit of an issue of matching a tangible with an intangible. Rights are hardly of any consequence, guys. Let me tell you, those of you who believe that I should have all the rights in a startup, वो चलेगा ही नहीं तो rights को लेके हम लोग कुछ नहीं कर सकते. You can make the life of the founder hell, but you won't get anything. So don't focus on the rights. Focus on the opportunity, working closely. Initial stages, there's nothing that the rights can do. Yeah, later stages, good valuations, yes, you want to protect rights, all of that comes in. Not the initial stage, which is why we invest in ICF, which is, we'll come to that. And more importantly, founders are actually seeking more capital. Apart from that, mentoring and education. So remember that. And again, every transaction is arbitrary. No rules. Every transaction will give you a new learning. Will happen at a different set of rules. So yeah, but I mean, just some numbers here. Pre-money, post-money, I'm sure most of you know, but just running this. Whatever money that you are putting in on the round is, will obviously increase the post-money valuation. The stake is always calculated on post-money. So let's say I'm putting 2.5 crores. In a 10 crore valuation, it gives me 12.5 post-money. I own, if you're putting the entire money, then 2.5 divided by 12. So 20%. That's typically how a pre-money, post-money working happens. Sorry, any questions? I'm just stopping here in case it's not clear. As you go along, obviously, yeah.
Decide your final exit window, meaning that there is no forceful exit given. How do you decide your exit window?
Yeah, no, good question. I try to address it, but I'll kind of elaborate more. As you go, when you put in an investment, let's say you put in 5 lakhs in a company, you have some idea of your return. That if they get 10x, happy. You already met your benchmark, right? 2 years later, you revalue, you look at the last round happened. Your stake valuation quantification is, let's say, 50 lakhs. Your expectation was 30 from that investment. That will tell you at any point of time there's a window, you should exit. Okay? At that point. If the conviction is not as high, if there's very high conviction, I'll give you some examples. Sanjay is here. Some of his investments, like a coin DCX, right, just became a unicorn. There were multiple opportunities of exit in coin DCX before it became a unicorn. Now, he resisted the temptation to sell. That's it. I don't know if that answers your question. Coin D6, he's still an investor, not exited yet. Grown multiple, it's already at a 2 billion valuation. Can go up to 10. But now it's a debate. Now, whenever a round happens, it's again every exit point and every round will give you a dilemma. The baseline. Sometimes the opportunity is there, sometimes it's not there. But whenever it's there, it's a decision point. Not everything will definitely list or not everything will get taken over. And then it could be downhill for the founder sometimes. So then you don't want to curse yourself, pair, Milaka, Moka, and administer. Does that answer your question?
Thank you so much.
Any other questions, guys? At this point?
Regarding the valuation that you talked about, should not be diluted so early. Are there any typical benchmarks?
Yeah.
What stage, what is the typical time?
Yeah, good question. So typically when we evaluate startups, we are at VC. We typically don't want founders to dilute more than 3-4%, max 5%. Well, a couple of mentors, advisors on board, tremendously helping the founders, fine. Go up to 4-5%. At that seed level. Like if the round is of 2-3 crores, 4 crores, valuation would be somewhere 15, 20, 25 crores. At that point, the founder shouldn't have diluted apart from the ESOP. ESOP are always counted as founder's stake. Investor's stake cannot be more than 4-5%. When you are doing that. Post the round, yes, the seed round typically ends up at 20-25%. Post the seed, which is fine. Which is not a problem.
Does it happen that founders come to you? There is no instance where you find something consistent approach to the founder?
Well, good question. We normally, first when we launched the fund in 2019, we went after the founder, right? We started speaking to incubators, we started speaking to accelerators, everywhere we could find founders, right? Yeah, e-cells, IITs, everywhere. And then that's where you went. Now with, let's say, a lot of incoming pitches come. So our inbox, which is pitch at 100X, is the incoming, inbound pitches. That's where we receive all the mails with the decks. And there's an evaluation team which kind of do that. So it's an inbound team. But when you want to find deals, you typically would, let's say as angel investors, would obviously go to a 100X website, get yourself registered like most of you have. You will get invited to our pitch day. You will see those deals which we have worked on already and invested. They are curated deals, so that they are not as risky as it may sound earlier. So then you have a curated list to select upon and you invest. Other than that, you have obviously angel networks which you can get a member on and then start.
Not so absolute, but if you find some business doing well, can you just approach that business and say, I
Why not?
would like to be a part of it?
Of course, at every point,
Not the early
yeah.
stage.
Yeah, no, even if it's an evolved
Already
business,
are doing well.
even if it's an evolved business, let's say 5-year running, the only problem, man, there is you got to find out if it's a lifestyle business or a venture fund. Now I'll tell you the difference, right? Venture fundable business is something which constantly needs capital to grow, and then that's why your exit will happen at some point. If it's a lifestyle business, you got in, right, because you like the guys, you like everything, but these guys are not raising money. They are not raising money. They are not growing. They are okay. They are doing okay. They are doing fantastic. They are leaders in their space. Even then, there's no benefit. Where is your exit? When you are investing, sorry,
Go IPO.
might not go IPO. IPO is not easy. How many companies do IPO out of the companies that start? So you are betting against a very heavy odds. If you feel they are IPOable, then yes. But then lot of hoops to cross before the IPO. If they are IPO journey, fine. You should invest because your exit is at the IPO, straight at the IPO. Whatever level they are at. They are in the series A, D, B, whatever, then listing yes. At that stage, whether you get the opportunity to get in, yes. Then an IPO is there. But not easy to do and very too many variables out.
But on that body only you invest. You go IPO.
Of course. You would. Founders in IPO, believe me, I have run companies, I have taken companies IPO. I have been in listed companies as CFO. It's not easy to list. Nowadays, yes, with Zomato, Laika, and all these, SEBI has now relaxed the norms, but that's just norms. It doesn't guarantee you investors interest. So unless you are growing at a phenomenal pace, right? Your users are like growing multiple X and your product is like all across. It's perfect market fit and everybody is dying for your company's product, then you have some signals that you require.
For example, my friend was an early stage investor in my account. She was a friend, so she invested early stage. She couldn't find an exit, and now she exited a huge amount.
Lucky to you. This doesn't happen very often, but yes, Nika did it, right? There is only one Nika out of 1,000 companies. So even great order. Hey,
Hey, how are you? Good question. Can you give us some tips on how we can get into deals? Money's great, but what if the founder is, if the round's really hot? Can you give us tips on how we can get into the round?
so sorry if I got the question right. You're saying that how do you enter a round? Doing much
Exactly. So in some deals, the founders are maybe so hot where they only want to take money from specific people. And as investors, we really want to get in really, really bad. Is there any tips that we can do to persuade the founder or any value that we can give? Just some tips from that perspective would be great.
No, great question, Brendan. And we face this a lot of times when people pitch to us. Everybody is not saying that 100x. I definitely want 100x to be my investor. There are founders who come and ask us. Some of us, I can see some founders here too. They've asked us this question: why should I take money from 100x? Right? This is true for any investor. Now we have to sit and actually sell ourselves, saying that look, guys, you come with us, we'll do X, Y, Z things. Meaning, I'm going to help you with business. I'm going to sit with you, fix your financials, fix your model, fix your pricing, tell you how you go to market, and then also, by the way, give you instructions to investors. I have a large network. You can raise further rounds. You will not close down. That is what I assure you. I'll work closely with you. Right? You start talking to them. Founders listen. They want. That's why I said mentoring, education, all part of it. Right? Unless you show that value add. See, in today's time, slightly different. 2 years back, capital was difficult to get. Right now, there's a lot of capital available. So capital is not the differentiator. Your check is probably one part of it, but the founder is more excited if you give them something else apart from the capital. So how do you do that? Do you have a network? Do you have ideas? Do you have a business that is same as the founder? I mean, something similar where you've gone through the same journey. You can add value to them. That's what typically will tilt the scales in your favor. Yours might be a small check, but if you convince him that by giving me your shares or letting me come in your cap table, you're going to benefit not as much in terms of capital, but tremendously in terms of network, business, and that's exactly what I've been speaking about, right? You've got to prove your value as an investor. Yes,
You talk a lot about value and mentorship. Can you give some tangible ideas on what that looks like? What kind of value? What kind of mentorship? What exactly is it?
Yeah. So let me say this, right? Mentorship comes in different ways, and believe me, startup founders get stuck at every stage. And they might not be vocal. If you have a line of communication with them, you have good relationship, they'll call you. Like, for example, we get calls, right? Vatsal, our CTO, gets calls. Yeah, I want a techie. I'm stuck with my product. I'm not able to go through. I have my launch date. What can I do? Vatsal immediately gets on calls. If he can't help, he can get people to help. Get to your people. Some techie will come in, get your product live. Then eventually you got to hire people. Now we also have something like a job board where our founders go and post jobs, and because we are putting it out there, a lot of these techies who are looking to be either co-founders or team members come in and apply, and they get selected by these founders. So now you've got a hiring board, and you help them hire. Right now, tech talent is in shortage, right? I mean, we'll talk about it later. But tech talent is in shortfall. Marketing, sales, not as easy. So if you can introduce like channel partners in a B2B business, you got to introduce some channel partners to the founder. Right? Founder may not know. He wants to go through that route, but he doesn't know. So those kind of things. I hope that answers the question. Yeah.
So there are various instruments of investing in a company. So be it CCPS or convertible round, or so are there any particular instruments which are more favorable to investors, or some instruments which we should avoid as investors?
Yeah, so good question. I'll tell you, I mean, the modes of investment should be a preferred share. Typically, founders would definitely issue preference shares to all investors, and you should, as an investor, focus on getting preferred shares because preferred shares come with liquidity preference over founder. So tomorrow, in an exit scenario, company gets taken over, you get your money first before the founder. So CCPS is an ideal instrument. ISAFE is also in a way CCPS. So
What about there's something called participating and non-participating?
yeah, so that's a little bit more complex structured product, but basically CCP. Participating is just for exit, where you get your principal and then your stake value comes in. That's participating. Non-participating is simple division of proceeds by percentage. I'll kind of, in the interest of time, kind of move a little faster. I just thought I'll probably touch upon a couple of things. Valuation methods, depending on the stage of the company, like no revenues, you could only count users, assign a value, come to that, invest. More predictable cash flows, you're able to do a DCF, and that's how the valuation happens. But yeah, when you don't have sales, there's no IRR, there's no ARR, sorry, to kind of give you a multiple, and a sustainable ARR. Sometimes, I've seen founders have revenues, people start doing multiplication of that revenue. The guys just started selling. Can't ascribe value on ARR of a just recently revenue generating company. There has to be a mode, there has to be an IP. So value that, and that's how typically you will end up. Again, investor, should need to watch out different aspects. Deal economics, management control. At later stages, these things, right? Like you just asked, investor protection, participating, non-participating, exit, liquidity. You've got to negotiate terms. The larger the check size, typically the larger the control and the more rights. Right? And yeah, coming to ISAFE investing, I'll just kind of spend 5 minutes and why is it the best mode. We've already spoken about speed. Founders have enough capital. So how do you ensure you get into founders earlier than somebody else or a larger investor? ISAFE investing will help you that, and why? It's a simple agreement for future equity. This is what Y Combinator launched a few years back. They invest through safe notes. These are quick one-page documents which kind of helps founders close the deal with investors. Right? And very relevant for early stage, not suitable for larger rounds for later stage because then the rights matter. Then you have an SHA and everything. You can't avoid that. But initially, yes, we've seen all our, we used this for the first time. Why is it ideal? Is because there's not too much on valuation around, right? You got to figure out it's a convertible. It helps you invest without a valuation. There's a cap on which you can invest. So various modes. There is a discount. I say you could use that. Because all these valuations will become contentious with founders at early stage. So these things help you. Execution is fast. It's a one-page document. Just execute, wire the money. The guy gives you shares in India. You have to issue shares, allot shares. So some amount of compliance, but you don't need a lawyer. You don't need a lawyer for an ICO. Key features, very high resolution financing. This is what ISAFE will enable to you. You talk to the founder. Most founders now know this. It's a single page. Terms are discussed. Only commercials are discussed. The whole template can be taken. So just one document executed. Nowadays, it's all electronic signature, DocuSign, all of that. One document and you are done. What's in it for angel investors? Again, three things. Speed is of importance. You can beat other investors to it. Remember, if a decent founder, half decent guy, will have more than enough interest. So you are trying to actually get onto the cap table than the reverse. You feel I have money, so I should, founders should call me 10 times. Won't happen. You have to get onto the cap table if the deal is good. The only way that can happen is, I say, get it done, close it. Once the contract is signed, no party can back out. It's the best way to beat other angels, investors, in the deal. Founders are also comfortable, right? They don't have to give out too much rights. If I have to do this, will I take your permission? No. You don't have to kind of come back to investors every time. And that's what founders love. That's why founders love ISAs. Right? Again, structured as a CCPS. So it's a CCPS. You will get your liquidity preference. ISAF is nothing but a CCPS. So all those concerns are there. Over 500 investments have been made so far in our portfolio by angel investors. Some of the investors are right here. I'll quickly come to taxation and compliance, 2 minute stuff. I say it works the same as for foreign investors. So for those of you who have friends abroad, works the same way. You don't have to really do anything. All the compliance, RBI filing has to be done, can be done, will be done by the founder. So their consultants, those guys will take care of it. Even if the valuation report is there, they will see, they will get it done. For our founders, we of course have a support system. We help them all in that. Capital gains for domestic, as you guys may be knowing, long-term capital gains is treated as more than 2 years holding. And for that, there's a whole 20% plus indexation benefit. For short term, it's a business slab rate, whichever slab rate you are on, you will end up paying for a short term. Same thing for foreign. Foreign is just 10% instead of 20%, and with indexation benefits for more than 2 years holding. Less than 2 years, same outcome. It's basically 30% per year. Yeah, I mean, this is a powerful tool. If you know, I mean, some of you have already invested through ISAFE, so you would know. This is the only mechanism that can create multiple unicorns because, again, speed is of the essence. The faster guys get funded, the faster next round happens, the faster the company gets into a unicorn stage. We really feel at 100X, we will see 200 plus unicorns very, very soon, right? This is an open source document. You guys can see it. Go to our website. You will see the document right there. And startup investing has come of age in India, is expected to grow multi-fold. So this is probably the only asset class in our view that will grow disproportionate to any other asset class. And that's our view completely. That's what we feel, and we are already seeing signs of that. Recent trends, obviously, government has been helping, relaxing norms for startups. You've seen the recent things. 1% companies are allowed now. Loss-making startups are getting listed. So more exit opportunities for startups, investors. So you will have more and more of that coming. I think the government has done their part. It's upon us as the ecosystem to kind of make sure that the investment happens. There's an immense amount of change in landscape in the last 3 4 years. You could see only 50, 60, 100 active Indian investors. I mean, the fact that we are having a full room here itself shows that there are thousands of investors now. I was just on LinkedIn, and you type Indian investors, you get 5,000 results, right? Maybe 2,000 of them are really active and investing, but 2,000 is a big number from 100, which was like 5 years ago. So, huge amount of interest, and you are in the right place, guys. I mean, keep at it. And yeah, I mean, that's it. Thank you all. I think we'll end the session here. And we have another session now continuing. I would want to kind of welcome Anup here, Anup Mathur, founder of KN Capital. He's an angel investor. We'll have a huddle, we'll have a chat with Anup. Anup, welcome. Please. Thank you so much for taking time, and we just wanted to chat. So just to introduce, Anup has been investing into startups, and we'll talk more about that. And he's founded KN Capital. So just a few things that probably may not have been asked. I may ask him because he's been investing, and I know some of it where he's been investing. So we'll try to answer some questions. Please. Sir.
Thanks.
So yeah, I mean, one thing that right off the bat I want to ask Anup is that I know Anup invests in various asset classes. So how is it different for you? How has it been different? How did you come across startup investing? Who introduced you to it? How did you start seeing it? How did you now compare it with real estate investing or maybe listed market investing? What's your experience?
So, firstly, thanks for having me here, Ramesh, and congratulations on your first summit.
Thank you so much.
On the list. Startups is something which I was introduced to about a decade back, and obviously, Sanjay. So Sanjay introduced me to startup investing, and he was already got into angel investing, and then it looked interesting. As a day job, I'm also into IT media, and therefore, as an ecosystem, it kind of complemented because a lot of the startups are not to do with the safety, and that was interesting. In terms of how do we compare it to real estate investing or the capital markets, they're all different asset classes. Now, if I look at capital markets, then we all appreciate that it's perhaps considered as one of the riskiest and volatile asset classes. And we all know what's happening with the Russia-Ukraine crisis right now. So all of you who are invested in stock markets, you know where it is gone right now. Everybody's portfolio. But you just need to be very disciplined with capital markets. With startups, obviously, the more you start investing, the larger your portfolio gets. It's a very different experience because you also get to contribute to the startup. I mean, we hear terms like mentoring. We talk about, how you're helping the network to take off in your presentation, right? So you're able to do a lot with the startups. And of course, if you can help them move forward, then that's ideal. It's like proxy entrepreneurship at the end of the day. And that's the joy that you get, when you start working. It's like a adrenaline rush, at least for me, when I started investing in startups, looking at all the founders. I got into entrepreneurship about in 2008. So if I can see the same zest, the same zeal, then that's pretty much exciting.
I think that's wonderful. Anup's journey, I definitely know. He's been working with very large corporates. So he has an idea. He was on the other side, always been a corporate guy. And then now with his own core media, the IT media company, they're helping a lot of corporates also invest into startups. They are actually enabling the whole startup ecosystem. And with your investing, I think a lot of people can take inspiration on how to transform from a corporate guy to a startup investor. So I think that is something that what when you look at a deal, like when you, for something comes to you, what exactly do you look into? Like what are your few things that you definitely want in a deal that you may want to get involved?
So all that you showed on your slide, right?
No, you want to pick. You have to pick up few things.
And clearly, you look at the founder. So I'll put it in an analogy to that, right? So if you ever go to a derby, right, you actually invest in the jockey. It's never the horse. And so what it means is that you're actually looking at the founder. And you can call it the star team or whatever, but finally you need to see the founder, the team, and you look at the intent. At the end of the day, do they have the right intent to take the product or whatever they're planning to bring to the market in the right scale, in the right spirit, and that becomes very important. Now, some of the things are very given, right? That, it has to be a MVP. There has to be a product fit. The go-to-market is there. They understand. So all the ticks in the box are there. But I think what becomes very important is looking at the intent of the founder, the team, and are they really looking, for that success? Is that hunger in the belly, or is it just another? Okay, let me take a shot at it. It's cliche. There's a lot of money in the market. Let's take some of it. Let's try. If it works, it works. If it doesn't, it doesn't. Because, whether we like it or not, today the markets are very different. Right? Unlike about a decade back, money wasn't easily available. Right? You still had to go to a bank. You had to raise capital. You had to kind of give some kind of collateral. Today it's different. Right? There's a lot of liquidity in the market. A lot of investors, a lot of angel investing happening, and therefore there are a lot of startups coming, and we need a lot of those. But again, at the end of the day, you need to see that how the founders are going to be true to themselves, and is that really what they want?
Yeah. No, I think that was like very narrowly focused. I did cover a lot, but you put the nail on the head. I think and how much does this interesting question comes to my mind is how much does gut matter? Because I know in early stage there is some gut involved, and we all have experience. But how important is that after you ticked all the boxes?
See, most of it is gut. So it's always the gut which says, okay, this is a team I can bank on, and it's always the gut feel, right? And the more you meet the founders, the more you meet the team, the gut feel gets stronger and stronger. And then you say, okay, that's it, there I go. But yeah, absolutely. If I go back to your slide where you said you lose about half your investment, that's going to happen, and therefore you need a considerable size. You need to have a particular number in mind within your portfolio.
Yeah, no, I think that's very important. And again, this one question is: how many meetings do you typically do? Like, for example, a deal, you want to invest in the deal, you are focused, you like the stuff. But what is like? Do you have certain number of meetings that you want to have, or you probably are able to cover everything in one meeting and then you decide it? Like, what's been your pattern? How many meetings that you want, or have happened with the founder before you conveyed that you want to invest?
See, an average is three. Usually 2 to 3 meetings. 3 is an average, but there have been deals where I just met once, but I spent half a day.
Exactly.
And
That's the
then
point.
deep
The time
dive,
spent.
understood the whole thing, right? And then gone ahead with the.
And I think that's great. And where do you see this whole startup? So one important question that I comes to my mind, and we'll take some more from you guys. Right now, we're seeing a lot of froth in the startup ecosystem, right? Listed market so low. Private startups, we know what's happening in the market. A lot of valuations have gone up. A lot of deals are happening at fancy valuations. Do you think there's a froth emerging in the market? Is there like a correction in the listed market is happening? Do you really see a correction happening? But I'm sure a lot of people are thinking about it. What's your take on it? Do you really see valuations becoming rational for a while, in a bit, or what's your sense? What do you think?
See, of course, there are the overpriced deals that come in, but if you have a conversation with the founders, you are able to rationalize it. Is there a froth? Yes. I think a lot of us in India are trying to kind of follow the 15 minutes where it goes into millions, but it's in the ground reality in India, it's still in INR, right? It's rupees. So you still have to look at the valuations in line with what the market is. But I don't think they're very overpriced. Some of them are fairly reasonable. And I think the market is really going to grow.
How much importance do you put on IP? Like, okay, there's a with the tech and IP product. I mean, at least I'm a finance guy. I probably don't understand, but you are in IT media, so you understand it more. How much does IP play a role? How much does the roadmap? What kind of like how much importance do you put for that country? If the product, I mean, what do you feel? How much important and tech, and how do you really evaluate tech? Sometimes it becomes difficult for angel investors to evaluate tech. Any pointers for our audience?
So if you would have asked me this question 5 years back, I would have bet only on IPO. There was no IPO, I would have money.
Okay.
But today the market has changed significantly. So if you start looking at every business and every startup that comes in, some of them are just services, right? So there may really be no IP, but the idea is it's absolutely unique. Of course, there are multiple ways to look at it, whether it's time to market and other things. But IP is important depending on what the startup or what the entire ethos of that organization. But if you look typically from a product standpoint, from tech, obviously the IP has to be there. And I do a lot of B2B because that's a bit of a sweet spot. Right? Because being in IT media, I understand a lot of the B2B side of things. We know the ecosystem right, being there. So therefore, IP there becomes very important. And there are quite a few that come in over there which are like a B2. So for example, in the past I've seen quite a few which have been like, okay, we are now going to be the new ERP. You really don't need new ERP. There are plenty in the market and there's enough open source. And to your point which you mentioned, so they become more like a cash flow business. Right? But typically if you're evaluating tech, you have to start looking at quite a few data points in terms of whether there is a market for this particular product. And again, it classifies between B2B and B2C. But in B2B, you typically start looking at is there going to be a need for this. Right? So many times I would actually call one of the CI friends. And I was like,
that's a wonderful one.
And in this way, it's not something that we really need. It sounds good. And I might do that with 3-4 friends across the board, across industries and get a bit of feedback.
Yeah.
And then accordingly take it.
I think Anup is uniquely positioned. He knows like at least 500 CIOs in the country. So any startup approaching, he'll definitely have one CIO call as a backup to know whether this really is happening or not. So I think you are very well placed. So that's something that's an idea. And I mean, one of the last questions, I know we are kind of running out of time, but what are your favorite sectors? Like right now, whatever you've been investing are in these sectors. Plus, more importantly, which of the sectors you are now tracking, you think are going to be the winners, the key ones to watch out, especially in 2022 or in 2023?
So, as of now, I'm pretty sector agnostic. I don't have anything specific that says that it's only going to be this sector. But anything which has got a tech play, deep tech, pure play tech, that gets very exciting. See, more than that, for me, it's a lot to do with what I understand. Right? So, with my background coming from financial services, coming from banking, coming from tech, those are the areas I understand well. I've done a lot of other things, so it has to be an area that I understand, and that's where the excitement will. But I see QSRs. I think India needs a lot of QSRs. That's one area which is missing. EdTech clearly is on the growth path and it will continue. Anything on digital skill set is a challenge in India right now. And the more I speak to CIOs and in enterprises, today there is a lack of skill set when it comes to digital, or you're talking about DevOps. These things are really missing there. So, and that's why I said that today there is also a services play. It's not just limited to only product.
No, I think that's a fair bit. Some of that insights, I think we keep talking to you regularly and has been reflecting in some of our portfolio companies. We will soon announcing our next batch, and a couple of them are in that, so I'm sure you'll like them. Guys, any questions from your side? I mean, while we're talking, if there are any questions, happy to take them. I think Anup and I we can take that. You can answer that. Any questions, please? We have him here. Let's take the most out of it. Anything that anyone needs to ask, please feel free.
I think the presentation covered practically everything.
But as we say that it's always uncertain, right? Till you dive into it, till you know the outcomes, and we are virtually in the investing phase. So I think question can we have the mic there? Please.
One question for Luke. When you started your investing journey in 2008, what was your checklist and what is your checklist now?
What was what?
Checklist of investing and what in 2008 when you started, and what is your checklist now? How different is it now?
Oh, it's still pretty much the same. The basics are still the same. The basics haven't changed. It's just that the landscape has changed in terms of the kind of startups that come in, but the basics are still there. Right? So the gut feel has to be there. The entrepreneur has to be, dedicated. Has to be the one who's like true to himself. So a lot of those things, the starting. So it's been pretty much static from that way. But of course, like I said, the landscape keeps changing. So then you start looking at, what are the newer things, innovations, and everything.
Please, please.
Do you see differentiation and valuation between services companies and services companies are going to indicate about that? Risk of higher, especially in the talent pool.
Murli, you could have especially asked me that question offline also.
He wants to put you in a spot actually.
No, but I think the valuations for services companies are only going to go higher now, because at the end of the day, the way technology is moving, services is only going to grow. And like I said, skill set is a challenge, and therefore today you will see a lot of even the large conglomerates who are emerging into as services play. Because today there is so much of a requirement, there is so much of a need for the skill set. Because in the last 2.5 years, with the digital economy picking up, what is typically happening is that you just need to constantly keep upgrading your systems, your new innovations that are happening, but people are not there. So services is pretty much to watch out for. I hope that answers your question.
I think we have one question. Yes, please.
I'll this is not a question, but I wanted a comment from probably either of you or both of you. So, for example, I have invested in a few of the companies from 100X, right? And this is about the valuation that we discussed about it. And there is a discussion to say that some of these companies, even at early stage, because they've got, Y Combinator and other support coming in, suddenly the number zooms up, beyond the level. And it is about the intrinsic value in India, but the moment it is flipped over, we're talking about, number which runs into 15, 20 million and so on and so forth. So does it worry you as an investor? I mean, you might get excited that the value is going up, but the intrinsic value is still not there. And to your point, you said that the numbers change dramatically, India versus the US side. I just wanted a comment from either of you or both of you, because it just sometimes blows your mind.
Anup, I wanted to take it first, and then I'll invite Anup to answer that. Good question there from you, sir. In case of a flipper, this is classically called a flipper, where guys shift to US base and they get Y Combinator, and post Y Combinator, it's fancy valuations. But yeah, good if I'm an investor already in it, love it. But yeah, I think US looks at things quite differently. The ecosystem probably is still mature there, and why this question comes typically is we in India are that it has to do with that nascency of the system, right? We are not yet as evolved. I mean, we think we measure companies from our own parameters, but in the US they evaluate on a different parameter, which is why you see the fraud happening. And sometimes the fraud is right, wrong, whatever. I mean, we can't really judge what is right or wrong, but if it works in your favor, it's right. If it's not, you're not part of it. You start wondering why is this guy getting so much valuation. But I mean, that's my. So Anup, you want to take a jab at it?
So the way I see it is the minute there is funding coming from a global standpoint, where the company is going global, then the market has changed. It's no longer an India market; it's a global market. So obviously the valuations will change because now the investors who are looking at, let's say, from the US or in Silicon Valley, they are now seeing it as a global player. And obviously the market has changed significantly, so the assumptions have changed significantly. It's good, and if you're invested in that, then what's there to compare?
We'll probably take one last question. We're running out of time, and then the next Q&A session starts. But please, Vipul.
Vipul from Liquidation. This question is for you. I think you've been investing for a long time.
Can you just speak up a bit?
Yeah, sure. Is this louder? The question here is, I think we are young investors, relatively speaking, and over the years that you've been investing, what are now the 2 or 3 red flags for you when you're looking at new businesses or founders?
So I think one of the big red flags that comes up for me is, it's that gut which we were talking about. When you're talking to the founders, right, and you just don't get that feel. So they tick all the boxes, but when you still get into that conversation, you're still not getting the feel, right, that these guys will be able to pull it off. So that does come as a red flag. I've made my set of mistakes. I won't say that I've got it all right, and everybody does. It's everybody's individual journey, but clearly that's one thing that you look out for. Second is you also need to be very clear in terms of what is their strategy. Right? So many times when something is pitched to you, the marketing or the go-to-market strategy, what they discuss versus what they want to implement, or even later they want to pivot. So these are the things that only come out when you're having multiple conversations. You see, you want to invest in a startup which has got a laser-sharp focus, they're going after one product, one service. But many times when you get into a deeper conversation, you suddenly realize there are multiple products that they want to focus on. So you're not going to get the outcome of that. So these are a couple of things that I clearly look out for. And thirdly, of course, you just need to look at how dedicated the founder is at the end of the day. I always tell a lot of the founders in which companies that I'm invested in, people keep talking about the burn rate all the time. Right? So I think you should start also looking at the earn rate, because that's important. At the end of the day, a business has to become profitable.
Lovely. I think that was fantastic. The last statement, I'll take it home. Start looking at earn versus burn. Thank you, Anup. It was wonderful talking to you, and it's never enough. But yeah, thanks for being a wonderful audience. We have a host of events lined up, and I will invite Vinod to take over the stage. Thank you so much. We are around, so we'll catch up. Thanks. Yeah. So, guys, we're taking a small break. Just be here. Don't go out too much. We have an interesting session starting with the keynote and then a lot of stuff. You guys have the agenda. So please be back here in 10 minutes. Thank you so much. exactly 10 minutes. And that is, there is a reason for that. I have two kids, a lot of you know that. And my second son always wants to know every morning, Dad, what are you doing today? But when I ask him, Neil, what are you doing? There's a dead silence. You should not know what I'm doing, I should know what you're doing. It's an unfair deal. That's the way it is. When I told him what I'm going to speak about, he said, Dad, 9 slides only. They're all very wise people in the audience. They know more than you. Don't pontificate. So I'm not going to do it. You have to follow advice from the young chaps, and I'm going to follow exactly that. With 9, I've added 2, 3 more, just so that I thought I must do my value addition other than my son. So I'm going to speak on the Moonshot game. At 100X, wherever you invest, you look at moonshots only. Is this company, is this startup going to become a moonshot? If the answer is probably yes, definitely yes, 100% yes, we invest. If the answer is we don't know, we do not invest. So it's a very different approach, and I'll take you through some of our parameters, what we think of when we look at moonshot. Let me begin with this video. I so much love this video. It's fantastic. This guy is a founder of Dollar Shave Club. In 2011, Mark Levin and Michael Levin, the two people, thought to themselves over a party, Friday night, Saturday night, saying, why do we have to go through the hassle of every 15 days, every month, going to a store and buying a razor? Shaving is required every day. Isn't there a problem we can solve? Both of them founded Dollar Shave Club, subscription model, razors, simple, effective razors, non-branded, delivered, definitely week on week, month on month, fortnight on fortnight. And within 4 years, they sold it for $1 billion cash. What are they solving? A simple problem, no complicated problem. Have a look at this video.
Hi, I'm Mike, founder of DollarShaveClub.com. What is DollarShaveClub.com? Well, for $1 a month, we send high-quality razors right to your door. Yeah, $1. Are the blades any good? No. Our blades are great. Each razor has stainless steel blades, an aloe vera lubricating strip, and a pivot head. It's so gentle a toddler could use it. And do you like spending $20 a month on brand name razors? 19 go to Roger Federer. I'm good at tennis.
And do you think your razor needs a vibrating handle, a flashlight, a back scratcher, and 10 blades? Your handsome-ass grandfather had 1 blade and polio. Looking good, Papa! Stop paying for shave tape you don't need. And stop forgetting to buy your blades every month. Alejandro and I are going to ship them right to you. We're not just selling razors, we're also making new jobs. Alejandro, what were you doing last month?
Not working.
What are you doing now?
Working.
You know Vanderbilt, but this train makes head. So stop forgetting to buy your blades every month and start deciding where you're going to stack all those dollar bills I'm saving you. We are DollarShaveClub.com, and the party is on.
So sometimes it's the simplest of idea which can stay. Very, very simple. This is not a rocket science idea. Razor blades every month on a subscription model, and we build such a large business. So scale or fail, this is the mantra we follow at 100X, and this is how we select companies which we need to invest. And this is a moonshot game. What is the market size? Are you selling 8 grain bread to South Bombay residents? Then obviously the market size is very small. But are you looking at something bigger? We are not interested in a small market size, and that's not a moonshot game. What is the addressable opportunity, and what is the positioning and segmentation? Why? Why is this product or service? Is it filling a vacuum? Is it just a vitamin pill or a painkiller? Vitamin pill you can avoid every morning, but if you are in pain, you need a painkiller. This is really important to address. Non-linear growth is important. If Ganesh mentioned in the morning about lifestyle business and venture VC fundable business, if this business cannot have a non-linear growth, it is not a VC fundable business. It's not a moonshot game. Then you are doing a business which is a lifestyle business, good for the lifestyle. And of course, velocity is very, very important. What is the viability in the product? It cannot happen that the founder tells us that we'll spend X amount, we get X amount of revenue. We spend 2X amount, we get 2X amount of revenue. It cannot happen that way. So here are my slides, which my son said. The first 3-4 slides are mine. This is for my son Neil. 9 slides he said, so I'll be sticking to 9 slides. So what would be missing if your product did not exist? Simple question to ask every time you invest in a startup. What is missing? I will give an example. We invested in a company called Vitra, Vitra.ai. They came to us and they said, for 2 years we have been working on the AI platform, and we are able to translate short videos into 50 languages, 50, within minutes. Fascinating, because otherwise you have to hire a dubbing studio, you have to get an artist to come, all of that stuff, expensive, time-consuming, and not productive. And within minutes they can convert. So what is missing if they hadn't introduced this? Because it's a very time-consuming process. So this is one fundamental question we ask, and you need to ask if you want to look at Moonshot. Do you love a product or customer? It is such a simple question, but 90% of the people we meet, the founders will love the product. They have a lot of them are techies, and they love the product so much. You have to tell them, friends, you have to love the customer, not your product. Product is important. It's not that product is not important, but do not fall in love with the product. Fall in love with a actual person, with a person, human being, not with your product. You have to keep telling this on and on. And at an early stage, chief everything officer. One cannot say, I'm going to do only sales, I'm going to do only tech. We have Kinner with us today. Kinner runs Nourish, a startup called Nourish, and I think he's got close to 750,000 users now. It's a platform for creator entrepreneurs to go online. And he does everything from sales, marketing, finance, business development, all of the above. At an early stage, a founder should have the capability to become chief everything officer or a chief enthusiasm officer, either the two. So that's what it means. Winning idea or strong execution. Now this is a tough one. What would you select? You would say both, right? People will say both, right? But here you have to then make a choice. What are you looking at? Are you looking at the execution part? See, ideas are important. Ideas are fragile. You have to nurture ideas. But at the end of the day, if execution is not there, the startup is going to fall down. Very, very strong execution required. Absolutely strong. Can there be a space to disrupt the crowded market? There is always a space. Just look out and see the friction which is happening and find out the problem. Find out problems which can be solved. I go to a lot of colleges and speak to them, and at the end of the session they say, but Vinod, can you give me an idea to solve? I said, that's not my, what I'm going to do. Just look out and you will see a problem which needs to be fixed. It could be a crowded market. We have an example of Kerala banana chips, is right here, Manas. He came to us and he said, I want to do banana chips from Lendal bananas in Kerala, very tasty, and not touched by hands, hygienic. Now, if you go down this Worli Naka, you will find 10 brands of Kerala banana chips. Not of Kerala banana chips, but of normal banana chips. What is so different? It is a crowded market, but he has been phenomenally successful by targeting a particular brand of bananas and ensuring that even in a crowded market, he can make an impact. College mates sometimes, not always, sometimes make the best co-founders. Because you, ideally, of course, if you're in a hostel also, you stay along, know each other so well, and sometimes they do make good founders. We had this 3 founders of a company called Utsav, one of them is here, Utsav app. They came to us from Calcutta, and they're building a community platform for followers of faith and divinity. Sounded simple, and we decided to invest. And this is an anecdote I must share. This is a real life anecdote. We decided to invest in these young founders, And I thought, let me be a little bit pull the leg for 60 seconds. I said, if the combined age of all three of you is less than me, you'll not give me a thumb sheet. So they started with me, I'm 20, I'm 21, I'm 21. I said, you are just about more than me, combined age. But this is how the founders are, and they're all college mates, they've got great understanding, and I'm sure they'll do exceedingly well. D2C brands. Now this is very interesting. We are now seeing a lot of D2C brands. There are obviously advantages. The advantages, of course, connect with the customer. You own the customer journey. There are no middlemen in between, and you are able to influence. You get direct feedback. You can pivot. You can change. It is not so easy to acquire D2C customers because India has got a lot of channels, established channels, and you can go through the channel and get customers. But I firmly believe that we will be seeing more D2C brands in India. We'll have a lot of moonshots in D2C brands. And is the founder a mercenary just out there to do, a filling on a particular year, or is he or she a missionary? I'll give an example. We invested in this company called Kroop, Kroop.ai. They came to us, the scientists and engineers. They said we are solving the problem of deep fakes. Video deep fakes is becoming a massive problem. On YouTube, you can get a video of, let's say, I'm not such a famous person, of Dhanpal, let's say, saying something which is never said before. How do you identify that, since you're sitting right there, how do you identify that this is a deep fake? And they had technology immediately identified it. And they were on a mission. And then they subsequently pivoted to a technology to find out to do synthetic data. So that is a mission they have, mission to find out this. We have to have founders who are on a mission. And this is my last slide. Is the startup founder's first salesperson. She or he has to be a salesperson. The founder not able to stand in front of the product and say, this is what I'm selling to you, this is what I'm marketing to you. It is a problem. Just a couple of days back, I had a conversation with this startup and they said, we are hiring sales manager. I said, are you crazy? No, we are scared to be in front of the customer. Then, pull up your startup. It's not going to work. You have to be in front of your salesperson. We have Rohan here from Super Scholar. They've got a platform for scholarship for EdTech companies. He is in front of all the customers saying, this is what Super Scholar does. This is important, exceedingly important. Sales is not taught anywhere, unfortunately. There are no textbooks, even MBA colleges teaching sales. I have done sales, a lot of you people have done sales. It is not easy, but it can be learned. I sometimes wonder why sales is not taught in any of the colleges. You are an MBA, but you're not had understanding of sales. It's a technique. You have to be on the field, on the street, and understand it. Be the startup's first salesperson. So these are my 9 nuggets. My son Neil had said, Dad, only 9, so I'm going to stop at this 9. And finally, I had to take some liberty of adding a couple of slides. Don't always listen to your kids all the time, 100%. Little bit liberty to take. So I added just 1 or 2 slides. Typically, when you are putting money, you think of what can go wrong. What will happen if this folds up? Will I get my money back? Will I get some dividend? Will I get something at least? कुछ तो मिलेगा Vinod? Yeah, ask me. Valuation startup. I can see some people already nodding no. When we invest, we only think of what can go right. If this goes right, what can happen? It's a very big shift in your mindset because you've always been trained to think of what can go wrong. In your education, in your upbringing, if this happens, be careful. But when you invest, if you want to invest in moonshots of the future, always think of what can go right. So that's it from me. 9 slides and a couple of more from me. And I thought I will share my experience on Moonshot. We're going to have a next session very soon, but I have plenty, 1 or 2 quick questions. We can take them, otherwise we'll move on. Any questions? None? I can give my son's email ID. You can send it to him as well. neilkarke@gmail.com. Thank you everyone for coming. Thank you.
Thank you, Nima. That was great. The past decade has been instrumental in rewriting India's history. With technology and young talent marching ahead, India is now home to several unicorns in a short span of time. To help us understand more, I would like to welcome Mr. Democratization. He is the Vice Chairman of Eversole Group and also the CEO of Eversource Capital, focusing on sustainable development investments in India. He has over 24 years of corporate finance and strategy experience and was a partner at KPMG before this. Previously, he has held senior positions at Vedanta Resources and ICICI Securities. I welcome Sir to this meeting. Just allow me a minute, I think this is the different mic that we have now.
Yeah. Hi, very good morning to all of you. First of all, great to be in person after about 23 months. It's my second event the last 1 month, and seeing faces instead of a flat screen in real life, I think it's fantastic. Sanjay, when he reached out to me to talk about, India as a unicorn nation, I actually Googled to check who coined this term. And there's this lady, I'm sure a lot of you know, Lee, 2013, she wrote this fantastic article about what a unicorn is. And kind of I found it a little bit almost amusing, because unicorn is a mythical animal. And here we're talking about real successful businesses. But having said that, it's also something that has become such an aspirational term. And that term has now become a global term. And what we are seeing clearly is that there is some sort of a complete fascination to aspire to be and to kind of, be part of this whole unicorn journey. So really, before I thought I'd talk about my perspective, and again, I'm not the right person. I actually told Sanjay why me. And I think the idea was really for me to share my personal, journey, my personal experiences, and my personal observations of what I see, what India has become over the last 30 years, and particularly over the last, I would say, 5 years or so. And for me personally, the journey of entrepreneurship actually started as a student. I went for my studies, advanced studies abroad, went to a college called Babson. It incidentally turned out to be a college for entrepreneurial studies. It's been rated for the last 25 years as the #1 college in the US for entrepreneurial studies. And I studied entrepreneurship. It's kind of a little bit of an oxymoron, right? How do you study entrepreneurship? I mean, you see, entrepreneurs, and everything you as an entrepreneur you do is a new learning every day. So how do you go to a classroom and study that? But it's something that I guess I had a romance for entrepreneurship, and that romance has continued for the last 30 years of my professional journey. I returned in 1992, and that was literally the watershed moment for India. India had gone through possibly one of its worst, balance of payments crisis. Manmohan Singh came and massively reformed. And that liberalization, if you look at it 30 years from where it was in 1992, where you literally were thinking of Star TV as this massive, electronic wonder, where you could actually get so many channels in your TV instead of 8 channels, to where we are today, where your entire world is in your palm of your hand. That, for me, is possibly, I think, has seen many economic cycles, many journeys through these economic cycles. But I see a lot of friends in the audience, and I can bet you that all of them would say that none of us have seen anything like what has happened in the last 3 years or 5 years of our lives. none of this last 30-year period, any 3 to 5 year period, has been as, I would say, vibrant, dynamic, exhilarating, worrying, challenging all at the same time. And it's possibly one of the greatest periods in post-independence India of entrepreneurship that I have witnessed or I have observed. So the thing is, what has caused this massive groundswell of entrepreneurial activity? If you look at the pre-91 period, and I think a lot of the entrepreneurs possibly wouldn't even be possibly in school or wouldn't have been born today. It was a very different world of licensed Raj. And I think it's important for one to understand history, to understand potentially what the future lies for us. Licensed Raj was a very, very supply constrained economy. If you had the license to build something, it would sell. So you don't need to be a salesman, as Ninad just mentioned, be an entrepreneur. You just need to produce. Post 91, it unshackled and actually allowed the private sector to come in and compete. Compete on market basis rather than competing on a supply constraint or a regulated basis. And that period also, if you look at it, in some ways led to the birth of consumerism. As the Indian economy grew, as we started actually having economic foundation, per capita income grew, disposable income grew, consumerism grew in this country. But the pre-2000, I would say 91 to 2008 period, was really all about these two major kind of moves in this country. Private sector building and private citizens consuming. And I would say that in some ways it also led to issues around building moats which were not necessarily really market-based moats. A term which became quite popular and became kind of almost it has become a fairly evil term, is crony capitalism. Right? What happened during this period is that people use ways and means to fix the system and build moats around their businesses. So that became some sort of an artificial advantage in how you create those moats so that your business is sustained. But what I would say, we are witnessing the post-2000 and especially the post-2016 period, which I'll talk about, is the democratization finally of the entrepreneur in India. India has been, possibly for the longest period ever, a country of trade and commerce. But we are finally, I think, becoming a country of entrepreneurs and capitalists. And this democratization, in my mind, really, there are, in some, what I call 3 factors which drove it. The first is formalization of the economy. The second is digitalization of the economy. And the third is what I call is the unification of the economy. If you look at formalization, what India has done, I think most governments around the world have not been able to do successfully, is actually create a unique identity system which allowed every Indian to become part of the formal economy. Supported that with a unique digitalization program called the India Stack to support financialization, reaching the absolute grassroots levels of the economy. And all of these, if you look at it, right, allowed us to move from, if you think about it 10, 15 years ago, we always talked about India having 2 economies, a black economy and a white economy. And just what's happened over the last 5 years is because of these moves that we've seen something like a third of the economy, which was black. Potentially, if you talk to most economists, they say it's maybe a single-digit number today. Which means suddenly you had an India which you could not address, being addressed in a formal and in a digital manner. There's also the whole pre and post 2016 period, where it's almost, in some ways, we call it the pre-Geo, post-Geo, or the 2G book period, right? Before 2016, we were a 2G country. When Geo came in, 4G came in, we suddenly became a data economy. And an economy where basically what I call the India 1 and the India 2 both started participating heavily in economic growth. Because pre that period, it was largely India 1 which was driving. And India 1, in my definition, is the urban, affluent, middle class India. And the India 2, that I would say the urban affluent is close to about 150, 200 million, whichever we add up. There's a whole India 2 which is servicing India 1, which is at least another 300, 400 million people, which got completely integrated into the Indian economy because of this one, I would say, very significant factor, which is basically digitalization. This inflection point, in my mind, created the India and what we call the Bharat of today. And that has almost coincided, I would say, with the fact that the government, which was waiting or rather trying to unify the country through a common tax regime, eventually passed a law for the GST around the same time. So there's almost a tectonic shift that happened. You saw a sudden formalization, you saw a sudden digitization, and you saw a sudden unification of this country, the like this country has never seen before. And what you've seen, therefore, as a result of the last 5 years, in my mind, has been a revolution of sorts in India, which we had never. And in fact, I have now, having spent 30 years of my professional career, I can say I too don't understand this India anywhere close to, many of the younger ones who are kind of not born with any legacy and therefore with biases, and actually creating new India in a way we've never seen before. Unification also did a massive thing, right? There were 29 complex markets. When we were investing in the 2000 and 2010 periods, we were always investing based on a local, a regional, and then finally a national play. Because it's extremely difficult to build national businesses in India. And here Ninad is talking about B2C businesses. You look at the rise of B2C businesses, the less friction that is required to actually go reach your ultimate customer. The ability to sell without necessarily having to build the entire sales channels, the distribution channels, the access to that ultimate customer. It's something, again, which has been a revolution of sorts. I mean, it's a lame example, but Lakme took 45 years to build what it did. Nykaa, you all know the story, right? In 8 years, it's done what most people did not believe was possible. We ourselves actually invested in a beauty business. We invested in $1 million brand, made it a $15 million brand. It took us 5 years to do that. 5 years, 15x, not bad, but yet it took 5 years. And now we are seeing $1 billion companies being built in 5 years' time. I think another very powerful thing that's happened is that India has figured out its Indianness, and the Indian entrepreneur has figured out its Indianness. Vernacular. What was seen to be a disadvantage is now being seen as a massive enabler and an access provider to a large set of consumers. And consumers today, interestingly, are consuming content like they never consumed before. They're consuming creators like they've never done it before, and they're consuming commerce like they've never done it before. And I think what you're seeing today is a market driven by creators, content providers, and commerce, all reaching in all sorts of, I would say, from a geography, language, as well as from an access perspective. I think one of the things in all of this, which we haven't yet as a country really captured, and where in many ways I'm reading some stuff on artificial intelligence. And this is an area where I think India needs to do a lot more. There's the whole US model, there's the whole Chinese model. There's a great book written by this guy called Persuading. He's a venture capitalist, PhD, basically worked in Google, Microsoft, was running Microsoft for China, and basically decided to become a venture capitalist. He's written a book about the rise of AI and how AI is going to basically create the next new waves of digitalization for economies going forward. I think the Indian version of that, I would request you to read Mr. Chandra and my colleague Rupa Purushottam's book on Digitalization, where it talks about the use of AI, but not really to reduce jobs, but as an enabler to actually create more jobs. And I believe the next phase for India is going to be out there in the Bharat part of India, where one has to focus on actually reaching out to that Bharat and using technology, using data, using analytics, and finally using artificial intelligence to make the services much more affordable, accessible, and available to basically the Bharat of India. There is a massive opportunity out there. what we are seeing finally, I would say, is in many ways a formalization, digitization, and unification. A lot of these markets, which hitherto were just not available to the organized sector, they're not available to the formal economy, and that's where the entrepreneurs are coming and playing an extremely important role. Finally, I think why has all of this happened? And if I just focus ourselves on the entrepreneur, why is entrepreneurship become such an enabler, which earlier used to have 20,000 issues about being able to even build a business, let alone even think about a business, let alone build a business. And I think there are 4 key elements. One is the founder, second is the customer, third is the talent, and fourth is the capital. If you look at the founder mindset today, and that's really starting at the level where people are just coming out of colleges. When I grew up, I think the epitome of a successful exit from a college was getting a multinational posting, or if someone was coming from, say, some of the tier 2 towns in India, was basically getting a government job, or at best, they would look to basically get some sort of a, corporate kind of a position. 30 years hence, I think the first and the most important criteria for people to see themselves as successful is, are they able to start up themselves out of college? If you look at most colleges today, they're actually throwing out more startups than what we've ever seen before. In fact, I talked to a professor, friend of mine in IIT Madras, and one of the biggest things they're seeing in their information research center is really people focusing on deep tech, on robotics, biotech engineering, etc., all wanting to basically go and build businesses of the future. No longer is it, I would say, a taboo to be a founder. No longer is it a taboo to be a founder and have failed in a business. In fact, failure has now become almost a badge of honor. And therefore, if some founder is going out there, building something, failing at it, and wants to come back, we actually look at that as fantastic experience to hire back into the corporate ecosystem. Because the courage, because the agility, the flexibility of mindset, like you said, CEO, chief everything officer, all of that capability comes into the person when you go out start doing. So it's no longer a taboo to do that. 2 is, I would say, talent. The other flip of building a business is not about yourself, but how do you build the right team? What India has done in the last 20 years, because of corporate India growing so rapidly, has created possibly one of the largest pool of professional talent available globally, and possibly one of the smartest pool, because they've seen growth, which has been amongst the highest growth anywhere in the world. That professional talent today is actually facing almost a second career or a FOMO situation. And that FOMO situation is, look, I need to be now part of a startup. I've done enough in the corporate world. So either I do something myself, I go and join a startup. It's fantastic. I don't think 20 years ago, anyone had the opportunity to go and recruit top professionals into their startup. Today, it's the reverse. It's almost a reverse brain drain, right? That corporates are seeing maximum resignations. And especially after COVID, we're seeing that. Because most of these fellows want to go and start or join a startup. The third is customer. I've talked a little bit about it, but at the end of the day, I think the fact is that the reach to the customer today, the many barriers I talked about which have been unshackled, I think just gives an entrepreneur or a business massive leverage to be able to go and build markets in the shortest time. And finally, I think capital. This is an prime example. I don't think this model would have survived because there wouldn't be that many entrepreneurial ideas. When we were doing private equity 15 years ago, I could count the number of private investors on my fingers. To add a little bit more. That's it. From that, today we are seeing thousands and thousands of angels around the country participating in the capital provision program. I just met a colleague who introduced me, and they have 1,000 agility. Where are you? How many angels do you have? 2,000 angels on their list. Sanjay told me he has 600 investors. And incredible. So what's happened is you've seen wealth increase in this country, and this massive cycle of capital flowing back into the economy, and a big chunk of that not going into the capital markets or in the public markets,
but also moving into the entire entrepreneurial and venture ecosystem. Earlier, if you needed to raise capital, either you needed to go to a development bank or needed to go to your friends and family, and that was the only way to do it. Today, if you have an idea, there will be capital to back you. So again, I think a confluence of all of these factors, entrepreneurs who are courageous, who want to build businesses, want to be founders, want to create a change, build business of the future, build category disruptors. Markets, which I've told you, are completely unified and formalized in a way where you can access it easily. Talent, which is available to help you build your businesses, and finally capital, which is kind of the raw material for businesses to make businesses work. So with that, I think I'm pretty excited. At the same time, I'm extremely anxious. The anxiety comes from the fact that I don't know where my next competitor is going to be coming up from. It may be someone in this cohort. My businesses, I'm really excited about them because I do believe that we are possibly in the next 10 years in the era of what I call digitalization, sustainability, and manufacturing. And everything that we have today to offer is available. And it's just literally the power of our dreams and the power of our ideas. It is going to limit what we can do over here in India. Thank you.
Thank you, Dhankal. I call upon Vinod to handle the token of appreciation. The journey for a startup from the seed to the market is challenging, but it can be successful if it is purpose and solution driven. To throw light on this exciting route for startups and their investors, I call upon Brendan Rogers to the stage to talk about that story from seed to IPO. Currently, he is the co-founder at 100X.VC, an early-stage cross-border fund across India and the US. He has co-founded VAC, a venture in the pet space, which has raised over $360 million till date. Brendan is an active advisor and mentor in the United States and across Asia, and he has traveled to Mumbai especially for this very summit. So welcome, Brendan. The stage is yours.
Hello? All right. Thank you very much. I really appreciate it. So my name is Brendan Rogers, and I am from a small town called South Kingstown, Rhode Island, small state in America. Definitely want to have this more, a little bit informal, and want to talk about my journey from founder to now investor. So the goal is for this talk is to hear more about my story as a founder and why now I'm investing in media and why I'm so happy to be here. And then lastly, how I invest here, and if you guys can ask me questions on how I find deals, how I get into deals, how Moonshot and I really provide value to founders, please, I'm more than happy to answer those questions. So basically, I moved to Palo Alto in 2011 with no money. My grandmother had a little bit of a tax return, and she said, "Hey, Brendan, here's a little bit of money. Go to Palo Alto and start a company," because we always would talk about startups. I got on a plane, went to Palo Alto, and really had no idea what I wanted to do or whatnot. And the team I was with were, your typical, founders that didn't really have, amazing backgrounds and families that could really help them. So, we really had to hustle and really had to knock down doors to get inside the room. And, we had a lot of no's and we had a lot of yeses, but, it was a journey that we were all very excited to go on. So in 2011, I started an online dating site that was precursor to Tinder. And we were trying to connect people to go on dates. Went up and down Sand Hill Road in Palo Alto, and everybody said no, but we kept working. And eventually, we had people that believed in us because we just kept hustling and hustling and hustling. And when I moved to Palo Alto, I lived in an apartment that was 500 square feet, 4 airboats. And my partners and I, every night we'd go home and it was like just tough. It was something that we wanted to really we didn't know how to get to the next step. So we had advisors in our corner to allow us to get introductions to people. So this dating site was a flop, but we learned a lot. We learned about how to get investors. We learned about how to hire. We learned about just how to hustle, how to move. And honestly, the energy in Mumbai today reminds me of the days when I first got to Palo Alto with my grandmother's tax return. So fast forward, after that venture, it did not go as planned. We basically had a couple of weeks left of capital. So my co-founders and I decided to go to Los Angeles. In Los Angeles, most people have pets. And marriage happens later on in life in LA. So people have pets and there's a lot of traffic and it's very hot. So dogs are inside all day. And in 2014, pressing a button and getting a car come to you, or pressing a button and getting deliveries delivered to you was very popular. So that was the experience that a lot of millennials were doing in 2014. So what I thought of was, why not connect pet parents to dog walkers? And in Los Angeles, everybody has side hustles because people want to become famous. And one thing about pet parents is that there's a high lifetime value of pet parents. People have pets throughout their whole lives. They have multiple pets. They have dogs, cats, birds, fish, whatever. But we knew that if we could connect pet parents to dog walkers, then we could really, have a special place in their heart that they trust and care about. So what we did is we launched an MVP, and we essentially had the Uber of dog walking. And on the marketplace side, on the walker side, it was a very, exciting job for people in LA because they could walk around in the sun and walk dogs and get paid. But the business, a lot of investors said, this is a lifestyle business. This is not a venture backable business. You're walking dogs. Not everybody wants to be the dog walker. But through my journey as a founder, we essentially knew that if we could get inside the pet parent's heart, and if we could build that trust, and if we could launch a service that was repeated every single day, then we could upsell them into other pet-related categories, such as sitting and boarding, delivery of medication, having your pet medical records. And all of these services would create a moat around our competitors. So what we did is we scaled the WAG platform across the whole United States of America with dog walking, and we focused on dog walking specifically because we knew it had the highest retention and frequency rate, and we knew that it was the lowest barrier of entry. And we knew if we could get inside that pet parent's house, that we could scale this platform. So my co-founders and I, through all the ups and downs and whatnot, we were able to raise capital very quickly. And we looked for specifically, and I think this can go to a lot for you guys, is we found angels and funds that could provide value immediately. We didn't want people that would just send the money and then we don't hear from them for a year. Our angels were very, very value added, and our early funds were very value added. So the business scaled very quickly, and we were able to raise from some great Silicon Valley funds. And then there was this inflection point of the business where it was such a low barrier to get customers. Our cost of acquisition was very low. Our payback periods were very quick. Our LTV was getting very high. And there was a fund coming up called the Vision Fund, and from a gentleman named Masayoshi-san in Tokyo. And Masa loves pets, and our founders were scrappy. We did the 100-hour weeks for years. Our employees were passionate. Everybody was on the same frequency and wavelength. So we were able to close SoftBank, and we took in a $300 million round from SoftBank from Masa, and we brought on a great board member that was also on the board of companies like Chegg, DoorDash, etc. And that was a huge inflection point of the business. We were now a business that went from a small little house to now this massive behemoth. So as I look back on my journey, there's a lot of lessons. But what was crazy is that you think that when you raised from Masa, you ride off into the sunset. And as a founder, it never stops. When you're born as a founder, you always want to become a founder and never stop. So we went through a lot of ups and downs after the SoftBank money because our business, our unit economics, and as investors, if you guys are investing in consumer-heavy marketplaces, please do diligence on unit economics. Our unit economics did not scale as they did previously. So we had a lot of turmoil in the business. And as a founder, we learned a lot through that whole experience. So after 5 years, I decided to do something else. I think that inside of me, I did what I had to do at that business, but there was something more. So that's when I met a gentleman named Herschel Mehta, my co-founder now, and partner of 100X.VC. And we met in Los Angeles, and he, when we sat down, he told me about Sanjay Mehta. And when I heard about the portfolio that Sanjay had as an angel, I knew that I had to meet this man. Something inside me said, you have to come and meet this man. And I was always intrigued with India. India, for me, before I came here, was a place where I've always wanted to go. The best engineers, the best founders. Everyone's from India. So I knew there was something special in the air. And after meeting Herschel, I got an email 2.5 years ago at like 5 a.m. in the morning, and he said, will you come to the 100X Demo Day 2019? And something inside of me, my intuition told me you have to get on the plane to Mumbai. And I was at a crossroads in my life because SoftBank and WAG and we weren't growing as what everyone thought. So I said, hey, I'll come to India. So I got on a plane, came to Mumbai, and when I came to Mumbai, the energy, the passion, it's just all stars aligned. And when I came to the first 100X Demo Day and I met these founders, I knew that these founders were special. I knew that they were put on this earth to be founders, and it was electric. And I needed to be a part of this journey. I needed to ask these founders if I could, invest in their businesses. But more on a macro level, the pain points that these founders are solving for people in India, it's too large to ignore and not be a part of. So kind of fast forward, Herschel and I decided to create a fund where we are a India-only fund. And now, and what we've seen is that we're seeing trends in the US. We've identified trends in the US that are now bleeding into India that are becoming massive businesses. And as a fund, we identify those trends very early on, and then we find those businesses in India. So our fund now is called 100X.VC. We're about a 30 portfolio company. We've been in business for about a year. This is Herschel and I's lives. We call it 2 a.m. because if we're up at 2 a.m. or the founders are up at 2 a.m., everybody's working at 2 a.m. and that's some of the most magical times of a startup. And in terms of the fund, we really see a massive opportunity for the Gen Z population in India. We're seeing founders now that can start businesses with not that much capital. We're just seeing founders move. It could not be a better time to invest in India as an angel or a fund. And as I kind of go through my journey from a founder to now investor, very similar things happen. And I think that in terms of for you guys to provide value that you can apply basically today is when you meet these founders, and they were talking about it earlier, is try to provide as much value as humanly possible to the founder. So when you go on LinkedIn or you meet founders and you want to get in these deals, like really ask yourself, can I provide value to this founder? And is your gut telling me that this is the founder that I want to back? And as investors, when you guys identify founders, one thing that really has helped me is, would you really use the product? I think a lot of investors invest off of signaling and whatnot, but if you have that gut feeling, like Anoop was talking about, really kind of ask yourself, would I use this product in this business, and is this the team to do it? Because at this stage, the data, it doesn't really matter. I mean, it matters, but it's really about the team. So you really want to get to know the team. Yeah, I have a couple minutes left. This was a short one. And now WAG is now going IPO on the Nasdaq. So very happy about that. And you know, from a little apartment in Palo Alto to IPO is just one step of the journey. I got this tattoo in Sanskrit recently, and it says every step of the journey is the journey. And that's how I live my life. And as a founder and investor, I think everyone should too. But I have 3 minutes left, and if you guys have any questions for me, I'm happy to answer. Happy to chat after. But I really appreciate the 100X team, including me. And thank you, Herschel, for sending that email to me 2 years ago. Beyond grateful to be here. And this is a very special time. So thank you so much. Anyone have any questions? If not,
What's the thought behind the name 2AVC? What's the thought behind the name 2AVC?
Yeah. So the name 2AVC, this is a common question I get probably asked like 4 times a week. As a founder, in my journey, the lawsuits, the times where you hit $1 million in revenue, the employees that are up with you when there's bugs, when you push a build and there's bugs, you have to get the engineers, on a call, they're up. The investors that are with you when you're like, hey, Masa wants to put in 300 million, what do I do? I have Tiger who wants to do 400 million. 2 a.m. is a very magical time for founders and investors. In my experience, that's when the real magic happens. And I'm getting chills right now because this startups are in my blood, and at 2 a.m. it's just a very special time. And it's funny because in India, a lot of the founders are up very late. I feel like no one sleeps, so we take a lot of calls at 2 a.m. So that's the significance behind the name. And it's funny, you'd think that getting a name for a company or fund is easy. It's probably one of the hardest early things to do. Good question. Up in the back? Oh no. Cool. Well, thank you so much, everybody. I really appreciate this opportunity, and thank you.
Thank you, Brendan. That was great. Keeping this very tone in mind, I will now call upon Vikas Chaudhary and Jules Sanghi for our next discussion revolving around the startup's founder's journey from 0 to 1 in the ecosystem and across stages. Vikas is a partner at Pivot Ventures and a president at Geo. He has expertise in creating value in the digital economy, having operated billion-dollar businesses and having invested in companies which are now up valued to billions. Juval is the CEO of LogiNext. He has also been featured in the Forbes 30 under 30 list. Juval has been an avid early-stage investor and also a close mentor to many of our portfolios. And sales now is.
Thank you for having me.
Thank you. Great. It's so good to see everyone after 2 years sitting in a room. Normally, without masks, this is my first, I must admit as well. I've been very conservative through these years. So great to see all of you. I hope you're having a great morning. It's a privilege and honor to talk to all of you. I know a lot of you are investors that are sitting here. The idea today is to share, I guess, a little bit of Juval's story from an entrepreneur's perspective. He's built an amazing company. I like Juval actually talk a little bit about the company and just begin with just what you built. I don't know too many people know about B2B company known as glamorous B2C company. And then we'll dive into the story a little bit more from the entrepreneur and sort of an investor.
First of all, thank you so much for having me. I think it's always a great honor to attend and speak at any of Sanjay's events, because I remember in 2015, Sanjay was the very first person when I had nothing in my hands except for a business plan, some sort of a vision, right? And everybody wants to bet on people and team and whatnot. But over the years, I've learned from him on what really is betting on people means. When there is very minimal information available in the very first 6 to 8 months when the founder is building something, without a clue on most of these business areas, and still taking a bet and leading that journey towards an exit, I think it just feels very good to address an audience that Sanjay has gathered. So really appreciate the opportunity to the 100X team. Because thank you so much for your time as well. For Logix, our story is 7 years long now. We started. So my background goes back to 2010. That was my first experience outside India. I was a young grad, 22 years old. Went to US for my master's, just like any other, many other engineers out of India. Did all this fancy education around machine learning, data sciences. Did not have a clue on what these things are. Got a job at Deloitte. Understood the nuances of B2B businesses, consulting, how do you really advise large customers, what do really these customers think, and what do they really want to achieve. So got that exposure from 2010 to 2014 in the US. At that time, Amazon was kind of making a lot of noise where they had posted their first profitable quarter. In US, retailers were kind of getting more aggressive on this e-commerce strategy. Walmart, Sears, Target, some of the large players were kind of thinking how to really start doing fulfillment, last mile delivery and whatnot. But nobody really had a clue on what this is, like how to really do better and accurate e-commerce deliveries. And that was the opportunity that we saw in 2015, moved back to India, built this platform for enterprise customers. The focus was to operate delivery and transportation businesses on a cloud platform. So very boring industry, very hands-on groundwork that goes behind it. As Vikas said, not very glamorous for us. Still, we are not very glamorous. And over time, the glamour reduces as the focus only becomes on customers and nothing else. Over the last 6 to 7 years, we managed to add close to 200 enterprise customers on the platform. We work with large brands like UPS, McDonald's, Walmart, Target, and KFC, Burger King, and many local brands as well in countries like UAE, Saudi, US. Majority of our revenue 96% of our revenue comes from outside India. So we are a pure play, global platform. Our customers are spread across more than 15 countries. And we process close to 10 million shipments every day on our platform for these companies. We are a SaaS player ultimately. We don't do any operations or deliveries as such. We only provide software on a subscription model. So yeah, I've been kind of grown from, and right now we have people in 4 countries in Malaysia, India, UAE, and US. So kind of grown from zero to today with many customers, many lessons learned as well, many ups and downs, a lot of things went wrong. So happy to share a lot of these stories. And currently, we're very proud to have some of the top backers like Tiger Global, Steadily Capital, a lot of our group companies, and so on. So very happy to have the support from a lot of angels over the journey as well, who have now exited the company. And I think the vision is to kind of now build towards an IPO over the next 2 years on Nasecom. So that's what we are currently executing on next. Happy to share any story which allows any of you to kind of learn from a founder's perspective what goes behind the scenes. And I'm sure all of you have portfolio companies and you interact with founders on a daily basis. Whatever I could ever be very happy.
Super. So let's, while we're talking about 0 to 1, where you've really taken the company over the last several years, let's first chronologically start with sort of 1 to 0, right? You give up a thriving career in the US and you came back to do this. So what was kept you awake at night on day one, right? What was the day one, month one? Tell us a little bit about that. What were the pains at that point in time?
I think the day one journey is more about trying to get to your first customer, because and I remember in 2015-16, when you were in this B2B space, enterprise space, enterprises do not want to buy anything which is MVP. And what MVP tells you is that build the MVP, go to market fast, and you constantly be in that confusion that when I take a small product to the customer, they don't really like it, and they ask me to build more. I don't have resources to build more. I don't have team to build more. and no matter how much I build, people still want more. Right? So I think that was the biggest thing that kept me awake at night in terms of how do I close my first large customer, right? Because then when you look at these large successful SaaS players, I remember in India in 2015-16, there was nothing, like nobody understood even SaaS. I remember our pitch was that we are B2B software company. We were not using this word SaaS because customers did not understand it, investors did not understand it, and calling ourselves SaaS would kind of put us into some niche category which nobody wants to touch or experiment with. So that was the second part, which was positioning, right? How do you really tell the world that this is truly a large opportunity, where all you have is kind of some sort of a belief and no concrete revenue or data points to really matter. I think this revenue, like first customer and first brand building, positioning in front of your right investors was the biggest challenge that industry faced in the first 1 year.
And how has that changed today? Right? You're now across continents, hundreds of enterprise customers. What is it that really you think are measures of critical success going forward from here?
I think the biggest thing is that beyond the point, it kind of creates a chain reaction. So I think the biggest learning over the last 5 years is that it is to feel this product market fit, right? Like most founders also want product market fit. Investors are evaluating product market fit, but what is this really product market fit? No, I think getting that taste and understanding of that this is called product market fit, and for us, I think that has been more how automated, how much business you can generate without having to do a lot of hard work. So I think at this point we reached the stage where we don't have to work hard every single day, because while we all like hustle and hard work, beyond the point nobody wants to do that. You want to ultimately build a business where it repeats itself. So I think we have kind of reached that critical stage now where there is enough number of customer concentration and product value created in enough number of countries across the world to kind of just proudly go and sell it wherever you want, however you want. And there's enough inbound demand being generated for the platform on our channels, which is not typical consumer channels that you would say press or media or anything like that. It's like very core customer focused channels where you go and pitch and position yourself. I think over the next few years, the focus is to kind of make it more repeatable. We still, sometimes miss a quarter, we sometimes miss a month, and we don't know what to do. We don't know how to not miss a quarter. And that's something we're trying to currently build on how do we repeatably bring revenue, repeatably expand our customers. If one quarter we hit 120% net retention rate, how do you hit that NRR every quarter? I think it's becoming more metric-based, more execution-based versus vision and team-based now. And that's what we are kind of institutionalizing in our culture as well. Because a lot of our early team members still believe in hustle, hard work, and we kind of tell them that, enough of hustle, hard work now. Let's just institutionalize this to take it to the 100 million revenue mark as soon as possible.
Super. So you talked about some of the metrics in terms of retention. I know B2B businesses are measured completely differently than the B2C businesses. B2C, a lot of people talk about now, engagement time, CAC, all of those sorts of things, right? Can you talk a little bit about what are the key metrics that you measure in B2B businesses, and which amongst them do you think are really important for both investors and founders to keep an eye on?
So I think that in B2B segment, a lot of metrics are same on both the sides, on B2C and B2B. But I think in B2B, one thing that we typically measure, and I've seen a lot of investors getting impressed by that, is how much of your revenue is truly recurring revenue. I think this, especially in India, we have seen this whole concept of MRR and ARR being very fuzzy. And most decks have run rate numbers versus recurring revenue rate, and that to contractually recurring revenue, where you have concrete customer contracts which locks them into this recurring revenue. I think, again, we all know about this ARR concept, but what that true ARR means, how to evaluate that, I think that's number one metric that we track. Second, I think we track as a SaaS business, which is already any B2B business is the gross margin. I'm not sure again in B2C how much gross margin are appreciated in day one, but we have been like about 88% gross margin from within day one, and that has institutionalized this whole culture of profitability. You can just never, if you have about 80% gross margin, it's just impossible to burn too much money. Even if you raise a lot of money, it's just not possible to spend so much money because there's not much you can do about sales and marketing beyond the time. That's number two. And the third one I think in B2B is the net retention rate, right? Which is basically difference between expansion revenue and churn. Not at the customer quantity level, but revenue level. So we kind of measure this retained dollar every quarter very, very strictly, which allows us to understand how happy our customers are and how much more money they are allowing to generate. So I think if you see all three are more financial metrics. And I've seen in B2C, I think more about user engagement, NPS, DAO, MAU, these kind of concepts are more prevalent. And delayed revenue is fine. I think in B2B, revenue retention, revenue growth, revenue repeatability, highly profitable revenue, locked in revenue, contractual revenue, these kind of numbers are more important, is what I think.
Super. So you've gone and built, of course, a formidable global product selling to enterprise customers across the world, and bulk of your revenues come from across outside of India, of course. How have you been able to really do that, right? Because when you started out, like you said, SaaS wasn't as sexy as it is today. Selling product out of India, building and then selling product out of India wasn't as easy. You were in a space which was theoretically quite competitive, right? E-commerce was already large and scaled, and you went in and built a product that you could sell. And then selling to enterprise, we know how hard it is, right? It should be that game 10 years ago. The lead times that it takes, and so forth. So can you share some anecdotes, stories from your journey of building this global product and global company?
Yeah, and I get this question asked a lot, on how did we really reach this 96% non-India revenue, right? I think, especially in India, it's appreciated a lot that we don't have India revenue because of obvious, issues around price sensitivity and whatnot. But I think the biggest learning I would say that I've learned is that, globally, customers are the same, right? And businesses are operated in the very same way. Enterprises are very large companies. It's very difficult to run a large company. A lot of time, there's a lot of bureaucracy that creeps in. A lot of operational inefficiencies creeps in, change management issues creeps in. So I think one thing I've learned over by selling into multiple geographies, including literally I would have traveled like 20 countries and pitched to first customer myself in all these 20 countries. I realized that people evaluate products in a very similar way. I think the usual myth that most people have across the industry is that Indonesia must be a different market, so US is a different market. Or Europe is different. Government is a different business too. They provide different DNA, different product. I don't think that's true. At least in our case, we have been able to build a playbook very early on, and that realization came on our own. That what everybody's telling us to, change the playbook for every region is just not true. And it's pretty fundamentally the same. So that kind of worked out for us. I think the biggest journey is that some of the anecdotes are about. When we got our first online sign up in US, we were hoping that we would kind of get some small company signing up online for us and trying to use us. Turned out it was UPS, which is the largest and currently our largest customer now. And this was in 2017. And they signed up online. They came on our website, put in this small request that we are interested in talking, taking a demo. So that kind of realize that, when you are nothing in the US, there are some people who are still getting to your website based on whatever SEO you have done, and they are expressing interest. And you do a remote demo, they like it. Next week you take a flight, go to their, participate in the RFP. They got like a shortcut entry into RFP because they loved the demo. You also get to see other, large competitors, Oracle, transportation management. They're like 7 people sales team is coming to present in the RFP, while you're a single founder carrying a bag, moving and trying to pitch. But all you have is that passion and that great product more than the passion, which you showcase to these customers, and these customers value a lot. And I remember they signed up in US with us with like $15,000 of ARR. Currently, they pay us $1.5 million in ARR, right? Over 3.5 years of journey. So, and this is all organically kept on happening without any contractual lock-in whatsoever. And 100X. It's kind of 100X expansion, right? This one customer a lot of times screws our entire expansion ratio across the company, and all the other inefficiencies get hidden. And then now we have like many other customers because it gives us confidence that like even largest of the company, a $75 billion revenue company out of US, who has no presence whatsoever in India, As nobody, like most people are not Indians who are taking decisions there. They still founders took our demo, gave us a shortcut entry into RFP, signed an India contract with us, wired money into India with $15,000, which they are very usually apprehensive about. And what is this Indian company will be, and asking for insurance clauses, unlimited liability only on your contract. So you learn all these things. And at the end of the day, it just gives a lot of confidence to the team that yes, we are able to do something large, and we are not a startup anymore. This can truly be a large enterprise. So I think that is an anecdote that I remember. There's a lot of other ones I can do for hours, but I hope this at least makes it more limited.
Absolutely. So you've obviously also built. A lot of people don't know that, I guess, a profitable company, which is unheard of, along with top tier investors, right? And they usually don't go hand in hand. So that's a very, very unique position that you've been able to accomplish. Can you talk to us a little bit about that, right? Both from a founder perspective, how did you actually achieve that? And from an investor perspective, how did they actually let you do that? From versus investing in growth in a good way.
No, absolutely, and I think this is a great question. And we've been profitable for last, we've been barely profitable for last 18 months. I think this is very much a function on your board. This is something I've seen. So our board early on was heavily focused about making sure we don't run out of money, because we had 2 crore in the bank. And we had that kind of, I was depleting year over year and month over month. So the constant advice we were getting was about how do you hit profitability. That was one. And at the same time, in 2016-17, the market theme was about profitability, because a lot of Indian startups had sunk. There were a lot of horror stories around companies which don't exist anymore, but tiny house, housing, great entrepreneurs, they're great friends, but there were a lot of burn stories around it. So all investors were more worried that my portfolio should not sink anymore. And what if they can't use the next round? So the advice we kept on getting was profitability is more valuable, keep doing it, revenue, all of it. And that creates a culture of high gross margin, low CAC, high LTV. And when you talk a lot about it, even your software developer starts talking about these things. If I want a new license of, let's say, Slack, I will think twice before, do I really need Slack to build a better source code? Probably not. Try to not spend that money. And that culture kind of gets institutionalized but it starts from the market and the board and then goes across the company. Over time it changes, so once we hit the profitability, we take a lot of pride about it, but in last 18 months, in every single quarterly meeting, the only feedback I get is, you're not burning enough. If you are growing 100% year on year, you should be spending more on growth, grow 200% year on year. And my question comes in, okay, now we already have a culture which is capital efficient, we have a model which is capital efficient. Now, even if I do 50 more events in a year, I'm not going to get 50x more growth out of that. So all my numbers will shake up, and I'm pretty sure in 2 years, those numbers will be questioned. So, it's kind of balancing act beyond the point. I think we have, again, to long story short, I think we have hit profitability based on certain advice we got and the market trends. In last 2 years, the market trend and the advice I got has completely changed. As of now, to be honest, I'm in the question on why I was even chasing profitability. This is a harsh reality. And probably we should have actually spent even more on it. Because there's a lot of capital available, we still have a lot of capital available in the bank, and the new capital which attracts, which kind of tries to and approaches us to be, to put in money into a company. But it's just that we don't have any, we don't have any business justification right now to use more, because we're still growing, and the growth is no longer a function of how much money we are in the bank, and that's what we currently have. But I think overall, I've seen that markets do go up and down, but growth is more valuable than profitability, something that I have not taken. And maybe this is anti-advice in this audience, but a counterintuitive thought. But that's where at least I am right now.
So I love to double click on that. Tell us a little bit more about your fundraising journey, how investors looked at you, how did you actually go out and get some of these top-tier investors? They're known for being very maverick in their approach, right? What can you share with us that can be interesting in that journey because of all of these sort of dynamics that we have? Right?
Absolutely. I think that also has been another eye-opening journey when we raise money from Tiger Global and right? I think these two are very unconventional investors. I would have like in our Series B last round, I would have pitched to like at least 50 investors. We had 3 offers, 2 from private equity, 1 from a VC. Both private equity were US ones. We did a 3-month diligence, went into extreme details and found every single corner loophole of our business. Financial compliance and governance issues and churn issues and revenue recording issues and what every single metric was just practically wrong, got off by 10-20%, and we were ripped apart. Great learning experience, but very frustrating also to an extent, very distracting for the founder and the management team because you spend so much time on fundraising. Tigers that you kind of are unconventional, I think, from 2 perspectives. One is that they are extremely fast, and second is that they are extremely founder friendly. And by these 2 things, I'm sure all of you must have heard of a lot. But when I saw it in 2020 for the first time myself, and what founder friendliness and what speed really means, it's mind-boggling. The quick, and maybe they work 24/7. I don't know what, how quickly they're able to digest some information. But they do diligence super fast. They are detailed. They already come super prepared because they have a team of analysts who are doing an amazing job. They already have made customer calls before you knew it. So based on market intelligence, they would make customer calls. They would heard about some customers. They would make sure that they know who their customers are they really sticky or not. And I think when they meet you, they are already in a decision-making mode. They are not starting to make a decision by learning from you. They have learned from somewhere else and making a decision after just meeting you. And that expedites this whole 3-month journey into a 3-week journey, or even less. And that was like just amazing experience for us. It saves so much time and really builds trust that these are the kind of investors who would really, who are the ones I want on my cap table. This is probably not good in very early stages because you will get carried away also. And that also happens, and I've seen that happening in seed stage when this culture comes into an angel round or seed round. It can be detrimental for the ecosystem, for the company, for the founders, for the investors. But at least for us, it happened in Series B. It was very amazing. And founder friendly meaning they would take our existing agreements that our lawyers would propose, or we would have, or one of the other syndicate round participants would have, like let's say there were 3 other investors. They also had their SHAs. They would come, take the SHA and strip off every single thing which is not founder friendly. Their lawyers would come, the general counsel would come on call and educate the CEO that, you know what, you are agreeing to a bad clause of this 8% dividend. It's going to hurt you at some point when things go south. So you should take it off. And it is very, very counterintuitive that my largest investor with so much of capital power, and they clearly have influence on our company because we would love to work with them or love to take their money. They are coming and taking away things which are their benefit. And that, again, builds amazing confidence, gives you the power to again fight larger battles in future when you at least understand what is good for the company in long term. Because most founders, they end up taking money when the round is happening, when the offer is on the table, the term starts to look small, and you end up accepting whatever the investors are asking. You just want to get to that closing event, get the money in the bank and execute it again. So I think these are the kind of 2, founder friendliness, and a lot of examples. Some I can share, some I can't. And the second one is speed. I think I've seen that over 18 months, landscape globally has changed where this has affected a lot of other VCs, private equity funds and individual investors also, where they are trying to move very fast. And I think it's an irreversible change that is happening in the ecosystem where it's difficult for investors, but I think that's the reality now. Good for founders. But I think I've seen everybody moving very quickly now. And I think now when I talk to investors, their first pitch is that we move very fast. So which is never usually a pitch that investors will talk about value. Now they're talking about how quickly they can move to fund you, provided everything is fine.
Yeah, I'm glad you brought that up because when we are now as a family office that I run and make investments in, I feel like I'm pitching to every founder that I want to invest in. So it's a bit crazy.
I think that's also changed in the market, which is not related to these kind of fast movers in the industry. But I think India especially has attracted a lot of capital in comparison to the good number of good companies that are there. And that's why this pitch has kind of completely reversed the effect where it's good founders are not pitching anymore. They are showing their business metrics. They are showing like the real business stuff versus the fat pitching. And investors are really trying to create value. They're trying to build true relationship and not just for the namesake. They are really Like we are kind of talking to two VCs which are just helping us build the next CRO to showcase that we can actually help you get a CRO, because that's our next milestone. And all investors who come and say that we'll help you do the CRO, there are two investors who are actually helping us hire the CRO without having any fundraise plan whatsoever. Just to prove that we are the right partners for it. So whenever you are ready, please talk to us. So I think that's kind of true.
That's an extremely healthy change in the environment in that sense. Right? And I think founder friendliness is going to be completely key to the industry, essentially just following a tailwind and creating larger, better companies, right? Because it's sort of just co-creating a company and investing together. It's almost like bringing up a baby together.
And that's so much good for them, right? Because it takes a lot of time, obviously, and you need to have like a pre-funding operating team also now, let's say. It gives you so much information about the company that when they're raising, you just know whether it's a yes or no, and then you can truly move fast. Without just having to move fast.
Let's talk a little bit about the last 2 years, right? I think the world has changed, the economy has changed, digitization has changed. What has it made for you?
So for our business, it's my pandemic is a very unfortunate event for the world. I think one thing that it made an irreversible change around this faster, cheaper, and better deliveries. Everybody wants everything delivered at home on their business. Everybody wants it super fast. And this fast concept is changing to an extent where now groceries are being delivered in 10 minutes. I don't know what else will start getting delivered in the next 30 minutes and whatnot. And better. So it's not about only speed and free deliveries, but people want the experience. They want time windows, they want rescheduling abilities. They don't want to talk to driver anymore. Like one of the email I got recently from Amazon is no talk or something like that, no talk deliveries. So that is a feature we are promoting, that our driver will never call and will directly come to where you want it. So experience is another new element being discussed or being implemented. So I think in our industry there's a huge tailwind which has made these irreversible changes where people would just keep wanting things fast at their doorstep. It's never going to reverse, never going to end. And that naturally creates a need for tech platforms, because such kind of a delivery model you cannot manage via human management or interaction. You need to have a software taking decisions, and that naturally creates an inbound demand for platforms like us. So I think for us in the last 2 years, this is the biggest change we have seen. And then the second is from a talent attraction perspective, which is extremely difficult. Attracting talent is, and this is a super cliche topic if you go to any founder talks, or I'm sure if you're talking to portfolio companies, it's extremely difficult to hire people right now, or retain people. People want to keep changing jobs, people want to keep asking for more money, and there's heavy distraction, and people are becoming smarter and smarter. So talent is becoming super smart. They want more ESOP. They want investable ESOP frameworks also, where your ESOPs are not just capped, but there's encumbrances on that, which automatically makes them more money on their ESOP without having exercise with. It's just like way too many concepts going on right now, which is difficult to understand and attract people on. I think that's the difficult part of our business, where in 2 years it's super difficult to attract and retain the best of that.
Super. Both those topics we talked about, right, I think are very, very key to changes in the ecosystem at this point in time, right, in terms of speed and communication, like we were talking about, is really defining, I think, the ethos of most businesses being built going forward, right? It's no longer sort of, as you call, a feature, right? It's almost become like a function, like it becomes a table stakes in businesses in terms of what you need to do. And it's very interesting to see that the war for talent in a good way, for whatever it's worth, right? That the ecosystem is now sort of coming of age, paying its dues, it's going to create significant value. In fact, very recently we looked at something where there's an estimate that you're going to see 10,000 millionaires coming out of the startup, $millionaires coming out of the startup ecosystem in India only because of ESOP. Right? And which is just going to be insane for our country over the years, right? And how that is going to change the landscape 10 years from today, are in ways that are just almost unimaginable, right? In that sense.
And I think that's so true, and we see that across many other. There's so many ESOP buyback announcements happening. I think it just makes me as an Indian, that makes all of us so proud that India is finally going to have that missing piece of the puzzle, which is wealth for young people. And that can have amazing consequences on the ecosystem and amazing results for the ecosystem and an amazing future for our nation. So I'm very excited about building from India for the world, and I think we're going to see more and more such companies which all of you will be able to invest and make more and more. So yeah, best wishes.
Super. So on that great note, shall we throw it open to the audience for questions? Anybody has questions, please put up your hand. We can circulate a mic. I don't think they've either understood the business well enough or understood that well that they don't need to understand anything more. Let me ask you one last question in that sense, which is, there is so much, this is 30,000 feet, right? There's so much talk about tech has become so big, COVID has obviously put that in the spotlight. A lot of capital, a lot of new startups, a lot of growth, and then of course, come Jan, the entire tech market valuations, all of that sort of crash. SaaS at one point used to be 10x revenues, went to 30x revenues. Now they're saying we don't know where they're settling in, right? So has the recent event in the last couple of months changed anything in the ecosystem? And how do you see the future? Is the future in the short term, let's say over the next year or so, is that going to be difficult, or do you see it bouncing back very quickly?
So in my opinion, I think this whole 30x, 40x, or even when Snowflake kind of told it, 80x next 12-month revenue, which is just insane, right? On a public stock exchange, this is crazy. I don't think that was just. I think it was an extreme hype around how big the tech can become. So I feel this was the normal. This is the normal. Even the multiples have still not come to how it was earlier. And I think this is the right kind of level to play at. I would not say it will further go south. Again, I'm not the financial expert here. I'm sure all of you. But my gut tells me that it was 10x for a reason. It is going to be 10x for a reason. I don't think this kind of a hype will come again in the next 5 years. And I think, I don't think it should be there because that does have consequences around multiple other areas. But yeah, I don't think this 30, 40x or plus was ever sustainable, was ever logical also. Maybe it was more about like the whole tech frenzy retail audience, or maybe a lot of hedge funds who were longing on it. And it all got accumulated in one single year and just spiked. But yeah, I don't think it's going to get worse because fundamentally, especially SaaS businesses is something I can understand really well. Are here to stay. It's a very obvious thing to do. Cloud, everybody is moving to cloud. Why to build a product from the scratch when you can buy and license a product? Much more easier to experiment with, cheaper, amortized. There are like all the reasons are completely in favor of a SaaS business. B2B businesses always have been, revenue efficient, capital efficient, and they keep growing. And we'll keep seeing a similar multiple range over the next years to come. I don't think it's going to crash further than that. So I'm personally buying a lot of stocks in a lot of SaaS companies right now. So that's what my opinion is.
Super. On that great optimistic note, thank you so much for candidly sharing all your thoughts and your journeys and anecdotes. Sorry, I think we have one question. Sure, go ahead.
Thank you. Thank you for making me not feel under this.
I don't have the skills or the knowledge to be of value to you. So how do I make myself valuable and I'm available to invest?
That's a great question. I'm so happy that the investors are asking this question. So I'm very happy to hear that. I think in early days, especially if you're investing as an angel investor, I'm assuming you'll be investing into early stage founders. I think they need a sounding board. So if you can really truly brainstorm with them on a regular basis, and actively take inputs from them in terms of what is it that they are not able to understand or find out with their network or their limited bandwidth. If you really work like a partner or a team member, I think for that stage of companies, that's the most important thing. I've seen that a lot of investors commit that we will do and will truly become a partner, but nobody has really time to do it. And which is also logical, right? It's not investors' business to run your business in this company. But that's the unconventional time we are in, where founders do appreciate this brainstorming that they could do. They don't know what the ideal LTV to CAC should be. If you can go and talk to 10 companies and find out what the real LTV to CAC should be and what the market reality is, that opens their eyes. Because when they Google, they find LTV to CAC should be 1:9, which they can never get to. And they keep optimizing it for 5 years and realize, oh, that was the wrong thing to chase. Right? Maybe a lot of investors, I remember we used to pitch in Series A, used to call us, oh, 15% churn, really bad. Enterprise 15% is really good. We are out. And then we kept on optimizing it, and we could never go below 15%. And we still became successful. And we still have 15%, and we're very proud of it. The game was that we should have more expansion and not high churn. Nobody told us that. So if you could really find this insight that every company has 15%, don't worry, and build on expansion instead, that's an insight. Takes months and years of execution for founders to really. Now, I don't know how much time it takes, a function of your time. But I think your time is the most valuable thing for early stage founders. And you have your network and access, which they don't have. They don't have time to build their network and access. So if you could bring that with me, I hope that.
All right, great. Thanks so much, Joel. It was a great session and love spending the time. Hopefully everybody enjoyed it here as well. Thank you for being a patient audience.
Thank you. Thank you.
Thank you, Vikas and Dhruv. So while we're just setting up, throw some light in 100X figures. So now across the 2 years, 100X companies have raised up to 412 crores across 70 companies. That's roughly $55 million today. And 24% of these investments have been via ISAFs. I think Avnesh pretty well explained that in the start. And for now, to the next session. Peter Thiel, the globally renowned VC, has some interesting insights in the VC industry and has observed that most of the VCs spend 80% of their time on the users. His simple advice is to spend more time on small but big winners. Early stage investing is an asymmetric bet, and in the power law world, the only thing that matters is the presence of a home run in your portfolio. To further discuss this very dynamic nature of venture capital, I welcome a panel for mastering the VC game, decoding the power of law. We have Apurva Sharma. She is a partner at Stride Ventures and previously was with Xander Finance. She has had a successful stint as an investment banker with HSBC. We have Nikhil Gola. He is the founder and CEO of Sixth Sense. He is an award-winning analyst and was voted as Asia's best analyst by Wall Street Journal. With 28 years of experience in the consumer domain, he was one of the pioneer investors in many successful startups, including Paytm, Go, and Infred. We have Vineet Rai. He is the founder and chairman of the Avishkar Group and serves as a commissioner at the Business Commission of Sustainable Development. He is also a senior advisor to other global economic and sustainability organizations. And the panel discussion will be moderated by none other than Shashank Kande, founder and VC at 100X. I welcome all the panelists and Shashank Kande.
Hi, am I audible? Okay. Great. Thank you all for taking out the time today. It's so nice and exciting to see everybody in the hall. I welcome my fellow panelists. I am super excited. I've been looking forward to this discussion. And I've followed them for many, many years. It's an absolute pleasure being here on a panel discussion with them and moderating the same. Today's topic is mastering the VC game, and we'll be touching about the power law. And my question to the fellow panelists, would be around 4 or 5, and I'll begin with the general statement which is being floating in the market, which is adventure capitalists is what the world calls VCs, because we are trying to aim for an outlier hit more often than not, right? And that's the objective of the whole business. But why do we do that? Is what we're trying to understand. And what is the power law, and how does it work? So let's begin with Apurva, and then
Actually, I think Vineet and Nikhil should start first, because I'm a little bit of misfit here. I'm in venture debt, and which is a very different dynamics. And I'm hoping in this session I'll add some more flavor, different angle of discussion to how venture debt guys look at the ecosystem, which is slightly different from how venture capital investors look at. I'm very pleased to be on this panel with Nikhil, Vineet, and Shashank. So you guys start, and then I'll put in my perspective.
So, firstly, lovely to be here. So just the power law bit, just to give a broad sense of it, it's about saying that there should be some outlier returns which a fund should return. Some small investment should give you outlier returns. I think it's a completely bogus way of running a venture fund. I understand globally it's a very set norm and so on, but the fact is that funds, be it at whichever stage it is, could be early stage, could be at where 100X puts in money, or could be at venture stage where 6X comes in, or could be an Everstone which puts in at an extremely late stage. The idea is that you are investing capital behind what you believe will be extremely successful businesses. You're not hoping to keep spraying. And India is at a stage where by default you will get outliers. It is frankly not the journey of an investor or a venture capitalist. It's got nothing to do with the venture capitalist. So if, for example, I'm doing my own, I've made some money in Paytm, and some disproportionate capital in it. Would that give me more joy, or would it give me more joy if the breadth of my portfolio did very well? I think it always is the breadth of the portfolio which does well, which is more pertinent rather than getting a couple of investments which will do well, which has got nothing to do with it. So finally, the power law, while it will happen by default, because anything which survives, which grows by default in India, will also become outlier in some of them. So it will happen by default. But I think the true test of any investor, and this is what if you are investors in any funds or anything, I think you should look at the breadth of the portfolio being better, rather than looking at the returns which maybe a couple of stocks give out of maybe 50 that you do. I think that would be you could do that yourself. You don't require a fund to do it for you.
Lisa, we spoke briefly yesterday, and we had some interesting inputs, and I totally agree with that as well. But we'd love to hear your thoughts.
I think first thank you for inviting me here. I'm normally not invited in conventional VC guys. So anyway, I think the power law is very simple. VCs like us are actually Begani Shadi Mein Abdullah Diwan. But it is not our money, and it's not our vision either. So we take somebody else's money and give it to somebody else, and dance on both sides to the tune. So the power law is, when you look at the intellectual hierarchy, the promoters are at the top, the GPs are at the center, and the LPs are at the bottom. When you look at the power hierarchy, the LPs are at the top, we are again in the center, and the promoters sometimes are at the bottom, sometimes at the top. So our position remains where we are. And since we don't do anything, irrespective of that, we really are not part of the power law. And because we are not part of the power law, the way we have to play out is we have to make sure that we tell a story. And that's the only thing that we have, the credibility that we carry. And that credibility cannot be built by saying, listen, you give me your money, I'll gamble. You give me your money, I'll give you 10 hairs, hopefully one will succeed. That argument, therefore, is very flawed. And anybody who made that argument probably doesn't understand investing, because you cannot build it up, and that's where we are aggressively agreeing, coming from a very different perspective. And within that, again, so the thought process about investing is very different. So if you are probably trying to do a discovery of technology, a new discovery, new technology, or you're trying to change human behavior, then the investing styles are very different. It will be speed, because it's impossible to predict where the success lies. It's also about significant capital allocation. So when you hear SoftBank, Tiger, and others coming and putting in, because in tech, especially if you are trying to use technology, dominance becomes a very, very important underlying state. So when you put in capital, when the success should come, it should come really big. And therefore, the investing is very different from the classical cash flow investing mindset that a lot of us have carried for a very long period of time. And therefore, it looks as if they are actually gambling, they are taking big and high risk. But it looks very different, but there is a logic and thought process behind those kinds of investing. The other way of investing, some of us do it all the time, is trying to make sure that there is a unit economics. A lot of people earlier used to believe that you should be profitable, but I think given the size and scale of India's market, almost everybody agrees that pace of growth, while scale India always gives, but pace of growth probably takes precedence over the bottom line. But not having a bottom line does not mean that you shouldn't understand unit economics. So once you have understood unit economics, then pace of scale actually dominates, and that's how you do investing. Now, things may go wrong, or some people will do that better than others, and that's why you actually have a portfolio where 20% probably will give you 90%, 100%, sometimes 300% of the fund. And the others may succeed, but not give you the same percentage or proportion of the thing. So that's why sometimes this power law comes in, but it actually is impossible for any of us to go and stand up in front of an LP and say, let me have your money and I'll gamble and have fun. So that's not possible.
Great, thanks for that insight. But I'd like to get your view from that perspective, and you've seen a bunch of transactions at your end. What are your thoughts on this?
Yeah, so pretty much the same. And for venture debt, it's all the more important that instead of essentially in statistics, any probability curves, how frequently a particular outcome will come in an experiment. So if I understand the Pareto rule, the power law, that 20% of your companies are going to give you moonshot returns and is expected to compensate for the loss or underperformance of your other portfolio companies. But I'd like to view venture debt as a normal curve, a bell curve, narrow bell curve, where all your portfolio companies should hit that ballpark of returns. And there will be some fringe cases which will give you exceptional returns, and those would be from the equity option positions that we hold in our portfolio companies through venture debt. But it's very important that we get that ballpark return for all our companies, because that's what the LPs have entrusted the money for. And we've spoken to so many private pitching, for fundraise to either family offices or corporate treasuries or HNIs, institutional investors. The way they look at venture debt is a variation to their fixed income allocation. So there are not a lot of MLD opportunities. Everything is sub 10%. So they are looking at recurring, predictable, say 13-14% per annum kind of return. And that's what we're working for. The additional 4, 5, 7, 10, whatever percentage we develop from the equity options that we hold is a bonus. And as both Nikhil and Vineet said, if you keep doing your diligence, the kind of companies you like backing, some sanity in the valuation business, then most likely than not, you will end up with a couple of moonshot companies which will really give you great returns.
With that, I'd like to get all your views in terms of helping us understand and the audience a journey for one of your portfolio companies, other from investment to, let's say, having a mega exit. Your experience in riding that entire way, that it was span of 10 years, 5 years, but love to get your thoughts.
We've now been in venture business for now 8 years. We've done around 45 investments, 47 now, investments across the 3 funds that we operate. 45 of them are doing good so far. So much for the power of us. But I think
obviously, like in every business, right? And India is at the stage where you will get outlier returns in few of them. I think it's important that whenever you're investing that capital behind the belief of success of that business. Each and every business is being invested for the success of that business. And there has to be obviously, even as a venture fund, there's obviously an optical illusion about what that business will be for you. So just as a case study which you asked for, let's say we invest in a company called Hindustan Foods, which is a listed company now. It's now become India's largest consumer contracting company. We invested 5 years back. The business revenues was 30 crores. Today, this year, there'll be 2,000 crores plus. And this is in manufacturing. The business has moved up by 50 times in 5 years in manufacturing. We had an optical thought about what that business will be. I'm sure Samir, who's the founder, also did not have that vision at that point in time. Obviously, it kept building up, and you also got reinforced with that vision as you move forward. The belief was that in consumers, for the first time, there will be huge disruptions will happen in India. And for almost 5 decades, we've seen nothing happen. The same players who were there 50 years back, 40 years back, continue to remain relevant and dominant today. And that was not because the brands were so super powerful. It was the distribution chose a bigger mode, and that created the brands. And my belief was that distribution will get dismantled in India over a period of time. You will see regional, third-party, e-com, digital evolve, and thereby you'll see a flux of neo brands evolve, and thereby compete with mainstream legacy companies and so on. And once there are challengers who compete with incumbents, by default, the incumbents will want to focus on brands because that's a 60-70% ROI business for them. And they will let go of manufacturing, which is a 15-16% ROI business. And when you let go of manufacturing, irony is that in India, there are not more than 5 good consumer contracting companies which can take MNC manufacturing standards. Yeah? So anyone who's large will become a billion-dollar company over a period of time. So that was the optics that we had. And in 5 years, it's showing in a company like Hindustan Foods. Contracting has become mainstream. So you see that happening across the board. The Dixons of the world happened, let's say, 2-3 years back. So you need to have that belief to go through. You might fail. Maybe your belief might get tested a lot more. Maybe you might be early in the journey also. So sometimes it's also important not to be too early in the journey, specifically for a venture fund. It's okay for an investor to be early. They have enough capital to keep pumping in more. Not good enough for a venture fund, right? So sometimes the first guy through the door also gets shot. So you have to be just hopefully at the right point, because your capital has to do the trick. And you can't hope for that, our capital getting replaced by an investor coming back later. We can't hope for that, right? You want to build it up on the capital that you're funding. And it's happened in businesses like that. And I'm being examples for the same. So I think it's more about the belief of how you see a particular business evolve and translating that belief also to the founders. And I'm hoping that is backed by some intuition which is getting proven at every point in time. So I think as long as that happens, like I said, in India, you will get outlier returns.
We have been around for a little too long. So I started in 2001, been around for 21 odd years. So I've seen every downturn. Not upturn, I've seen every possible downturn there. Let me start by telling you that I shouldn't be here. I'm actually a forester by training, so I shouldn't actually be doing investing. I used to hang on trees in Odisha and then actually ended up in Bombay, largely because my wife didn't find Odisha as exciting, or the forest I was doing, like I said. I became an investor by default with 5,000 rupees of personal capital in 2001. And if anybody was around in 2001 will remember that there was not much to do in 2001. It was impossible to find an entrepreneur. So my own journey has actually been a journey. So I've gone from 5,000 rupees to roughly 27 million in 2010 and 1.2 billion now in 2020. So our own journey has been there, and if I had to actually talk about companies, I would rather actually talk about sectors that we have pioneered. So when I started investing in 2001, I was looking at rural India and saying, there's so many people in rural India. If you actually unleash entrepreneurial energy of the people there, you may create a lot of jobs and therefore probably create a lot of money. Coming from a point of view of how to change lives while building businesses. And microfinance, the whole India's microfinance, 100 crores. Entire India's balance sheet put together is 100 crores. So I started investing very small amounts in microfinance, not one, not two. I invested in 8 companies, SKS, Share, Basics, Equitas. And I was the first investor. The entrepreneur used to be largely coming with a paper and saying, I'm going to start microfinance. And we used to do everything. I used to give them equity, then I would give them loan, then I would give them how to hire people, etc., etc. Out of the 8-9 investments we did, and just to give you an idea, 100 crore has now become 3.5 lakh crore. So just to give you an idea of what kind of context. Of course, we made a lot of money, we lost a lot of money as well, because microfinance is this unique way of making a lot of money and then going down and then coming back to the bank as well. So we saw the journey of 100 crore to 3.5 lakh crores in microfinance. Then I was the first investor in agriculture. Now, when I started investing in agriculture, almost everybody said this is the most stupid thing you will do. There is no way you can make money in agriculture. Unfortunately, I went into agriculture in 2007, a little ahead of time. In last 3 years, 4 years, you might have heard the term egg-tech probably 500 times. Interestingly, we are again across the board in agriculture in multiple companies. Agritech has not shown any unicorn. While I personally believe not on unicorns the way the world believes, I think a unicorn is a great unicorn in case you can actually impact 1 billion people. But anyways, since $1 billion valuation is equally important. But my guess is, and I wrote it in 2020 for Economic Times, that over the next 10 years, you would see at least a dozen unicorns coming from agritech sector. Not simply because tech and agriculture are actually designed for each other. Simply that all the challenges that agriculture have would actually be obliterated. We are in Ergos, we are in Agrostar, INI Farms, many companies. Some of these companies are potential first unicorn coming out of agritech as well. We are also one of the first ones in waste recycling. Nepra, the company that we went in with a very small amount of check in 7-8 years back, is roughly managing around 1,000 tons a day. When we invested in, they were doing few hundred kgs per day. Now they are doing roughly 1,000 tons per day, which again is a very quick and fast growth journey. So, some idea.
So for us, obviously, there are two forms of exit. The exit is obviously that we should get the principal back. That's the most important exit metric for us. And of course, you exit the equity options that you have. So I'll talk about the principal protection and then probably the equity upside. So obviously, we've seen a lot of successful exits as in companies who have paid us the principal back. But what I'd like to share of some of the companies which we backed when it was not very plausible to back. So when COVID started, a lot of companies started asking for debt because they had certain milestones that they wanted to raise primary capital at certain valuations. And then that becomes a very important instrument between two equity rounds rather than just coming on top of an equity round. That's when really debt helps you for a couple of reasons. Either it could be financing your working capital investment for which you should not dilute your equity, or it could be a capex or a warehouse or some purchase orders for a B2B company or a B2B SaaS company, or part of acquisition financing, or simple runway extension. You take some bit of debt when you don't have a lot of cash sitting on your balance sheet. But then how do you take those decisions? Because venture debt traditionally has just been topping up an equity raise when you're absolutely not taking, you're basically expecting to be paid from the equity capital that the company has just raised.
It is mostly post-CDG.
Yeah, so mostly slightly companies where the proof of concept is there is revenue monetization that is started, not pre-revenue companies. So Series A and beyond. So we took a lot of bets at that point in time, and all of our bets were in between equity rounds when the company did not have 18 months, 24 months of cash. They were much meager runways. But the reason and those are probably our best investments till date, because those are the companies where we entered at the most lucrative valuations. Those are the companies we, truly believed in, because irrespective of them being loss-making, they were fundamentally real businesses. And we took those calls because we believed in the founders, believed in the business, and any good business will have downhills, uphills, but they'll survive, they'll overcome. And you have to have that faith that अच्छा business है, grow कर रहा है, तो कर लेगा. It just cannot be that this VC has died, this much capital is sitting on the balance sheet, so you can't. So we took a lot of calls in 2020. Actually, we did the most number of deals in 2020. We were the most active venture debt player in 2020. And it has panned out so well for us. We got obviously our principal back, and we made some massive capital returns because the valuation at which we entered was very good. And So obviously that's one learning that, irrespective of other things, if fundamentally the unit economics, the business makes sense. Now unit economics, I know all of these are negative EBITDA companies, but at least not negative gross margin, not negative CM1. They are currently expending, for technology or customer acquisition, and all of that is fine. But धंधा बना रहे हैं basically. And we did a lot of, and on the warrant upside thing, yeah, we made very good notional capital gains because typically in venture debt space, we hold on to the warrants for at least 2 years for tax efficiency reasons. So we made massive capital gains on a lot of our deals, and I'd not like to differentiate, but some of them being, Infra, Mensa, Sugar Cosmetics, Home Lane, Cred Avenue. We made very good capital gains, and hopefully we will exit at better multiples on the warrant side.
So, Vineet, the VC ecosystem and the private equity ecosystem has, in my recollection, started somewhere in 2008, 2009. In its truest sense, I remember when I was early member of a SaaS platform selling database, selling research to private equity funds. I had a list of not more than 15 to go after in Bombay, Bangalore. That has fundamentally changed in 2022. There are not many VCs doing Series A, Series B, different formats, venture debt coming in, becoming very popular. We saw one venture debt fund in 2010 or 11. And now a bunch of senior private equity folks starting their own funds and going after very early stage opportunities. So we've got enough capital in the Indian ecosystem. And a lot of newer funds, are starting out with the thesis that yes, it boils down to how many home runs do we have? Or does it need to be a game of averages? Obviously, it's home runs for many of the VCs, right? And some of them are sector agnostic, some of them are sector specific. What are your thoughts to these new funds or seasoned investors, but for the year 2022, post-COVID, in terms of going after home runs, or should they be working on game of averages? Should they be happy with 5x returns or 100x outcomes? Or is it just about how focused we are in terms of sector? And it's a very broad, but I want to spice things up. And I know I have different views, so let's go on. Let's begin with you.
Sure. So again, Shashank, for us, obviously, all of our companies should hit that target. We cannot mess up even one thing. Because for us, it's not like we are getting overcompensated by the moonshot returns that are getting generated in all our other portfolio companies. And interestingly, venture debt as an asset class has shown that kind of resilience. This asset class has been in existence for over 25 years now. It started with Silicon Valley Bank in the West. And in India, it has seen a lot of acceptance from the VC community, from the founder community, from the LP community over the last 4 or 5 years, because of which now there are 4 major venture debt players in the country, and everybody is growing their fund sizes, investing in more companies, etc. Right? The asset class has seen a loss ratio of sub 2% in the last 25 years. That's a very, very, I would say, credible number for an asset class which funds loss-making companies, because that's a number which not NBFCs have shown with mid-market exposures, not banks have shown with large corporate exposures. And there are multiple reasons why the asset quality has been so robust. One of them being that, these are companies where there's no siphoning of money, there's no integrity question. These are very under-leveraged companies, so total debt is capped at, say, sub 10% of the valuation. Enough valuation buffer, skin in the game. And if you keep yourself under-leveraged, use it for the right cases, back, solid companies which have some same unit economics, some proof of concept, monetization, you can do a good job. So I think for us, definitely it is, as I said, the ballpark range that we have to hit for every deal and try not to mess up in any deal, because we just cannot afford that. And fortunately, the asset class globally in India historically has been able to demonstrate that. With respect to our fund also, Stride, so we are in our second fund journey, closing the second fund very soon. And we have invested in about 60 portfolio companies. And from both funds, we have not seen a single day of delay on interest or principal servicing in any company. Since inception, having restructured any portfolio, having extended moratoriums in either of them. So I think for us, all our companies have to hit that ballpark, and we expect to keep doing a good job.
Around
15 years back when I was an analyst at SSKI. And this is true for all analysts in India at that point in time. If you crack Capital, which was a big account, US fund, you will crack it. As an analyst, if I crack that account, I can be rest assured that I'll get a 1 crore of bonus at that point in time. And I can guarantee this. No longer relevant. So just as we talk about crowding of private equity, venture funds and so on, capital is no longer relevant in India. They are relevant, but there are possibly 100 other capitalists around. So I think anything which looks attractive, by default will have not many players from it. This is true in businesses, this is true in venture funds also. If venture funds do very well, by default there will be many players who will try to give it a shot. To say that, how the year should be, just one point which I think is interesting, and I've always believed that the returns of a public market player, public market fund, the difference between the best player and the worst performer is not more than 5 percentage points at any point in time. You can look at any PMS, any mutual funds. I think mota the difference will be 5 percentage points because they are all playing in that 200, 300 substocks that is there listed in India. The difference between a private equity or a venture fund investment can be a variance of 100%. From someone who's being a big outlier to someone who's delivered nothing. And that's the big opportunity that we're looking at. And that's the reason why investors possibly, as you get slightly more mature in your own capital allocation, you'll start to look at alternate as one more interesting product to look at. Because the difference is that as a fund, what possibly I'm investing in and what Vineet is investing is a subset of one for him and subset of one for me. So my outcome is only my outcome and it's got nothing to do with me. So I think that's a big difference between alternate vis-a-vis public market. So to time it, I think public market are more prone to time it every point in time. For private, frankly, not really too sure whether that's a great outcome. I think by default, all that we need to ensure is that, and I think that's what we think of, that are all our investments being done irrespective of market conditions. So let's say for the last couple of weeks, obviously markets have been at a different level altogether. Would I still be invested in all the investments that we've done in the fund so far? If the answer is yes, I think we're doing a decent job. If our investment is based on certain trends that we are seeing today in the market, then I think as a venture fund, we're possibly not doing a good job. So to me, the outcomes will be non-linear. For a venture fund, that is really the outcome that will hopefully happen. But it's really based on how businesses, founders deliver over a 3-5 year cycle period. And that to me takes into account the troughs and the peaks of the market. So
venture capital is a very humbling business. If you are an entrepreneur, you're running a business. If you're 5-year-old, you will actually, and you're doing well, you're actually going to go up. In venture capital, you raise a fund, 5 years down the line, your revenue or your salary is going to go up. Your fee is going to go down. It's a very difficult business because you are pretty much a startup every 4 years. Funnily, it's almost impossible to deliver results within 4 years in a venture fund. So you have gone to the market first time, Begani Shadi mein Abdullah Diwana trying to selling a story and trying to give somebody else's vision. But again, when you go next time, you are 4-year-old, you're roughly 4 years in. You know 5th year your revenues are going to fall dramatically, you will be struggling to retain your manpower. And you are again selling to people to give you money without actually delivering any results. It's a very difficult business to survive long term.
It's actually not true. I think venture capitalist is the most cushioned job in India.
If you're looking at the job.
No, the fact is that for venture capitalists, if you do a bad performance, right, in any business, right, if you make a bad product, you get penalized. And rightly so, that's the way it should be. Venture capital is the only business in the world where venture capitalists like us don't get penalized for bad performance. And that has to change. So if you do a bad job, by default, we should be out of job.
Yeah, but I think you will be out of job because the only thing that will happen is that you don't want to return the fee, but you will not get a next fund. And I can guarantee you, if you have done a bad fund, you will not. Fund business is very hardcore in that sense. So you're secure for 5 years, no doubt, but you won't be there for 6 years. And I'm telling you, if you want to do single fund, secure. But if you want to build a fund house, we are on our 8th fund, and I can tell you it's very, very difficult to convince in the 7th, 8th, 10th, 12th year that you are actually a good investor. So, and again, what is a good investor? What money? The DPI is actually the only trend. So what is your valuation in paper has absolutely no worth. I mean, you can do it for once, but ultimately if you don't return the money to your investors, you're worthless very soon, even if your company is doing well. And that actually hits home only after 8th, 9th, 10th and 11th year. So, and the loss of credibility, the loss of face is very high. So it may appear on the face of it that you are actually not being penalized. The penalties come very hard and fast, and they are very difficult as well. So, money is commoditized, it's available to everybody. India is going through that renaissance in terms of, so 10 years back, money was very difficult for an entrepreneur to get. Today, if you actually offer $100,000, $200,000, $500,000, 90% of the entrepreneur will not talk to a venture capitalist. So if you are not able to show them ability to bring 5, 7, or 8 million, not able to participate in 2-3 rounds, it's incredibly difficult to convince an entrepreneur to take money from you. This may change depending on the external circumstances. But right now, money is flowing thick and fast. People are becoming wealthier and wealthier. The number of angel investors, number of individuals who are participating with 1 and 2 crores is quite significant. So it's very surprising. It's very easy to raise 10 crores actually for most people these days. I can tell you 7-8 years back, raising 10 crores was considered quite an exceptional, even from VC's perspective. So the market is changing, and within this market, as I said, it's very difficult for a venture capital, and there we both agree actually that you don't time yourself to anything. I mean, today the Ukraine-Russia war is on. A lot of companies who probably, let's say if you're selling gherkins and you're selling a lot of gherkins to Ukraine and Russia, you will be in deep shit simply because there will be your exports order might have actually fallen by 80%. So those kinds of risks will happen in certain sectors and cyclical, but generally if you are investing in the space that we are investing, external market conditions fall up and down, or some other conditions only soften the price of your investment. So if you're paying 3x revenue, you might actually pay 1.2x revenue. It will also make a significant dent to your exit capability. So if you're thinking you are making 30% return, suddenly it will become 15% return, or that return will also become a paper return. Those are the two things that happen because of external circumstances, and your timelines to exit just go up. So from a venture capital perspective, what will happen in 2022? You can predict where capital will go, in what sectors you will see. For example, anybody can close their eyes and say mobility, energy and mobility sector will see a significant amount of capital investment this year. Simply because you can see every day there are, if I just go by my pipeline, the number of people with mobility solutions in energy, especially in energy efficiency, this thing coming to us is just very large. So there will be a significant amount of capital despite the kind of risk, because the government has taken a position that this space is going to dramatically change over 5-7 years. And we are talking about a very, very large sector in this sector.
But you touched upon a very important point, raising multiple funds. And I'd like to kind of take a deeper dive into that. And this is a question for first-time VC funds who are likely to kind of start their journey in 2022. Is how do you maintain that discipline when you think you've identified an outlier? How do you maintain the discipline of to invest or not to invest your entire capital in this one company? And what is that process? And if you do end up identifying an outlier in your opinion, do you then invest in 2 different funds? How does that whole process evolve? Okay.
I think investing 100% into a complete conviction is a tough one, but it's the easier one when you put in your own prop capital. So before starting the fund, if I have to put in my own capital, me my risk appetite is at 100x. I'm 100x actually. So I'm okay to do it, right? If it becomes 0, I'm okay. I don't have to invest in anyone. But as a fund, you obviously want to have certain discipline about what you do. And there's nothing which suggests that something will become 10x, 100x multiplier. There's nothing to suggest that. It's your gut at that point in time that it will happen. So I think having that bit of discipline is always good. And like I said, outlier returns, India may all you need to do is, as a venture fund, identify good survivors, and if survivors happen, they will grow, and someone will grow disproportionately. And hopefully you're part of the journey of leading that growth in some form. So not too sure whether it really helps to put in all the capital that you would want to. Like I might feel that pet food is pet space is a great space to be in India. It's larger. Pet as a space is larger. Consumer category in any other consumer category in the world, and India is not in 5-6% penetration. But can I put in all my capital there? Obviously, I would not. But obviously, you have to put in, I think, a lot more of your belief and capital into businesses that you like. So maybe you will top it up as much as you can. But to put in completely non-linear is a difficult one to do.
And what are the interjections? So, for instance, hypothetically, you identified a company, you like to park 100K, which is, I mean, average ticket size is 100K to it's 900. But would you then make an exception to go all the way up to 750K to a million if you really think you found a great company, or you wait for the next follow-on round?
So everyone has a different thesis of doing it. I'm going to be an outlier. I'm going to go with as much as I can. Because finally, if I'm investing by default, my conviction is there. There is no such thing as saying that I'm 70% convinced here, and I put in certain amount of capital, and 100% I put in more capital. Either I'm investing or I'm not investing. So I would optimize the investment as much as possible, but it's also a function about how much do you think the business also requires capital, and you want to overfund the business to the extent that they can go wrong twice before they succeed the third time. Yeah, so that is the capital that you want to fund, which means that are you funding them enough for at least 18 months of experimental capital burn success? So as long as we are doing that, I think we're good. For others, slightly material, whether we own 10% in a company or 49% in a company, slightly irrelevant. I wouldn't really care too much about it. As long as you're betting on the right guy, right space, and the right product in some form, I think we'll be good to go.
So I think it's very important to understand that venture capital, especially if you're doing an alternate fund, you are talking about something called a blind pool. You are effectively going and telling your LP that you give me money, you will have no right to see what I am going to construct. That's what a blind pool concept is. So that person is investing in your process system and decision making. So if your process system and decision making is actually so prone to whimsical decision making, then you are a very bad fiduciary. Because ultimately, fund business, if you are trying to actually build a credibility, then it is less about returns, more about the process and system. Some of you might have heard of Abraj, some of you might not have, but very much a whimsical process can actually kill you overnight. And so this is, you must understand the meaning of the word fiduciary. You want to play in this for long. And the punishment, and again, I'm repeating, the punishment is swift and it is very hard. So keep that in mind. It comes and it comes. And Abraj went from nothing to 14 billion. I knew RF from the time I started. I actually spoke. I was one of the keynote speakers in 2016, 2017. When the fund vanished, $14 billion fund. It was Asia's largest homegrown this thing. RF is still in jail, and that's actually the kind of consequence you can have, especially if you're playing on global landscape. So the blind pool is important. Once you are on a blind pool, what you are telling, and let's say if you're governed by SEBI, you already cannot do more than 20% of your funds. So you have to make 5 investments. Generally, none of us actually ever would put in more than 10, 12, 15% of our capital in a single company. Doesn't matter how good the company is, it's just not smart. Second, we are actually a portfolio creator. So one individual company is not really, does not actually excite us. It's actually the quality of the portfolio, which is what Nikhil actually started by saying. We are measured by the quality of the portfolio built, not the individual company. Of course, an individual company can contribute significantly to your capability of generating a return in a specific fund, but your ability to continuously spot companies is what people are actually evaluating you against, and therefore the concept of blind pool is very important to understand. Of course, as an individual, a family office, etc., I can follow any other approach. Finally, as an investor, especially those who are fund investors, we are all thesis investors. So if you meet Dhampal, he will have a thesis, and they will not move away from the thesis. It could be a subconscious thesis, you have not articulated it. Some of us, like Avishkar, we actually articulate everything to the team. So if we have a subsector also, we will have a 30-slide understanding of that sector, and we can defend why we are moving in this sector. So totally depends on it. You may be actually going with a written thesis or thesis, but I know for a fact that they will have a very strong subconscious or well-articulated thesis. We genuinely believe without that thesis, you are not going to do your fiduciary well. But at some point of time, somebody may come and ask, Hey, we gave you the money, what did you do with it? Everything needs to be explained to you. So this is a business which requires a significant amount of hard work if you want to go beyond a single fund. If it's only one fund, then you can do whatever you feel like.
Yeah, so for us also, a single borrower limit is very important. We cannot go all in one company. For us, we've defined it as 10%, although it allows 25%. So we've kept 10% that, no matter how good the company, there is a limit on how much we can invest. And anyway, venture debt ticket sizes have increased so much that by default, we are investing a lot in a single company. So our range, for example, is will be anywhere between $1 million and 15 million. But 15 million is where we stop. So no matter how good the company is, 15 million is what we can do. We do that within the guardrails, the other frameworks. If that company actually has the capacity to absorb that kind of capital. But it's important to have internal guardrails, and as Vinit said, remain true to the thesis. Overexposure in any sector, any company. We are plus sector agnostic, so we have internal guardrails on the sector exposures also. We will not fund more than 2 companies in the same subcategory in an industry. Yeah.
So, final thoughts. We left with 5 minutes. But very quick thoughts for the audience. We have new angel investors, first-time angel investors, first-time VC fund and seasoned investors. In 2022, as we stand, what would your thoughts be? And I can be biased because all of us are in the startup game, but what is your recommendation to these investors in terms of how VC investments versus listed stocks are different, and how should they proportion their investments over the next 2-3 years or 5 years even, starting 2022? Listed entities or startups in either category, LP or directly investing in asset classes through angel networks, platforms, so on and so forth. Apurva, would you like to?
Sure. So of course, listed companies and VC companies, VC-backed unlisted companies are very different. The degrees of freedom, the chances of experimentation are far higher when you are an unlisted company, and then once you get listed, you have other obligations. There are multiple number of metrics that you start getting evaluated on. Also, I think private unlisted space has a certain level of insulation from day-to-day macro factor, consumer sentiment every day. So I would say obviously there's a investment portfolio system, IPS, whatever it's called, by various PMS or wealth managers that design it for family offices or corporate treasury. But over the last couple of years, I've seen that people are more open to at least 10% of their wealth getting allocated to alternatives. It could be VC, it could be private equity, it could be direct investment in startups. But I think 10% is the broad number, at least I have seen on the world. I'm not really an expert to comment on that.
So, firstly on the public and private market, I've been a public market guy for 22 years as a professional worker. And then I set up the fund 8 years back. So I've done both public and private market. And I was doing pretty okay as a public market guy. But then I wanted to float my own fund. It happens to be in the private domain. So I'm hoping that the bias of private and venture is very clear. So clearly I have that bias about venture space. Second is also, like I said, in listed market, right? The variance between the best performing fund and the worst performing fund is not more than 5% point. Yeah, because the same subset that you're investing in. The second indicator is also the fact that, if you look at Fortune 500, 90% of Fortune 500 companies die over decadal cycle. And Fortune 500 is symbolic of the listed market in India, because these are also the best in class companies, evolved businesses, mutual life cycle, great quality founders, great profits, capital, everything is perfect, then they die. So to me, listed company is extremely symbolic of Fortune 500, which means that values will actually move away from listed to private over a period of time. And I see that happening already, right? So if you look at the unicorns, if that's your term, the public market unicorns were around 30 or 35 10 years back. They are at around 70, 80 right now. Private market unicorns were 1 or 2 10 years back. They are possibly 90 or 100 now. So clearly private market has upstaged listed companies, listed market and so on. And unicorns is not so much about value, but it's about businesses which are becoming relevant. You can debate whether Paytm value is real or anyone for that matter, but the idea is that the business was real, it was relevant, for people to attach a value to. With a 10 billion right of 5 years, it's a separate conversation. So private is really the way to do. For a lot of investors who are looking at, who get slightly more serious with the private companies, because a lot of us see unicorns every day happen, and obviously it's a great reaction to go with those names. I think it's also important to know that these are complete outliers which are happening. So if you guys are investing, my suggestion is that don't do it on an individual basis. Form a consortium of people who understand the space, and especially when you're doing it early, you will have to do a lot many investments. You can't get, please don't assume that your first 2-3 investments will become the outliers. Tougher, you'll have to be extra lucky to get that. And being a consortium really helps, because capital in India is really available in plenty. We've raised domestic capital right throughout our fund journey. We raised 2,500 crores rupee money in our current fund. We were looking at raising 900 crores. We've grown almost 3x that number. And it's all rupee money. So there's more than enough money in India. There are more than enough families who are investing prop capital, investing directly, and so on. So, as an individual investor, you frankly come in possibly the last in the hierarchy chain. And you should be cognizant of that. Maybe this is not your time. So if you have to invest, possibly invest through a consortium or through an angel network and so on, because you get used to looking at not many founders, their faces, their businesses and so on, and you'll get a better sense of where the money should go, because you truly have a fiduciary responsibility for your own capital also. So my only suggestion is that go in a group, don't do it individually, at least in the first couple of years, then possible function.
I don't invest in public markets at all, neither personally nor professionally, so I have no clue how it goes. I only know that every day you get up, you see it going up or down without any logic. So, anything that has no logic is not really something that you can read or understand. So I don't waste my time on that. Those who understand it should actually do it. But if you are looking at private market, I think there are many good reasons. You should be very cautious about it. The first good reason is that those who become unicorns, so you have what, 90, 100 unicorns. For those 100 unicorns, there are more than 10,000, maybe more than 10,000 companies that have actually been funded in. So the success ratios are very low. The second thing is a lot of angel investors I meet are very excited about that one hit that they have made. Unfortunately, if you play that Russian roulette, you would actually see if you bet on both sides, black and red, then you actually stay where you are. So you will keep winning, you keep consoling yourself that I'm winning, it is happening, but actually you don't make any money. So angel investing, if you are not really careful, is like that. You might actually be losing money or not really going anywhere. Yet you might keep consoling yourself if you have been very successful. Remember that it's a game of portfolio. The third thing which is very critical, and then you should watch out for what kind of businesses you are going in. If you are looking for those behavior change, technology discovery kind of companies, you must realize even the best investors, whether it is Sequoia, Blackstone, etc., they are also doing a lot of investments. They are not investing in one, but it's impossible to predict. So you can, general trajectory you can predict. Battery investing is going to create unicorns, but which one of them among the 100 you don't know, and nobody knows. Neither I know, nor Nikhil knows, nor Sequoia knows, nor everybody knows. So you actually then go through a strategy, a thesis, and then you choose what you think based on the experience that you have. Those who you believe has the highest chance of success, but you still don't do just one. You still do many, and I think therefore the advice that Nikhil was giving, that you need to actually go in a group and you should spread yourself in. It might actually not give you very large money, it won't make you a billionaire overnight, but it will actually keep you safe and keep you going for long term. Just be aware that private is illiquid. You have a very high chance of losing your money. There are far too many legal clauses that people like us put in that would actually make sure that even if the company has done well, you might not get your money back. Most of you probably don't know about liquidation preference and many other things. You may not get your money because we might actually take away the money irrespective of whatever happens to the company. So theoretically, you might be saying I'm at 6x, but you may end up actually getting 0 despite being its success. So there are far too many nuances, legal nuances that exist that most angels are not even aware of. And I know it because we have been investing in companies last for 10 years where there are lots of angels who have completely clueless of what actually is going on in the company. So just keep that in mind. So it's a risk that you are aware. Just be conscious and be aware that there is a risk. It does not mean you should not do it. Just know that this is a liquid market, long term, and returns may actually be more making you happy than actually making you sad.
Thank you so much. With that, we come to an end for this fantastic panel. Round of applause for all of them. Thank you, Apurva. Thank you, Nikhil. Thank you, Vinay. And I think we now break, but because we're not coming on to stage.
So we just like to thank your VC partners who keep backing 100X. You can see the names here. And for now, we'll be having a short break for lunch, and then we'll be back with more sessions. In the meantime, attendees who want to get their signed copies by Harish, he'll be waiting back after his talk, so you guys can plan it accordingly. Thanks.
Charge चालू माहिती. वो एक चेक करें. workforce to succeed. Something we have much pressure, right? We have to compete, we have to isolate, we have to shall I go again for the This week, this is done.
Hope you guys have a very good lunch. We'll kick off with the next session. Right. I request you to settle down. If you want to win in your game, you need to understand what the future holds. In our next panel discussion, Are You Future Ready? Discussing technology and business trends, our panelists discuss new technologies that give rise to innovative business models and products. I invite the next panel to shed some light on the same, both from the investor side as well as the product side. And why are these so important? We have with us Mr. Alok Goyal, who is a partner at Stellaris Venture Capital. His previous endeavors include leading enterprise software and outsourcing investments at Helion, as well as series of roles at Cyber Systems, the McKenna Group, and McKinsey. We have Mr. Rajesh Sehgal. He is the founder and managing partner at Equanimity Investments, a Wharton alumnus. He is an investor with Mumbai Angels and is the founder and the current chair of the Corporate Reporting Users Forum. Lastly, we have Mr. Vikram Gupta, who is the founder and managing partner at IDCap Ventures. He is the co-chairman with Private Equity and Venture Capital at ASSO CHAL. He has over 25 years of experience in private equity, business consulting, M&A, and various other industries and sectors. Also, the discussion is being stirred by Vatsal Kanakya, who is the principal and CTO at 100X.VC. I welcome all the panelists and Vatsal to the stage.
What's it? It's on.
Sorry?
Yeah.
Okay. Hey, welcome everyone to this session. Are you future ready tech and business trends? We've got a really good panel here and a very varied set of experience across the three. So very excited to get the chance to moderate. We're going to talk about top tech sectors that we're focusing on and the business models that we're seeing which are unique in the industry. Before I start with that, I think I want to put a question out to all three of you, right, to set the context. In your head, right, while obviously there's a lot more parameters when evaluating a company. If you were to create a split between product and business, right, product and business model, go-to-market, etc., what's your split in terms of importance according to your stage, according to your type? Maybe Rajesh, you can go first.
People. I think we come in very early, C2 series here, and most of the time it's a challenge whether you're focusing more on the product, because sometimes companies are pre-product and they're just building out the product, or if a product is there, the product market fit is still a question mark. So we come in pretty early, and therefore for us, business model is important, but that keeps pivoting. Product is important, but you never know what the right PLF is going to be. So we end up actually focusing a lot on the people, and the story that they're selling us.
Super. I think it makes a lot of sense. In the end, you are investing in the founders. Alok, what are your thoughts?
So pretty similar to what Rajesh said. I would say people followed by product, followed by business model, because it takes a while for the business model to really sort of emerge. So given the early stage nature of our investments, it takes a while for that to happen.
And what about you, Vikram?
I think it's not very different. The story is exactly the same. So eventually you're investing in people. So, but I think the products and the business model both evolve over time, right, as the market changes. So eventually you're investing in the maturity level of people who understand the market and the ability to build teams and the ability to scale business, the ability to raise more funds. So we assess people's maturity level and the ability to really understand how the markets are changing, the products are changing.
We have great consensus today.
Actually, that's it. I will just add a twist to Vikram's answer. Sometimes in the early stage, it is not as much the product, because mostly there is no product.
Yes.
What we focus on is the problem worth solving. Is it a deep enough problem? Is it a large enough problem? And so the problem is an important part in addition to the team. But product is also downstream most of the time we end up coming up.
Very true. And so we have kind of consensus that it's about people in the end, regardless of even if it's the hottest sector or the newest business model somebody is executing, or the most important problem they're solving. In the end, it's the people you're betting on. My next question, just broadly speaking about 4 hot sectors that people hear about today. One is AI-driven startups, right? So I want from each of you, are you investing in AI-led startups, either SaaS or consumer AI? Yes or no? And maybe a quick one-liner on why or why not. Maybe we can start with Vikram.
No, we quite actively invest in AI. In fact, all these 4 areas that you mentioned, of course, we've done quite a few investments in B2C. We've done investments in AI, doing businesses, SaaS, enterprise product companies. So yeah, so we have actually seen substantial growth in this segment.
Alok, where do you see the opportunity?
Yeah, so the answer is yes. I'm sorry, I'm going to give a little bit of a twist here, which is that we broadly classify it into 2 categories. Those that are what I would classify as AI enabled, in the sense that they use AI as a feature. Let's say it's a consumer app, which has also been recommendations of some kind, right? That I believe is table stakes pretty much across the board. We are seeing most companies use. Then there are those which I call AI first, where I would argue that they don't have a right to exist if AI didn't exist. And that second category is also very, very interesting for us, because we believe that AI first companies are going to reinvent many existing categories. And therefore we'll see a lot of incumbents coming in existing spaces and reimagining, rethinking those spaces.
And what about you?
Yeah, of course we do. I think
if you are part of the early stage ecosystem and you're even a little bit inclined towards technology, whether it's deep tech or even technology-enabled companies like we do at Connectivity, AI is part of life. I think wherever, like we say, data is the new oil. So wherever there's data, you have to have algorithms and technology to make sense of the data, which essentially is AI. So, yeah.
Super. So we have consensus that AI-enabled businesses and AI-first businesses are both important. Let me ask you this, right? Lots of investors want to understand key pointers or two maybe tips you can give on how do they evaluate an AI-driven business. Maybe Alok, you can go first.
Boy, that's a hard question because I don't think fundamentally it's going to be very different. But so I think, again, is it a problem worth solving is still important like it was for any other business. In the team, we will look for sometimes deeper tech capabilities, particularly if they're dealing with very high volumes of data. And if the data engineering part is going to be fairly complicated, then focusing on the tech co-founder also becomes a very important part of the thesis.
Super. What are your thoughts, Vikram?
So for us, as I mentioned earlier also, I think eventually it starts with the people, right? So you always look at, whether they understand the specific problem you're trying to solve and how they're solving the problem. But when you look at the problem itself, obviously there is a top-down approach in terms of the sector they're addressing and within that the specific problem they're solving and who else is solving the problem. So you look at all that, but as Rakesh mentioned that it's data is actually going to be the new one, which is actually very true. In fact, you see volumes and volumes of data now coming up, which actually will become an opportunity in search to offer new business models. Healthcare is a great example. We actually looked at genomics as an area which is now actually coming up in a big way. So effectively, you have to identify the specific areas, the data that you're able to generate, and the quality of the data, and the business model that you can generate around those data points.
So we've got the tech team, the people, we've got data, the ability to create proprietary data in that niche. What do you think?
I think the first thing we look for in deciding whether you want to back this AI company or not is NI, which is natural intelligence. As I said, there's so much data out there that if I share data with you here or with you there, you will come back with some analysis of the data. It's how you slice, dice, look at data, remove what's not necessary, keep what is necessary, and then make judgments and recommendations and decisions based on that. That essentially is AI. So I think the first thing is coming back to what Vikram said, the people, right? So the natural intelligence has to be there. And I think the second thing is, you brought that very well. You said if it's an AI-enabled kind of business or it's an AI-first kind of business. The scale at which we invest and the investing style that we have, we are not a deep tech fund. So the AI first is out for us, right? It's AI enabled. And as I said in my opening remarks, I think today's world, there is no business that can do without some idea of what data they are collecting, the business is generating, and what decisions they can use that data for.
Super. So I think there you have it, folks. I think AI is all about people, data, and making sure they have focus on the right space that they're building around and the right use case. Let me take a sector which is opposite of this, right? B2C brands. Lots of hype around the space, online first, lots of big passive players coming in, lots of money gushing in. Are you guys investing in B2C, buy or buy not? Maybe you can go first.
Yeah, of course we are. I think it's a no-brainer opportunity. Of course not. It's like a horse race. The no-brainer thing here is that one horse will win. And it's also very clear all horses are not going to win. Right? But I think this is disruption at a massive scale that's happening, especially in countries, third world countries like ours, which are very populous. So if you look at India, you look at Indonesia, you look at these kind of countries, technology has changed the way you and I consume whatever it is that we consume. Right? And the simple way to think about it, 10 years back, 20 years back, when I was investing from public market funds and private equity, large ticket sizes, larger mature companies, one of the entry barriers for new brands or new B2C kind of thought processes was the distribution network. a Unilever would reach, these many lakh stores, kirana stores, etc., through the length and breadth of a country like India. But a new brand, for them to even reach like a 1% of that market was very expensive. And today, it's just that whole mode is just gone. You launch a brand tomorrow, you're everywhere. Because Amazon is everywhere, because delivery is delivering everywhere. So that distribution is now taken care of. So I think there's a huge opportunity for these kind of businesses. I think there's one more angle to that, which I think is not as much appreciated, and that is about our willingness. You and I as consumer, our willingness to consume local. 20 years back, 10 years back, if you wore a denim, it had to be a US American brand. Otherwise, it was not a sasta pehna. No longer. Right? I mean, you wear clothes as a simple example. Textile. They are very local brands. You're proud of it. You're displaying the logos as well. Here is a local brand. Yeah, I'm a local khana. You take guests out to some local places. Earlier, it wasn't the case. So I think that is a big shift in how consumers have started thinking of not just price consciousness, but was value consciousness, and as well as they're moving up the ladder and they're proud to be consuming Indian. Big change.
Very, very comprehensive, Rajesh, and makes me feel very bullish. But maybe Vikram, you can share your thoughts on B2C.
So we've invested in quite a few B2C companies. We invested in Bluestone when it was very heavy in space. So the interesting thesis at that time was jewelry will be sold online, and we're talking about 2014-15. Very hard concept at that time to believe that people will buy jewelry without actually feeling it. And interestingly, at that time the business was very small. Now it's going for an IPO. And people are buying online. So I think the interesting is that AI, application we use that we're talking about is actually a very good example in this particular business, where actually the data is generated in every click that you make. Every time you look at a design, you're actually giving your information in terms of you like pink colors, you like flower designs, you like gold more than other pieces. So that actually is a lot of data that is actually captured to understand your persona, your what you like, and based on that, the system will start showing you what you really would want to buy. And we actually done, Purple we invested when they were just about 40-50 lakhs a month. At that time it was just primarily a concept that every time a customer comes online, we basically just try to understand the persona, the skin type, behavior, and other things. And it's grown to a fairly large business over time. So it's all again, application, use of data to understand the consumer.
And Alok, do you guys invest in B2C brands?
Yes, we do. So, like Victor mentioned, we also have a few B2C brands that we have invested. So we have invested in Mama, which is in the personal care space. We have recently invested in 2 more brands. One is a company called Zook, which is using vegan leather for accessories, and a company called Nasecom, which is in the kitchen and the home decor space. My apologies. I think I'm remembering the lunch here a little bit, but at a macro level, that's still our thesis is that India, you look at most categories, roughly 70 to 90% of goods that people buy are largely unbranded. And therefore, there is still a massive market to be tapped. The challenge, on the other hand, is that for a single brand, we find that it's not easy to scale brands beyond 1,000 crore kind of a mark. And again, I'm picking it's a bit of a random number, but if you look at brands in this country which are more than 1,000 crores, there are actually very few brands eventually. So while backing entrepreneurs, 2-3 kinds of things that we are looking for, we are usually looking for categories which are high ACV, high margin, with some repeat behavior. So if it's an impulsive buy, let's say buying a packet of chips, at least we are not yet there in our thesis to be able to back those kinds of companies. So that's sort of one side to it. From an entrepreneur perspective, we feel that it needs to be someone who understands both physical distribution, because beyond a point, you cannot grow purely online, you have to go offline as well. So understanding both offline and online distribution, understanding both online and offline brand building becomes very critical. And lastly, an entrepreneur's ability to span across multiple brands and multiple categories, which is sometimes very hard to judge very early. Like Vikram said, you come into a company which is 40 lakhs per month, single brand, usually just a few products, and you are taking a bet whether they will be able to build multiple brands, multiple categories, but those are the kinds of characteristics we look for. One last thing I like is that not only is B2C as a space interesting to us, but even other technology businesses catering to B2C are also becoming very interesting. And I'll give you a few examples. We backed a company called LineChat. That is basically a conversational AI company, now only focusing on the B2C space. We've evaluated companies which are allowing B2C brands to create the subscription models. There are companies which are just allowing you to do analytics now for just third-party marketplaces as well. So lots of newer categories are coming around B2C brands, which are not strictly brand companies also, but technology companies serving these brands.
Very, very comprehensive. So, broadly what I'm hearing is the opportunity exists because there is just so much. The platform has been built, as Rajesh mentioned, there's distribution, easy access for consumers to go out there. There is an opportunity, like Vikram said, to personalize. Because of the online approach, there's an opportunity to personalize like Moonshot did. And like Alok said, about 70% of products bought are unbranded. So the opportunity exists because of that, right? There's 70% of your household items can be replaced with a B2C brand. Alok mentioned a couple of great points on how to evaluate some, B2C brands, on the being a large revenue opportunity, making sure it's a high frequency, large, high retention, large ticket size purchase with good margins, and obviously the founder's ability to understand distribution. Maybe Rajesh, you can add something on top of that on how do you think about evaluating B2C brands?
So one of the things that we look for, I think you just mentioned that we pay a lot of attention to that right from the beginning. It's been a hybrid model, and as I said, as you just said, you have to have a deep understanding not only of online but also offline. So online is a easy access kind of, you can just be there like I described. People are trusting to buy brands online because it's no longer about just your brand's name, but it's also Amazon. Amazon se kharida hai, so Flipkart se kharida hai. So there's that brand rub-off that's happening. Right? That's one. And I think offline is extremely important. In a country like India, if you really want to build a scalable business, a large, sustainably scalable business, you have to, as a brand, you have to go offline. Because people, as much as they buy online, there is a large section of population which will really want to, if not feel in touch, but at least see, at least a reminder that, actually, Nykaa store ek yahan par hai. I may never go into the store and buy that thing from the damn store. And I may think, kyun itna paisa kharch kiye hum yahan pe store, on a high street, etc. But I think that's that kind of, influence on the consumer's mind. It changes a lot in terms of consumer behavior, and so hybrid online offline for B2C is essentially important. I think the second thing that when we are investing in these kind of companies as an investor probably is about the team. You may, as I said in the beginning, all of us agreed as consensus that we back people. So people are extremely important. The problem statement here is when you start the business, there are very few people. So you're just evaluating that founder and his founding team. 3-4 great people have come together. Acha kuch na kuch to isme magic hoga. Right? We'll see. But I think as investors, when you're evaluating these businesses, you make sure that you have some understanding of that business model. You have some understanding and some value add that you can do to that business. Because as the team grows, as the business grows, you have to at least make sure, if nothing else, that they are hiring the right kind of people. And every aspect of that customer delight, right from sourcing raw materials to the whole supply chain to where it reaches the consumer, there is one gentleman there, other than the founder and the founding team, who's managing that part of the process. And as investors, you have to make sure, again, it comes down to the people, but it's no longer just the founding team, but the people below them, the leadership team at least. So these are things that we spend a lot of time on.
Very comprehensive. Again, thank you so much, Rajesh. Vikram, any final thoughts to add on to that?
No, I think for us, investing is not just that, look at transaction and then, just evaluate based on valuation and all that. I think it's a process for us. We actually spend a lot of time. On average, we would have spent a year with the team before we decided to invest in it. Right? So basically, we'll meet them multiple times, understand their mindsets, and understand how they think about not just the product, but how it will evolve over time. So, it's not just about assigning valuation to the business based on multiple values, right? So for us, we've done deals where, we would have met the entrepreneur in 2015 for the first time. They would have come with the first prototype of the product, but we would finally invested in 2021. And during that time frame, we would have actually spent a lot of time guiding the entrepreneur. They would have gone and raised other rounds of funds in the meantime. They would have come to us at that time. So especially in B2C, as Alok said, there is a challenge that, if it's just a product, single product company, there is only so much size that you can think of. So the multiple models which are emerging in the market, which is a big story everybody hears about. I mean, there's some neat facile kind of a model that emerges somewhere, and there is value in that because we actually build multiple brands, we actually build house of brands. So in a certain area you can do that. We've done that in healthcare earlier, within our portfolio with lecture banking labs. That model works, and actually, if it's a single brand which cannot scale much, you actually have a house of brands, effectively building a platform. So I think, as long as you have thought about the target market that you're going after and the size, that you can build there, then it's a matter of just,
Very true. I think note this down. I think investors, your relationship with the founder should be a line, not a dot, right? Build it over time. Very, very true. So I think I'll just pick one more sector really quickly. This is what everybody's probably been hearing with all the Facebook hoopla rebranding to Meta. The metaverse and Web3 ecosystem. You hear all of these pre-seed rounds, $5 million rounds at a 50 million valuation, Web3, whatever, right? So are you guys investing? There's so much hype around this. Are you guys investing? Why not? Where do you see the opportunity? And how would you, or in brief maybe, how do you look at these opportunities? Maybe Alok, you can start first.
Boy, I was hoping that you'll ask the other two guys and I'll come to this question in the end, because as a firm, we are spending a fair bit of time in this space. I think over the last 6 months in Denver, there is a part of our team that has spent a lot of time in this thing. At the same time, I should confess that, on a scale of 0 to 10, our understanding is somewhere probably in the 1 to 2 category still, because there's just so much to uncover, so much to learn in this space, and it's still evolving. It's still actually pretty amorphous as a space. We divide this broadly into multiple categories, whereas there is the infra side of it, which is the building blocks that others will use to build other applications. Right? Then there are the applications themselves. These applications could be, for example, these could be NFTs, other kind of creative tools, etc. And then there are applications in finance. That's the sort of broad 3 buckets in terms of how we are looking at it. We are we are keen to do more very early stage, partly just because we don't understand much, partly just because valuations are sky high the moment you go to next round these days. So it's hard to catch these companies at a later stage. But I don't want to give a disingenuous answer because we are still building our thesis, and hopefully in a few months we'll get to it.
So, thank you so much, Alok. But maybe you can talk about how is Stellaris approaching and learning about this, right? And maybe you guys can talk a bit on this as well. Let's dive into the question. Family offices, angel investors, everybody's trying to invest in the future, right? How do I keep in touch, and how do I decide, okay, this is something I want to learn about, and how do I keep educating myself on this topic? Maybe you can take this with the case study of Stellaris learning on Web3 space.
Okay, so 2-3 different aspects of learning, and I think this applies to Web3 in particular, but applies to other spaces as well that we do. It's a mixture of, I would say, 3-4 different levels that we do. One is that very often we will hire people with very specific skills. So for example, we hired somebody with a very strong financial services background, with a deep interest in Web3, and by the way, I think Web3 is all of 2 years old for most part. So it's not like anybody has a deep background, so to say. But at least you are familiar with the terminology, sort of where people handle, but that's one part of it, and you learn through them as well. That's one piece of it. Second, you just read a lot and you hear a lot of podcasts. I'm, for example, a podcast person than a reading person. I run a lot, and while running, I'm always listening to podcasts. And I'm realizing that I think I have listened to most podcasts that exist on Web3, and I've learned pretty much close to nothing still. Is sort of where I stand on Web3. The third part, which is I think where investors learn the most, is by meeting entrepreneurs. I think the beauty is that every entrepreneur is trying to change the status quo of the world in some small way, somewhere, right? And whenever you are pushing the envelope on the world, I think just understanding what the status quo is and what that pushing the envelope means, just hopefully people learn a lot in those meetings. And I think, I guess that's the best part of our job. So once you begin to meet, let's say, 100 entrepreneurs, you begin to see some patterns, at least some blocks begin to fit in your head, I would say. But broadly, I would say those are 3 different mechanisms that we are following to learn about this space.
Very, very true, Alok. Indian entrepreneurs show us the future and educate us on their vision. Vikram, what are your thoughts on the Web3 space? Are you investing or not? And how are you educating yourself on a space which is not seen before?
So how, very similar to Alok actually, I spend a lot more time, I get a lot more learning meeting entrepreneurs. In fact, I remember first time an entrepreneur walked into my office and said, doing something new in cryptocurrency. This was like 6 years ago. And I said, leave everything aside, just spend 5-6 hours with us. Just tell us what cryptocurrency is. So that guy actually, coached us, educated us, basically right from the very basic fundamentals. So, entrepreneurs are actually the best source of learning new things. So I learn every day like that. But I think one thing I want to highlight here, when AI was a new buzzword, I think entrepreneurs are being forced that every third sentence should have the term AI. So when you're actually meeting an entrepreneur, just insert the term AI. That will catch the attention. And we're now seeing something very similar on metaverse side. Right? The entrepreneurs just inserting the term metaverse somewhere in the pitch. So just to catch attention, yeah, this sounds in metaverse, right? So something new. So I think just because you're using the terminology doesn't mean that it all of a sudden innovative new business model. See, I think this is something which is definitely changing the way things are done. But I think especially in India, we are still very early in this whole game. Globally, yes, if you have a business model where customers are in the US or in other parts of the world, I think you can apply some of this technology that customers understand. So especially if you're in a B2B business, when you go and talk and use this terminology, customers will ask the right questions. But in India, go and talk to a customer and try and explain this. It's something that will, very similar. Customer first ask you to educate them what it really means. So I think it's a very similar story on the investing side as well. So we actually spend a lot more time for us to educate ourselves. What is it about? How we actually use in multiple business use cases, etc. And this is an opportunity for sure. Web3 is offering good opportunity. Very selectively, we have to identify the right business models for that.
No, I think very good point from Vikram. It's important to avoid the tourist founders who are just trying to create hype in the company but may not understand what they're doing. And obviously, it's important to understand it's so early. There's going to be a lot of missteps and a lot of customer education needs that needs to be done before this market is ready. So you need to keep that in your mind, be cognizant before you actually invest in a company. And finally, Rajesh, what are your thoughts on Web3? Are you investing or not? And how do you educate yourself on fields that you've not been exposed to before?
Yeah. No, I think a few thoughts on this whole Web3 phenomenon that we are all now part of. And, like you said, every day now has some mention, metaverse ko aata hi hai. Whether it is metaverse or not, I don't know, but meta is there. So, I think it's a huge opportunity, right? I think it's not just an investment opportunity. My limited knowledge of all of this is very candidly, you guys mentioned that we're all learning about it, and I'm the same camp. We're all learning about it, and I can confess that I still don't consider myself an expert, even an amateur in the field. So we're all learning. It's still early days. But why I feel this is a huge opportunity, not only from an investment point of view, but I think for the Indian startup ecosystem as a whole. My question is, are we as an ecosystem ready to take on this challenge? Why do I think like this? All the entire startup ecosystem, all these technology companies out of India, right? Most of the companies, if you are very candid and truthful about it, this is very limited innovation. There's really not technology. We are not at the forefront of technology as an ecosystem. Right? It's a reflection on all of us. All of us on this side, all of us, all you guys there. For once we have this opportunity where everybody in the world is trying to grapple with this new thing at the same time. Like you said, it's just 2 years old. It's not been there for 20 years. It's a challenge. But hey, this is a challenge where we are equals with every other startup ecosystem in the world. Can we as an ecosystem take this opportunity, seize this opportunity and demonstrate that India is not about servicing the West or other developed countries. India is not just about making technology which others are using, etc. and the value addition there. But India can own the space. So I think that is the challenge that I see. In terms of whether we invest or not, I think any of us will be missing the bus if we don't invest in this. But that said, there's always a but. I'm sorry, but there's a but. That said, if you go back to early 90s, and there's this young guy called Jeff Bezos, right? And he said, internet was in its infancy. He somehow figured an opportunity saying, yeah, ये किताबें online बिकेंगी, right? And look at how what's happened, right? So right person at the right place at the right time, right technology. So if internet wouldn't have become what it has, Bezos wouldn't be who he is, right? So we are there now. How the building blocks are coming together. When you talk of Web3, it's blockchain. It's a lot of things coming together. Now, are we at a juncture where most of these building blocks for Web3 are coming in place, and therefore some of our businesses, some of our entrepreneurs will be actually able to build monetizable businesses on top of it, right? Honestly speaking, and like I add to both you guys here, I have no idea. I don't know. But it's a huge opportunity, and I'm not letting it pass by. So I think all of us, we'll be learning. Mostly I think we are a little privileged because we have these entrepreneurs who come and give us 6 hours to explain, everything. But that's the best way to learn. We're all learning.
No, excellent point, Rajesh. This is the 90s. The internet's just come out, and we have just as much of a chance of creating leadership as the rest of the world. So it's a chance for us as investors to invest in, to envision the future, and to build it out with the founders. Excellent.
So just one more thing to add. I think you brought that point very well. This challenge is a little more compounded because when in early 90s, etc., 94, 95, when the VC ecosystem in the valley was what it was, and they were funding all these companies, किसी को समझ में नहीं आता था इंटरनेट में क्या होने वाला है, and therefore valuations were very subdued. Unfortunately for us at this time, when you're looking at these, forget about pre-product, this is at the idea stage. The metaverse itself is at an idea stage, and the valuations are skyrocket high. So should you participate now? Or do you expect that we should wait for the next few years? एक बड़ा crash आएगा. Somewhere everybody will realize ये समझ में नहीं आ रहा. So the valuations are also pretty rich in this ecosystem. It's not easy.
You have to be cognizant of valuations and the price of it for sure. So I think we've covered a lot of tech sectors. Let me quickly talk a little bit about business trends that we're seeing might be hot and a lot of investors might be hearing about. And would love your thoughts on this. Specifically, product-led growth. A lot of SaaS startups or even consumer startups now talk about using product-led growth. And the second is on the subscription business model, right? Every single thing is going subscription. Even consumer brands are creating their own subscription businesses. So maybe we can start with Vikram, you first. What do you think? Are you investing in product-led growth, or have you invested in product-led growth startups or subscription startups? Any thoughts on either of the spaces?
We have done, as I was saying earlier, quite a few SaaS-based, companies. For example, we invested in a Convo site. This is actually a platform for communities, and basically you extract content from the discussions that happen in different communities, and that becomes interesting insights for brands. So effectively, the brands on the other side are subscribing to the platform, and the communities are actually providing content, and which is actually mined to give rich insights about their product that they're selling in the market. So that's a very interesting concept, and it's actually scaled up quite a bit already. Another company called Elucidate, which is drug discovery AI platform. So it's actually working with big pharma, biotech companies. Very early stages when we are actually working on a new drug pipeline. There's a huge amount of time that goes into early stage research. So these guys are they're collecting data from different sources and are able to really turn around a lot of intelligence around what should work eventually. So that actually reduces the timeline to build the products to the market. So that products like these, which are actually going to be there for a very long time, except that you have to keep evolving based on the data you're generating, based on the market trends, based on how the mindsets are changing. So there are quite a few examples like that.
In these companies that you mentioned, what are a couple of things you're looking for that PLG really works for them? Right? And how do you think that somebody comes and tell you as a company, as a founder, I'm going to do product-led growth. How are you thinking, is this a match for the company or not? And are they going to be able to execute?
I think the first thing is always about, is there a demand, is there a market for it? So of course, you have to first talk to the customers, understand why they're using the product in the first place, and what other options they evaluate when they're considering buying this product. Right? So you spend a lot of time understanding the consumer behavior and why they bought certain things, and then you match that with the trends, and then see whether this product is actually going to stay for a long term versus is it a trend or a small time frame kind of a thing which will then be replaced by something else. So you have to study multiple things before you actually come to a conclusion that yes, this is the one you want to select.
Great. Alok, what are your thoughts?
So if you look at, and I'm going to answer the PLG question first, which is that if you look at the distribution methodology for software in general, we have seen three eras, which is, I would say, almost all the way up to 2000. And this is the era, I used to do software sales guy for 10 years as well. But broadly, it's a feet on street sale. Very low role that marketing used to play. It was largely sales led in these kinds of motion. And it quote unquote relied on the charms and the sort of whining, dining, etc., all those methodologies that they used. That was the one process. Salesforce changed the paradigm when they moved sales to phone inside sales. I used to work for Siegel, by the way, at one point in time. And when Salesforce came out, we used to make fun of Salesforce, saying that they don't know how to do business, because we were doing $10 million deals, and they were doing $40,000 deals at that point in time. But clearly, history is proven that Siegel was not right. But they changed the paradigm because you could generate demand using digital marketing, and you could sell on phone. And we have now Indian companies like Zoho, Freshworks, and now many others have taken that offshore. Somewhere in the 2010 onwards, or broadly I would say, is where the motion for what we now refer to as product-led growth started, which is when Dropbox, Evernote, a lot of these companies started, right? But it has become mainstream now. I think we are realizing, in general what has happened is that the center of gravity, where in an organization where software decisions are made, actually has come down. I remember that I used to sell to the boards and the CXOs. Slack maybe sold to departmental users as well, many of the softwares that we have seen. And now individual users make their own calls. And as long as a software has a value for an individual user, even though they may have a different value at the organizational level too, but as long as they have a value at an individual user level, I think that there is a possible way for product-led growth. And I'm a bit of a convert. Even until a year and a half back, I was very skeptical, because I was born in a different sort of school of selling. But I'm realizing that the power of PLG is actually very high. At the same time, like with everything else, just because you have a weapon doesn't mean that you have to use it in every single case. And you need to be thoughtful, like Vikram said, as to where it makes sense, where it doesn't make sense. But I think the power of PLG is actually pretty enormous.
Absolutely. Why use a nuke when you can use a pistol?
And like with everything else, Vatsal, I'll say that as an investor, I see opportunities in two directions. One is, for example, we are invested in a company with you guys, which is purely a PLG motion company. Right? That's one thing. So a lot of SaaS companies are going to be PLG focused. Whenever there is a new go-to-market motion that comes, there is a massive opportunity in building the stack to support that motion as well. So when the world went from outbound motion to inbound motion, that's when companies like HubSpot and many others got created. Right? We believe that a completely new stack will get created for distribution as PLG is becoming mainstream, and that is also a very active area of interest for us as an investor.
Super. Thank you so much, Albert. And maybe I'd love to hear, Rajesh, your thoughts on the subscription model, because I think Vikram and Alok both spoke a little bit on the PLG. What do you think about the subscription model? Are you investing? How should investors think about every company that comes to them saying, okay, we're doing a subscription on our consumer product or consumer brand or whatever, right? how do they evaluate it?
So this is a tricky one, subscription and subscription-led models have been presented to us, and we've been part of these conversations for I think at least 2 cycles. And I still don't, have any few names that I can count Indian companies who have really cracked this whole subscription, business. Globally, yes, we all subscribe to so many things. We look at Apple's results or Google's results. Everybody, we're all paying them by the way, whether we realize that or not. So I think it's still some way off, but the way we are tackling this at Economy is we are looking at micropayments. We are saying even if you don't subscribe, even to whatever product you're buying, or whether it's a physical product or an online tech product, if you don't want to tie yourself down for 12 months, but you start paying micro payments for whatever it is that you consume, whether it's content. So you're consuming content, and you don't want to subscribe to the entire. Let's say, for example, a newspaper. Right? Earlier in the morning, a guy would come and give you a newspaper every day, and you would read the whole thing. 10% of that, 20% of that was relevant to you, but you would buy the whole thing because that was the only packet it was available. Now you take this example online. Today, there's an ability, and we've backed a few companies in that space. One of them is Thinkly, and you guys should go online and search. They are saying, okay, you can read the globally best content available, and you don't have to subscribe to New York Times, right? Here's that one article about New York Times that a friend forwarded to you on WhatsApp, and you want to read this, right? So you pay 10 rupees to read. So I think we are somewhere on our way to subscription models, right? And I think we are doing it in a very Indian way of saying micro payment. Sachet, 5 rupees mein bikega, 10 rupees mein bikega.
That's an excellent insight. Thank you so much, Rajesh. I think we have limited time, so just a couple last questions. One quick one. Lots of these guys are angels, FOs, family offices. They're all looking to invest in the future. How do they pick their battles, right? There's opportunity in AI, there's opportunity like you spoke about how we don't invest in AI first companies, right? But you know where to invest and where not to invest, right? So how can investors make a choice, right? These investors decide, okay, these are the sectors I want to focus on. These are the future sectors I want to focus on. These are the future sectors I don't want to focus on, right? Maybe Rajesh, you can go first, and then I'll look at the.
That's a tricky one. I'm known to speak my mind, so I will speak my mind. So I think as angel investors and family offices, and I'm keeping institutional investors out because we have processes and all of that, right? We have people who do investments 24/7. So but family offices may not necessarily be doing that. They have their businesses to run, and their surplus is going into investments to create wealth. Same for angel investors, right? They have something else to manage, and in their part time, they are also making sure that their money is working as hard as they're working. So strictly for angel investors and family offices, I think, and I was an angel investor by the way. I started my angel investing career in 2006, 2007, very early days of the startup ecosystem. So I can really speak from experience. Few things that you should not do is, it comes back to the basics of investing by the way. I'm not going to give you anything new. Everybody is like discipline. Yeah? You have to be clear in your mind whether you're here for a casino experience, because we can give you that, right? This ecosystem can give you that. So if you're here for a casino experience, then there's nothing wrong in that by the way, but you should be clear in your mind. Or you're here for building a portfolio and supporting entrepreneurs in whatever journey they are in. And they're very hugely different, right? Very, very different. So in your mind, ask yourself this question first and be truthful to yourself first. Second is, if you're coming into this ecosystem and you want to participate in this whole humongous growth that is happening, my recommendation is allocate capital, very wisely and do it before you get in. So you should know that I'm going to allocate this much capital, and in this much capital, I want to do 10 investments. Be very clear about that. Otherwise, you will realize in your excitement, and I did this mistake by the way as an angel investor long back, कि पहला बंदा मिला बहुत अच्छा लगा, उसको बहुत सारा पैसा दे दिया, और फिर उसके बाद में you keep meeting all these rock star entrepreneurs saying आपको पैसा ही नहीं है, allocation ज़्यादा हो गया, right? So be very mindful of what you're doing. Don't come here just because your friend is doing the same thing or your neighbor is doing the same thing. तो मुझे भी करना है. Have discipline about it and know what you're doing here and why you're doing it.
Super important point, discipline, obviously.
is very critical. We all talk about it, but nobody actually executes it. Very important ages. Alok, quick thoughts how to select your backers.
Sorry, so sorry. So can I do a quick question here? A show of hands. How many of you sold stocks over the last 3 months from your portfolio? I see only 3-4 hands. Nice, thank you. It's just for my personal consumption. It shows discipline.
Go ahead.
So, 2-3 thoughts as far as family offices are concerned. Number one, I think that the world of investing, especially investing in startups, I feel gradually has become a lot more specialized over the last 15 years. I mean, like in our team, I only do SaaS. Somebody else does B2C brand, somebody else does Web3. And chances of going wrong are actually much higher than chances of going right. And if you are scanning the surface across multiple spaces, chances are you will mostly go wrong and not go right. And therefore, just 2 pieces of, at least my advice from a framework perspective, that if you are evaluating startups which are related to your core business, your mainstream business, there actually you bring a certain muscle. And I think those you should do direct. And you can decide to do early stage, late stage, whatever sort of fits your budget and interest and overall intent. And then, if it's outside of your core area of expertise, I just think very much like public equity, you are better off putting money in fund managers who know how to do their stuff, as opposed to playing yourself. Unless, as you use the phrase casino money, if you're doing it for play money and not as an investment, then that's a separate thing. By all means, you should invest. But otherwise, you're better off investing behind managers than playing with yourself.
Super. Thanks, finally.
I'll say the same thing slightly differently, actually. I think basically, fundamentally, it's the same concept. But I think the important part is, what percentage of your time are you going to invest in this? Actually, because you should actually, if you're investing directly in the company, either you should know the business and you should be able to add value to that business, or invest with somebody else you trust will be able to add value or will actually make a difference in that business. Otherwise, it's actually, as Rajesh says, a casino. So I think you never know. I think you can actually, we've seen exactly if you put 50 lakh rupees and have a 200 crore outcome. But I think discipline and investing in areas that you know, or investing in people you know what they do.
Super. Thank you so much, everybody, for this wonderful session. This was super insightful. I think everybody learned something to different valuation.
Thank you. Thank you.
Dinad is just coming on stage to hand over.
Recently, a strong trend has emerged of family offices pursuing alternative investments. Let's decode family office investing in startups with our next panel discussion on family offices falling in love with venture capital. I invite Chetan Mehta, the Chief Strategy and Investment Officer at Transfer Group of Companies. He is a chartered accountant and a lawyer from India, with 2 decades of advisory and consultant experience, of which 11 years have been with EY. I invite Davya Dolakia. He is the founder and CEO of Dolaka Ventures. In the last 15 months, he has invested in more than 25 companies, including some of 100X.VC portfolios, through Dolaka Ventures, which is a sector-agnostic fund based in India, which is also the family office arm of the Dolaka offices. We have Siddharth Somaya, who is an investor with the Somaya Trust across sectors. The trust has been an active investor in 100X Portals and a mentor as well. And lastly, I invite Harshal Mehta, co-founder and general partner at 100X.VC. He's an investor with Mehta family offices and also actively mentors and invests in 100X Portals. The floor is now yours.
Hello everyone, how's everyone doing? I think a lot of us are personal investors here. So the point of this panel is to get an understanding of how active families and active individuals in venture are looking at venture. So pretty esteemed panel here. I'm seeing all three of them on cap tables. I've been co-invested with them. I know how they operate. So I'm really excited for them to share their thoughts. I think, kind of starting out first, how do you guys actually look at VC compared to other assets? And how does your family really what percentage are you guys allocating to startups? And then afterwards, what percentage of time are you allocating? First, kind of what percent capital, and then what percent time does that equate to?
So, I'll just talk from my perspective. Basically, my family has started an innovation. We started an innovation center in 2010, which eventually became a formal incubator in 2014. So we are investing more in the ecosystem to build startups, investing in very super early stage companies, and then from there growing them and investing them. So I would invest personally, my uncle would invest personally, my mom, etc. And so basically our time is more on ecosystem building, and currently till today we've incubated around 140 startups, and I think the PalmEasy's MVP was built in our innovation center in around 2012 or 2013. So for us, it's more about ecosystem building rather than personally investing. All the personal investments I'm mostly doing because I love the space, but family is more into ecosystem building. I hope so.
How much time do you spend? If you had to allocate a percentage versus the other parts of investing, because one thing about VC and families in general is if you're a direct investor, there is a level of time commitment that involves. Does that come into play as you think, or is it more you're open to any amount of time?
So I love interacting with startups and startup founders. So as much time is required, our CEO of our incubator will call me anytime and be like, okay, setting up a meeting with this guy tomorrow, spare 1 hour, I'll spend 2 hours. I love learning the journey of as an entrepreneur because I personally am an entrepreneur myself as well. So I would allocate maybe 15% of my time every week to interacting with entrepreneurs and startup investors.
Amazing. Yeah, similarly, when we started, it becomes full-time pretty quickly. Maybe Chetan, you want to talk about how the family that you're with is allocated.
No, thanks. Let me clarify, we are not cousins. We keep ending up meeting in various events and people are starting associating us as cousins. But yeah, he's a great friend. So, for us, we look at it from an asset allocation lens. So first of all, it's very important to really see as a family to evaluate what is your asset allocation, how much liquidity requirements you have for the family office, and then also look at what is your risk profile and your return expectation. I think once these three are clear, that's where we see how we want to allocate capital on the lens of risk. That's the most important thing because a lot of family offices, when they see are getting into the new asset class, in which venture is slowly becoming a new asset class for many global family office investors. It's very important to understand the risk first. And given the highly illiquid nature of the asset class, it's very important how you also, once you decide on the asset allocation, how do you build your portfolio? And again, it has to be a mix of whether you're comfortable with selecting managers or backing managers and having some fund investments, or do you have the time and resources to get into more direct investing? So I think it's a question of one, being very clear on asset allocation, how much risk you want to take, and then how you want to allocate within that. and then how much you want to diversify, in terms of areas, sectors, geographies. I mean, I'm heading a family office based out of Dubai, so we are able to do much more globally. So as a portfolio, we are investors, in India, US, Israel, Middle East, and many other countries. But then, if from an Indian family office perspective, it's also very important how much you want to allocate and the sectors where you want to allocate. So I think asset allocation lens is very important.
So, talking about our family, I think venture capital was an asset class with, what we started off with, talking about investments. And from the time perspective, me, part of the family, I look after the investments full time. And so, we have like one person dedicated from the family in every vertical that we get to.
Awesome. So I don't think anybody would come to a 100X Investor Summit thinking on indirect investments. I think everybody here loves startups and wants to invest directly, as does the panel. So it comes with pros and cons, but let's keep the track on direct. Curious on each one of you guys. We'll start with you, Sid, first, because you're closest to me. On what kind of checkboxes are you looking for when you're assessing a startup, and specifically equate that to what stage? So if your preferred investment is at seed or early stage, what are the checkboxes you want to tick off before considering investing?
So for me, I love getting in super early as possible. And the idea is funding the startup through their journey from seed to Series A, Series B as much as we can, as much as they allow us to. And the checkboxes for me is, in India, I feel like it's very founder-driven, very network-driven, very people-driven. So for me, I focus first on the person. I wouldn't say the business angle is secondary, but with the business side, I have like a 55-question document that I would go through directly and indirectly with the startup founder. But for me, I'm trying to gauge, how coachable is the startup, is the founder, is he willing to listen? Because these are very important things, right? You can't have a God complex and start a startup. And for me, that's super important. Now, obviously, in terms of the business angle, for me, out of my 55 questions, it comes down to like 3 things, basically, like what are the current cash flows, what are the future cash flows, and how risky are the future cash flows. And if I can kind of answer these questions effectively, then I'm pretty much in. And I don't even then negotiate valuations or something, because that's, a very complicated discussion. So for me, I get in super early and then try and fund them as much as I can throughout the journey.
As a family, Sid, and somebody that wants to come in early, do you ever lead investments? Is that something that your family looks to do? Are you guys doing currently? Here's how you look at becoming a lead investor, or is the preference more as a co-investor?
So I'll speak from my perspective. My family still invests relatively, my mom, uncle, etc. I love startups, so I'm going to take it like my proprietary investments. I would love to lead investments. I have led 1 or 2 investments before. And for me, I would be most comfortable in leading an investment and sort of trying to set the terms as much as possible.
Awesome. Yeah, there's nothing like leading an investment. I think when starting out, families, we getting our feet wet. Co-investing is the right strategy at the beginning. Once you have a thesis in mind, you do want to start leading, and maybe I can segue into Chetan. How are you looking at it? I mean, are you looking at co-investing, leading? What is your preference, and what are the checkboxes you look for?
So again, from a family office perspective, we try to diversify the different stages where we invest. And then our criteria of investing also depends and changes with the stage. So if it is seed, then I think the founder quality and the founder who's really building the business, I think his vision, his clarity of thought is the most important thing. You can do research in the market, right? At the end of the day, it's all comes down to the founder. So it's very important that you spend time with the founder when you're coming in really early. and spend more time, have as many interactions as possible, and see really what is his vision for how he wants to build the company. The other thing which I've seen is, sometimes founders are very technical. Maybe they are building a technical product, but they don't really understand how to build a business or how to view the business from a P&L lens. And it's very important that founders really understand how margins, how much margins are they making, or what are the different things which they will do to really increase the margin or increase the take rate moving forward. So, just going after building a good product is not the only thing, but in terms of how do you really scale up that, how do you build it more around solid unit economics, all those things also matter. And when it comes to late stage investing, it is about what the company is doing at what stage in the market. Do you really identify that sector, and do you think that this company can really grow from that stage? And then the quality of investors on the cap table so far also becomes important when you are co-investing at those stages. So I think it's a function of at which stage you are entering, and then having access to the founder early on is very important. I mean, for me, unless I meet the founder, I don't really try to write a check unless he is Elon Musk and we are investors in SpaceX. But it's very important to meet the founder, because that's where I've seen my decision kind of changing after I've met the founder. So for me, meeting the founder and getting that comfort is very important.
It's funny how that works, right? You see a deck, maybe I'll take a call, and you meet with the founder, next thing you know, you're signing a check, and I'll never, the sales capacity, it's nothing like it. How about you, Greg? What are some checkboxes you look for, and are you more comfortable co-investing, or are you looking to lead deals as well?
Sure. So, a couple of checkboxes, I mean, idea and product and market and everything comes later. I think founder is first. How I think one thing I also learned from 100X Thesis was how coachable or trainable are the founders. No founder is going to know everything on day one, but is he willing to learn, etc. We're talking about other investors on the cap table. I think it's also important to see if founders picking the right investors. He's not only looking for money, he's looking for the right money, smart capital, right? So that's another thing. And talking about co-investing or leading, I think it's only been about a year and a half. So we've mostly co-invested. A couple of companies that we've led around were the follow-on rounds that are existing portfolio raising. But I think in the longer run, we'll start sort of leading the rounds as well.
Yeah. No, one of the major advantages of having your own capital and investing your own capital is patient money. At the same time, want to be cognizant of what startup stories are. And pace and velocity is very critical. So I think, Ravi, you're on a good point on more follow-on rounds, post first check. So is that something that you guys find advisable, or is it more along the lines of case by case? For example, should we be looking to kind of lead an up round once comfort is there, right? Or is there a playbook, or do you guys mostly look at it case by case?
So I think it's more of a case by case, but we've closely monitored this company. We've seen the traction build up. We've seen how founders have evolved. So I think the comfort level is higher, once you're on the cap table, even before you
Well, let's get into some of the fun stuff. Let's get into more storytelling here. Siddharth, give us, kind of one of your favorite companies that you're close with, and give us a story on, how you got sourced the deal, how it happened. I think the audience would love to hear some more specifics and generalities on a special startup you have in your portfolio.
This is actually the first startup that I ever invested in. Basically, I was at our incubator in 2015, and it was called My Cute Office, and it was like an Airbnb for office spaces, and I was supposed to lead around for that investment. And I was speaking to someone, and for some reason the deal didn't go through. I was only 25 at the time, and I was putting my own money. I obviously wasn't taking my family's permission because they were conservative, and my mom was like FD, and I was like, no, I'm going to do startups. And the deal fell through because one of the mentors that I was looking at, he didn't invest, so as a proxy, I didn't invest. But I had that money sort of set aside to invest, and this mentor that I was speaking to, he knew I loved the direct-to-consumer space, and this dude comes along, Ashutosh, founder of Valuation, and he tells me, hey man, I know Indian men, they just like feeling macho, and I've created a product that makes them feel macho. I have no data, I have no surveys, I have no studies, but I know this exists. I was like, you are brilliant. This is such a nascent stage that there's no market study done. That means it could be like a huge return for me. So then I get a check, which was in like double-digit lakhs, and I was like 24, 25 at the time, which was again a huge deal for me. And 4 years later, we sold the company to Marico, and I made my first exit. So that company is obviously close to my heart because it was my first check, and my first exit with my first check. So that was also fun and also very lucky. And thank you for Ashutosh for making that happen to me. Yeah.
Superstar. Nothing like it when you build that relationship with the founder and you get to see the whole journey. How about you, Chetan? Tell us a story. What Portfolio do you look at as this is a special one, and kind of give us some details on how it all went down.
Well, in fact, I remember the first batch of 100X, which happened at IIT Goa, and that was a cohort of 20 startups, and I was there meeting with quite a few. And in fact, Sundar remembers I was the first one to write a check on that day at demo day, and we had this company called Top 32, which is now Smiles.ai. Two brothers, one delegates, one MBA, and I really liked what they were building, and I wrote a check on the demo day itself. And then after that, we had a great ride. Sequoia came in, Chirate came in, and they just recently closed their Series A with Falcon Edge writing a large check. And we've seen them grow and really mature as a company and what they intend to do. We've again followed on and are participating in the Series A. So again, this is where sometimes you also have to go, with kind of your heart and intuition. It was the first time I was meeting him in 45 minutes. I decided to write the check, and it's been a great ride so far. And sometimes, one is of course, kind of the multiples of the X that you make, but it's about, kind of the satisfaction that you get in terms of how you've been able to, just be mentored as part of the process, handled a founder during, COVID and those, bad times. And then really see the company goes out as a winner where you have these large funds backing. So that's one case study. The other is, we've made quite a few bets in Israel, and we work closely with few Israeli kind of funds, platforms. So there was, one Israeli company I always admired, which was eToro. eToro is a social trading platform, and I knew, the founder's wife, because she is one of the angel investors there, and I always kept talking to her that I would love to have invested in eToro. And after a year, there was a secondary available in eToro, and she remembered that I was really interested, and she called me and would you be interested for the secondary available. And I said yes. I've always loved the company, and we invested at quite it was maybe a 600 million valuation. But from there, and then COVID happened, and this was the best thing to happen to eToro, and now they are raising or they are listing at a 10 billion valuation. So again, it's been a great journey. As part of the process, I've got more than 2-3 occasions to spend time with Yoni, who's the founder at eToro, and spend time with him, and now they are good friends. So I think it's about also you kind of looking at a sector, looking at some companies and seeing, what is that something of interest, and then also building a relationship, because I think the relationship sometimes gives you that access, gives you those insights into companies, or just brings you opportunities. So I think build your network, build your relationships. That's very critical.
Yeah, super lesson there, Chase. I remember your commitment in Doc 32, and I remember how these relationships play out. Jake and I are quite close, I'll never forget you coming up to me, which ones do you like? And I said, these Doc 32 guys are good, committed that day. And that pace of commitment led to a direct investment in the company, which is now quite a high multiple. So congratulations on that one. It takes guts to move that quickly, and those internal relationships matter. So the more we transact together, and the more it ends up kind of bonding. And I've been seeing you on a lot of cap tables, and I've seen a lot of founders writing ventures on their websites and whatnot. So why don't you share a story with us, maybe on your first investment, or maybe one that is close to you?
So I think for about a year and a half of portfolio, we've seen 4 or 5 companies do their follow-ons. But I think the first investment that we made as the family office was again a 100X portfolio company from class 1. In fact, last week we prepared, as a third check in the company. We led this round, and we've seen the company grow almost 15-16x in the last 15 months. A company called Property, which is micro lending space. I think our first investment, maybe we got lucky, and we're happy to do the lead to follow on as well.
Awesome. So it's a lot of fun talking about successes, but with venture also comes the other side. And so we'll talk. Next topic will be pitfalls and kind of the mistakes or learnings we've had. So I can start it off just to kind of break the ice there. In VC, it's when you're investing, it's fine if a startup consumes your capital and doesn't work out. That's one thing. As long as the founder didn't fail, that idea is okay to fail. What hurts a lot more is a miss, is a whiff, or I saw the investment for whatever reason didn't connect the dots. So I had too many to count on my end, but one in particular that comes to mind was I was a very early check in a company called Zepto, and my fund at the time, which was the only fund, was up, and we wanted to do a follow-on, and very close with the founder, great relationship. Founders telling us, hey, this rounds are happening at these valuations, and I said, well, that's too expensive for me. I knew what they were capable of. I was already an investor person, and wasn't able to pull the trigger there, and that was a big loss for us there. So curious if you guys have any kind of pitfalls. And my mistake there was I should have read the room a little bit more. Should have been seeing what was happening on the ground. I wasn't spending the time doing the diligence, seeing the pace, even though I was already an investor had I known. So curious on you guys, any kind of lessons learned or pitfalls in that regard?
So for me, the most powerful emotion to avoid at all costs during investing is FOMO. It is the worst emotion in the world. I have invested in 2-3 companies because the founder was from an Ivy League school, had an insane background, worked at an MNC, and raised at seed checks at like 50 crore valuations, and invested, and now those investments are worth 0. So for me, I've been I feel like an investor's journey is also like a personal journey. Philosophically, I feel like the 3 things that one must always have during investing is patience, restraint, and conviction. And for me, those are the 3 things that I'm always looking at when I'm looking at a company, because I'm looking at it like from that angle. And I'm always very self-aware of FOMO right now. So the moment I feel that emotion, I just back up. It's just
FOMO is dangerous. They call it that. There's a phrase in crypto called aping in. It's like an ape that's coming. So it's very hard once you get into space. You'll see signaling from other investors. Jacob, what are some pitfalls and lessons you can tap into?
See, I think it's important to look at building a portfolio and give yourself enough time to build a portfolio. For family offices or angel investors, you can't be just doing 2-3 deals and then waiting for those outcomes. So rather, you plan and build your portfolio wherein, say you commit that, okay, you will do at least 10 to 15 investments and then maybe take a pause. Because at least then it kind of guarantees, return of capital to you. And then of course you can build on and add more companies to the portfolio. So one is don't take, don't kind of deploy your entire capital in 2 or 3 companies. That's number one. Second is, I completely agree. I think over the last 5-6 years, I've realized that I don't want to chase any opportunities. I think opportunities, if one goes, another one, 2 comes around. So it's okay if you've passed on some or those are done well. But don't chase opportunities and then see if, again, whether that fits into your thesis, whether it fits into the quantity in terms of how much you want to write a check and how does that kind of impact your overall portfolio. So stick to the basics, give yourself enough time because it's important to not just be in a hurry and you have so much of capital and you need to quickly deploy. Be patient, deploy slowly. Try to interact more and meet as many startups as possible because that will also kind of bring insights and help you become a better investor. Because then you will start asking smart questions, you will see those data trends, you will see where the company is doing something right, something wrong, and you will be able to separate it because you may find maybe another company in the same space after 2 weeks. I mean, it will give you that chance to compare companies and why you should bet on one against the other. So give yourself enough time, build a long-term portfolio, build a diversified portfolio, and don't be in for a short game or just for the returns. I can see how you are able to also add value to all your portfolio companies, and with your experience or your family office's experience, how you can add value to them. Because that's something which the founders will also appreciate.
Absolutely. I mean, discipline is a common theme here, and there really is no quick money in startups. It's an absurd concept to expect. Founders are even selling the story. Oh, this will 100x in 1 year, runaway, right? So, Dorothy, I know you're pretty early in your journey, but what's something that keeps you up at night? What's something that you're cognizant of that you're thankful for as a newer investor?
So as I think both of you mentioned, FOMO is one thing that I have with putting in systems and processes in place, which takes up a lot of time, and I always get this is a good deal, good investors, and that fear of missing out is always there. And in that rush, you also tend to skip a lot of steps and processes. But talking about mistakes, I think not a lot of people know, only my immediate family knows. But back when I was in college in the US, the whole crypto and blockchain hype came up, and I went and attended a couple of conferences here and there, learned something about it, and obviously did not do my homework. Ended up transferring the crypto portfolio into this new blockchain company, which I don't know where the founder is now. So I lost that, plus all the upside I could have gotten on the crypto side. So obviously the homework was not done. Again, the fear was there. The deal was closing, 90% committed. You want to jump in, and the whole hype created around. So I think the first and hard lesson learned was from that.
I think everyone here has bought high, so that's a very easy thing to do. Awful investment strategy happens more often than not. So, I would love to hear some of your guys' opinions on what trends you guys are seeing, and what's something that interests you, and something that you as a family won't touch. Let's start with you, sir.
So I'm seeing a lot more people getting really excited about obviously directly investing in startups. And I don't know how new the trend is, but I've been seeing a huge uptick recently over the last few months. So I think it's also because, we as Indians are very entrepreneurial, we have grit, and we can survive in spite of many forces against us. And the more people get out to fund these ideas, I think the more India will grow and India will scale and, really be a superpower in terms of financial and intellectual. So that's sort of the trend I'm seeing. And something I won't touch, I don't know, I never really thought about that. I'm quite sector agnostic. Earlier, I used to only do direct to consumer investments, but now I'm pretty much invested in most categories. So it's something that, actually, I probably wouldn't touch like a direct crypto investment, even after one of my hands. So I think that's like been a really good, crypto's been a really good feature, probably save me a lot of money in the future. So yeah, many crypto things I wouldn't touch. So yeah.
It's so interesting. I was with B2C founders last night, Indian founders, and they were telling me some of these multiples on revenue in B2C. Insane. I called her a liar. And she said, Google it. And I Googled it, and everything she was saying was true. And my mind was blown. And some of these valuations are jumping 50, 60 times in B2C. In the US, B2C is very cold right now. It's become it's very hard to fund. So I'm wondering if that trend comes back, and I'm going to be picking your brain after the conference on this. So how about you, Jacob? What's something that you guys are kind of leaning into, and on the flip side, what's something that you guys won't touch?
I think as investors, we need to somewhere spend a lot of time understanding the macro environment and really seeing what are the big changes which are happening in a country or any jurisdiction which are investing. So one, if you see India, right, I mean, last 3-4 years, so much has happened which maybe we living in cities don't really understand or realize. I mean, there are really low income families now having bank accounts, which is so empowering. We have the whole UPI coming, which is made it so easy to transfer money from one place to the other. You have energy, electricity reaching villages, households, which can really, which has enabled a lot of businesses being built around it, and the other things I spoke about. So, and especially post-COVID, I think the whole way of transacting has changed. So I guess we have to focus on what is tier 2, tier 3 town, tier 4 town really looking at, and how people there are aspiring to either consume goods and services. And there are so many businesses which are now being built around catering to that audience. And for example, you had Flipkart, Amazon, but now you also have a Moonshot, right, which has created its own space, while the kind of goods they sell are of low value and all of that. But then still, they've been able to create a niche where Amazon and Flipkart were not able to reach. So the thing is, you need to also keep an eye and study where the whole landscape is changing and start identifying those trends, and maybe build your investment thesis also around those areas which will be the future, or which will be, or which may, or any new tech or new way which will change your the way you're consuming goods or services. So I think if you are able to spot those opportunities, I think somewhere you have to start taking those bets more from the future rather than trying to follow what's hot right now. So I guess a bit more futuristic, a bit more understanding the micro, and kind of playing a larger trend, which may come about in the years to come.
And Misha is a phenomenal story. That business would not have worked in the United States. I think that those unique India stories are fascinating, because these are some of the market trends here are the only places where a product like that could work. I mean, that was many times, we get stuck investing X for India. It's the same startup, but for India. The trends tend to work, but in Misha's case, it's Misha for India, and probably India only. So how about you, Daria? What's something that you're really leaning into, and something that you're kind of shying away from?
So again, sector agnostic, approach was to have like 1 or 2 companies in each of the basket, get a feel, understanding of each of these sectors, obviously, putting away the saturated, highly funded sectors. Get an understanding before we sort of filter out those sectors which we understand can add value, and probably focus on those in second and third year. And I think the sectors that we want to as a family avoid investing are the meat industries or alcohol, gambling, or the sim industry, right? So we try to stay away from these sectors. But other than that, we want to have an understanding of each of these sectors to get some insights, what's happening, even to understand what's trending, what's new happening in these sectors.
Yeah, legacy businesses are tough. I mean, we have a Porto in the audience. I think Jake and I are both in Coolberg, so non-alcoholic. Way to go. So curious, well, we have a little bit of time here, so it'll probably be the last question. I'm always curious how families, what was it like kind of convincing, this is what you used to with success and whatnot. How did you get family over the hump? What was that conversation like on startups? Did you have to show results? This, that, at least my mother was always asking, when's the exit? You spent all this money, when's it coming back? So how do you maintain your liquidity and looking at it? What's the one thing that you can speak to your family on patience and whatnot? What are those conversations like?
So initially, I was always using just my capital. But now, just last year, my mom has given me access to some of hers. So that's really nice. So I can invest more. In terms of that, I showed her, I have a portfolio of 25 companies that I've personally invested in as of today. I'm 31 years old and I've been investing for 6 to 7 years. So I showed her, what my CAGR is as of today, and it's at 31%, approximately something like that over 7 years. And she was impressed. She's only used to FDs and things like that. So there wasn't much convincing, to be honest. Now she goes around telling her friends that, oh, my son invests, you should speak to him. And it's funny because earlier she was telling me that, oh, you shouldn't invest in startups and things like that. And my uncle, on the other hand, he's been the one exposing me to incubators, and ever since it started in 2010, he's been telling me to go there, interact with startups. He doesn't invest as much in startups because he invests in his own business, but he's very, very bullish on investing in the ecosystem. So he's built a state-of-the-art biotech incubator, one of the only in India. We have another incubator which is for engineering and stuff like that. So there wasn't much convincing to do. It's just showing returns and hopefully showing better returns. But for me, it's not about the returns. Otherwise, I would have invested in a VC fund. For me, it's speaking to founders, 5 to 10 founders every week, learning their stories, learning their difficulties, learning what's happening in India, having your feet on the ground, and learning how we can make India a better place. So for me, that's what I'm doing, and that's constantly my focus.
I mean, intentionality is so critical. How about you, Jason? What was that conversation like with the family office? Were they hesitant at all to enter into VC? If not, how did you convince them?
Yeah, so when I joined, the family portfolio was extremely conservative, largely real estate, fixed income, and I was always an equity guy, more of a risk taker, and I was also working with startups, doing a bit of my own angel investing. So, so my pitch to the family was, see, we have this, but the asset allocation is really, lopsided. So what is it that you want to have? So I ran a questionnaire for all the family members, took individual inputs from them to say that what is your liquidity requirement, what is your risk profile, how much returns you want on a year-on-year basis. And that's how once I got the inputs, I said, let's build a portfolio around venture and allow me to start doing that. The family had some bad experiences in the past, where they would have just partnered with some family and that has not really gone anywhere. So they were a bit skeptical, but I think initially what worked really was, from my side, also writing a check with the family. So they could see my skin in the game. When I was recommending a startup, I was also putting my own check. there was a time where, and I would not recommend to anyone, but there was a time where there was a startup and there was an opportunity, and I could see that this is a really good, safe bet, go in the venture space. And I wanted to really write a large check from the family office, and I said, I will put myself, on the same check, and I actually borrowed capital, and I invested in the startup. I will not recommend anyone, but I mean, I see so many friends buying loans for, taking loans for real estate. I said, if I don't back myself, then what's the point? So yeah, I mean, I feel. You need to have these discussions with the family around, again, the same parameters of asset allocation, risk profile. You clearly know how much you're allocating to this space, and within that, you can also diversify your portfolio. I think each asset class has a role to play at a family office level. Same thing, I think, also is for maybe a blockchain, Web3, crypto investments. It's not about whether it is high risk, low risk, or that. But if you believe in an asset class, if you believe that this is going to be the future, let's not sit on the fence, right? At least let's put 1% of the capital on take some bets. I believe in that, and I believe you have to make a start somewhere. So you start with whatever is comfortable to you, and if you start allocating, and that will give you much more insights, exposure, because once you put in your money, you're spending more time to understand this space, and that's how you will, grow that asset class.
Awesome. No, superb. Those stories are very critical to understanding how to get over the hump in something that's risky. And Dorothy, how about yourself? I mean, I can't imagine that conversation at your age. The whole checkbook opens up. So, what was the conversation like? How do you talk to your family about startup investing?
So, it's very different than most of the families, because we as a family have never invested outside of our own business. And this is an asset class that we started off with, given a condition that one member of the family is full-time focused into this, actively looking at this. So I think it was a long, 6-8 months debate that I had to have, because the family was never invested in stocks or bonds or gold or anything. Starting off with one of the riskiest asset classes was tough. But again, my interest was to diversify. So give me a year, whatever capital. If you think it's not working out, I'll come back to business and do whatever you tell me. So 6 months later, looking at the portfolio, they increased the allocation to 2x, and then after 12 months, they increased the allocation to 5x. So they're happy, I'm happy, and I think 100% of our portfolio is VC anymore.
That is the best feeling, when mom's like, "Oh, I tried this product," and you look at her and say, "Hey, we invested in that." So, super stuff. Awesome, guys. Well, we really appreciate you guys obviously taking the time. And these guys are super investors. Please do network, and please do talk with everybody. This has been a phenomenal event. Thanks to the 100X team. So we'll be around, and looking forward to meeting everybody.
Thank you. Thanks for inviting us.
Takes 2 minutes. It's okay. के बाद अपना सेशन चल वेरी गुड which is also
You're based here? Five days in Delhi. It becomes 9 days in That was the milestone. Actually, solving now, of course, I mean, Here in India, so our condition is somebody has to be significant minority. The benefit is not as makes sense. I'm so glad to see okay, do I have the optionality? That's kind of it's very interesting. I'll drop you a WhatsApp I take some time, you take some time together with that philosophy. So there are some very So yeah, so I mean, please tell three of them that on the good thing about the is like your mindset is
Just like you investigate
All closed now. The Geo Gen next also, I think TVR is connected. We are having so I will be able to call you. Geo and here actually I moved can be rightly integrated in front. You can see the difference. I think with Reliance there are many Wind is there, Geo is there. So right now we're getting good right now. So right now we're just going live with market. So Monday we're going live. Big store for hostel market, celebration, gift card, so sales cycle right now the market we're facing B2B customer conversion works slow. And that cycle is very so right now the biggest challenge is but बीच में ये प्लान था ना कि this will be rolled into another entity or something. When we went with them, we were discussing that कि कुछ और plan चल रहा है, ये कुछ और fund पे convert होने वाला था. मेरा लास्ट IPL के साथ हुआ था I had one employee so they 1.1 का round था and they led it 98 investors of my capital तो अब मैं कुछ ही डालता यार हो गया अब उसके लिए 3 महीने लग जाते 4 महीने लग जाते that was like yeah let's just go say उनके पास power of attorney है so I don't deal with 98 but still 98 certificates yeah मैं मुझको 98 सर्टिफिकेट नहीं सिग्नेचर एक उनकी तरफ से आईपीवी लेकिन मेरी तरफ से और पता नहीं एक गड़बड़ और मेरे आर्टिकल पेपर पे लिखा हुआ था कि मेरा सर्टिफिकेट फ्यूचर में एम्बॉस सील के साथ मेरे साइन के साथ लगता है पहले मैंने एसएचए में लिखा कि डिजिटल होगा था उसने उनके किसी लॉयर ने बोला कि आपकी आईओए में लिखा कि आपको प्रिंट करके साइन करके एम्बॉस वाला वो लगा के ही देना होगा I signed the boss, right? All the things. So अभी ये ना this forming where Andrew Holland, the CEO, is investing. So I have some funds and all coming. अच्छा चल रहा है. पूरा overall 7 से 10 मिलियन का है. नहीं अभी तो बच्चे का उसका 10 मिल का 70 मिल पे हो रहा है. He's a 90-year-old kid. I think class 3 or class 4. They're doing 10 million. बड़ा क्या होता है अभी एक थे हमारे वो क्लास 1 वाले ने 23 मिलियन का किया था नॉन 30 आज छोटा ही और बहुत सारे गरीब
We'll be shortly starting, so I request everyone to settle down. I hope you all had a good break. Let's dive into it again. Corporate venture capital has the potential to become an alternative means of innovation. Strategically minded VCs are not driven exclusively by returns but also value innovation. CVCs offer a wealth of capital, human resources, corporate partnerships for startups. But does it really matter for startups? To further elaborate on this very thing on the next panel discussion, which is future-proofing your businesses, corporate venture capital, I call upon our next panelist. We have Amar Shankar. He is the head of the GeoGenX Fund. Over the past 3 years, Amar has led the GeoGenX Fund with advising to 100 startups in India, which have collectively raised $250 million till date. He previously held roles at Microsoft, Reliance, and DishNet. We have Nitish Muttersen, the founder and MD of the Nazara Group, which is among India's largest mobile entertainment platforms. He is also serving on the South Asia Board of Young Professionals President's Organization and is a trustee of Dr. B.K. Goel Heart Foundation and the Diamond Tree Awards Foundation. Lastly, we have Tanmay Kumar, who is currently the CFO at Shipwalker. He has 23 years of experience as a finance leader and also includes 12 years of leadership expertise in business startups and scale-ups. He was previously the CFO for Spencer Retail as well as Burger King India. I'll welcome you all to the stage, and the floor is not yours. The session will be moderated by Ramesh Rajka, who is CFO at 100X.VC and also the founder. We'll just wait for a couple of minutes to have Tanmay join us.
Hello. We'll just wait for Tanmay for a minute.
Well, thanks a lot, guys. Thanks for joining in back again after tea. I'm hoping this to be a very interesting session, something that you guys will definitely enjoy. I have an esteemed panel here. She's already introduced you guys, but that's Salma, yes. Good, thank you so much. Well, we have three esteemed gentlemen here. They've run large corporates and are still running it, very successful. And they already are involved in startups in some or the other way, right? So let's just jump in right on the discussion. We are kind of slightly running late. So I quickly jump on with the discussions. Starting with you, Amay, you've been leading the Gen Next initiative with startups, dealt with multiple startups for 8 years now. Just tell us a little bit about your experience. How do startups feel? And how do really when they react when, let's say, as a large corporate, you're supporting the initiatives? I know you've incubated startups as well, but they grow, they went on in the journey, and then when they have their first brush with a large corporate, how does it feel to them? Any perspectives there? And I'll jump on later to Nikhil.
Yeah, thanks. First of all, congratulations to you guys for organizing such a great event. As I was saying that, this is the first physical event that I'm attending after a very long time. So it's great to be here. I think as far as our program is concerned, over the last 7 odd years, we've engaged with about 170 startups. And we have sort of collectively raised more than 2,600 crores in venture capital. And about 50 of them have entered into commercial engagements with, some part of Reliance, whether it is the energy side of the business, whether it is geo or retail, etc. And, the interesting, corporates and startups come from two different worlds, right? And a lot of ex-corporates also leave and start their own startups, and for them it's a very new experience when they do that. So our job at GeoGenNext is to actually bridge the gap that exists between these two stakeholders and build that bridge quickly and help them accelerate their conversations such that some kind of a meaningful relationship is established. And it's been a solid learning for me. Like I said, 2 different worlds, and I would say that it's still work in progress.
No, absolutely. I think we're all learners. I'll point this to Nitish. You've been at Nazara, been there, done that all 20 long years, and you've seen a bunch of, kind of strategic partnerships. I would say, right from Nordwind, Dataworks, Sportskeeda. I think you're involved in so many such deals. These are all probably at some stage quite small, right? When you're acquiring them, talking to the parties, talking to founders, management teams. How have been the interactions? Like, how's the build-up? What all things do you take care just to make sure that these partnerships become successful post-integration?
Yeah, sure. So I think before that, I think give some context on why we went down the route was maybe more relevant to this discussion. Nazara is a company I started when I was 18, but 22 years back, right? And in 2015, I was realizing that, in fact, one incident happened where I realized that the mindset over the years kind of has to change, otherwise you become a kind of a dinosaur. I was talking to an entrepreneur who wanted an investment from us. And he said, boss, I want $5-7 million, 50-40 crores to start my business and scale it. And I asked him, how long will you use this for, And he was like, maximum 6 months. So I lost it. Was my mindset of running the business was very different. And that day I realized that times are changing. When I started this business in 98, what was the market size? There was no risk capital, there was no equity capital. I was an entrepreneur born in those years. The entrepreneur born today in 2015 or 2020 came with a completely different mindset. And I realized that for Nazara, for my company, if we did not partner and associate with new entrepreneurs, new blood in the system, we would become obsolete like dinosaurs. And I think that's what made us move into this new mode, which in the last 4-5 years we have been very successful in. And what we like to call the Friends of Nazara network is where we partner with many entrepreneurs who are running their own businesses, but
passionate about gaming and can come and join, become part of this team, and achieve a dream that we all are sharing. I think that worked very well for us. I think one instance of the corporate venture capital, I'm just sharing why we did it. In terms of what's needed to do these deals, with founders and entrepreneurs who are running businesses like gaming, which require a lot of passion and they're fully into it. Doing financial dealings are not easy. And I think I must have had 20 lunches and dinners with each founder at each Candy Club before actually, being able to do it. So I think there's a lot of effort that goes into it. It's not just about financials. There's a lot more about soft skills. There's a lot more about relationship, trust building, and confidence building, more than just a valuation. At least when it comes to partnering with a corporate. When a founder is taking money from a VC or a financial investor, I think it's far more simple, It's like founder is saying, show me the money, and it's like, show me the valuation, and deal done. Right? I think when it's partnering with a corporate, there's a lot more that goes into it. And the biggest thing from a corporate perspective, I think I've found over the last 5 years is, it's not about how much as a corporate or established company we are investing. It's not so much about the IQ, but about the EQ. The ability to partner with founders, have visions, let them take calls in their businesses. It comes easily to investors. It doesn't come easily to corporates, right? Because they are already used to operating a business. You automatically extend that into operating their business. That can be disaster, I think. And therefore, at least in our case, we've asked all our founders to have 100% control. We don't get into day-to-day operations at all. So, long answer to a short question.
No, absolutely. I think all of them were very relevant points. Exactly what I was looking for. But very interesting viewpoints I think you gave in terms of letting founders the leeway post associations, post getting them with that first brush with the last corporate. As you rightly said, corporate is a different world. When the founders first meet, they are used to hurdling, they are used to hustling. And that's not as much that happens in a large corporate. Right? So that's something, and I'll kind of now move on to Tanmay. Tanmay has been in the finance field, worked on with many companies before moving to Shiprocket, and he leads the whole initiative, not just the finance, but also strategic. So I'm going to answer some more difficult questions to him later, but the easier ones first. How has been your journey, Tanmay? Just show us a little bit about this side of the business where you're constantly dealing with strategic initiatives. What's the challenge that you faced in not just Shiprocket, but other companies as well?
Sure. So, we have this interesting situation where we are corporate in the sense that we've been a startup which is grown, so we understand that piece. At the same time, the benefit of having gone through the journey and being a little larger. So it's very interesting, when I moved from my earlier roles where I was doing this for larger corporates to Shiprocket, the whole beauty and the whole fun of this is actually seeing everybody and the whole ecosystem grow. That the whole part that you're talking about, growing an ecosystem, working together, I think it comes very naturally in our kind of environment. I find this very, very powerful to be fair. Right? Now, just to give you a little more longer answer, what is Shiprocket? Shiprocket is powering this whole digital commerce for each one of these B2C brands and B2C brands. For us, it's all about this ecosystem, right? And there is this whole extensive work we are doing just to enable, support, grow digital first brands. So there is this extensive science, cohorts, teams, meetings, just so that we can mutually all grow as an ecosystem is what we are doing.
No, absolutely. I think I've been watching Shiprocket grow, and this whole digital first push that normally all these startups now have, riding on consumer, riding on retail. I think you guys have been a big enabler and well positioned as a well funded startup. So you understand what these startup journeys are.
makes you a more bigger fit for a CVC kind of association than anything else. But yeah, I mean, just jumping on to taking a little step back, trying to ask the bigger question, right? Like when we talk about corporate venture capital, it's another form of venture capital. Of course, startup funding is part of it. But like we've seen in the US and the advanced countries, we have the models of, Masco and Qualcomm, and these guys are pretty big guys. They've been doing it forever. If you really want to see the kind of model evolve, these are the kind of guys who have led it. So when you see these large corporates run it the way they've run it, what differences do you see in the Indian ecosystem? Like when you talk about Indian CVCs growing, we've seen a few bunch of deals. Amrita has been doing a bunch of deals, and what classifies as CVC. Any pointers on where this is going? Any takes on is this growing? What's the future of CVC in India? How do you see India CVC shaping up? Because that's a lot of corporates on the fence actually are not jumping into it. They're trying to get their feet wet, but not really jumping into the pool, so to say. So anything on that? Any pointer? I think we'll go one by one.
I think it's very simple because this is really the decade of startups in India. Right? I really believe that we are well on our way to be the startup nation of the world by maybe 2030, 7-8 years from now. I think the kind of innovation, the kind of value creation that is going to happen in India and out of India by startups is going to be immense. Corporates can choose to jump into this flowing river, or they can choose to stay out of it. I think staying out of it is going to be super dangerous.
Yeah, I think I would agree with him. One of the issues that I see is to force fit a model that is worked in the West in a corporate in India. Because I think culturally, even from the point of view of the management style, it's very different in India as compared to the West in a lot of cases. Maybe not so much in startups, but in large corporates who've been around for a very long time, the style is very different. Right? So you have to adapt the corporate venture capital model to the style of the organization and make it work that way. And that's been our endeavor, and that's been very different from typically a startup way of working. So that's number one. Number two is that I feel that corporates don't have any option but to partner with startups now, because that is the engine of innovation and growth, right? Like you said, that this decade is going to be the decade of startups, right? So we have to find a formula that works. My only concern is that the model has to be repeatable and scalable. It cannot be a once-off kind of effort. That you find something interesting, you do it once a year. But this has to be a continuous process because technology is changing so fast. So if a corporate figures that out, I think they'll be on a middle street.
Okay, so I will agree with both. I think clearly the overall, I think corporates allocating more capital towards this direction is clearly growing, and this has come with a lot of the success that is happening, right? So where people are seeing now. Overall, if you think of corporate venture capital as a proportion of overall, right? I think India would be like a half of where the global average is. We do there would be like 120 corporates doing it today at this point of time. Probably number growing with a lot more startups beginning to do it like us, right? And growing. And that's where you are getting to see players who understand innovation, understand this ecosystem far better, and that is going to, in my view, fuel this very, very significantly. We are involved, for example, in this in all three stages. I mean, we, for example, in a year are identifying very, very early stage, close to 100 brands where we try and incubate, nurture, mentor, work with them. Then there is another program where we run our own accelerator led by somebody else, where we are helping them get funds, exits. We run 2 cohorts in a year, 15 brands each, do that. Then there is a third, element where there is a Series A kind of investment where we are co-investing. So we are seeing that this whole science of being able to get through the all parts of journey is something that is going to really multiply the whole thing big time. And that's where I see this whole thing doubling, growing very fast over the next few years. Between, I was reading somewhere, and it's close to 700 million must have come in last year. There's been, 1 year, there's been like a 250% growth in the CVC capital. It is going to grow.
No, I think corporates are realizing that they have to get associated with startups in some way, right? The way probably is not yet figured out completely, as I think Amir rightly pointed out. The models are yet to be evolved, but it has to start somewhere, right? So one question that comes to my mind is that each of you, this is applicable. If you were to allocate some percentage of capital on CVC / innovation and not R&D, I don't mean R&D by that, because probably that applies more to manufacturing, pharma industries, etc. More on innovation. So what part of the surplus funds, or is there a logic, is there a math to it that, okay, I'm going to put this much kitty just for corporate VC and venture capital, and I'll dedicate this fund to venturing into startups in some way or the other. Is there a number in mind? Is there a math to it? Please take a jab at it.
It depends on your timing, treasury management for financial gain, or is it a strategic move? Is it smart capital that you bring to the table? Can you accelerate the growth of these companies? In the last 3 years, most of the companies we've got have 10x in revenues in 3 years. So we've been able to demonstrate that the companies we enter, there is a lot of value add that the Masala platform is bringing to them. And the value add is objective, can be measured in numbers in terms of the growth curve that is open after the space. As a corporate wants, or as a company wants to get confidence, yourself also get confidence that your theory is to take playing out, and you can accelerate that a lot more, right?
Yeah, I think it's a tricky question because you can't really say that this much money is enough. Every sector has its own capacity to absorb capital. If you look at the energy sector, it has tremendous scope, and a lot more capital is needed as compared to typically what digital ecosystem requires. So there is no one size fits all, and our approach has always been that it depends on what we need. Is it just talent, or is it technology talent and an operating business? And at what stage do we need it? For what sector do we need it? And what are the priorities over the next 3 to 5 years? And then sort of capital allocation is done on that basis. And everything happens off the balance sheet, so there is no a separate fund entity, or then obviously one is an LP in other funds, and it happens through that process. So there is no formula, or there is no fixed. I don't know if that answers the question.
I was just trying to pick some range. I'm the numbers guy, so virtually everything rolls up in numbers only. But there's a numbers guy sitting right at the end.
So I would probably agree with both, right? It is dependent on the company to company, right? And what your strategies and how you're looking at it, right? But to me, the way we see it is for us, it is more of fueling the whole ecosystem. In the 3 different programs that I was speaking about are less, frankly, about money, because look, capital at the stage where these businesses are is capital will come, capital comes, right? I think it's more about the support of the ecosystem and the mentorship and partnership that you bring to the table. For us, that's the Ship Rocket has like on its own platform close to 75,000 digital sellers active in a month. We bring the power and understanding of that to the players that we work with more than the funds, and that's the way we feel. Having said that, if there is something which is more on the acquisition side of things, that's a very different subject, and that will depend on the company to company, and frankly, like what I said, if there is a right objective and a right meeting of minds, capital in today's startup world, capital flows. If you don't have capital can be raised. So that is for me is an easier problem to solve.
Sure, thanks. I'll kind of just here take 2 minutes to kind of pause and just talk about one small use case with Tanmay. especially. I know, I mean, I have to congratulate you on the recent deal on Exo, guys, that you did. It's out in the news, so it's no longer confidential. So I'm hoping Tanmay can share a few snippets about a little bit of how was the thought process, how did the whole AI-led platform, marketing platform that they were running, what was the strategic intent behind it, and how did the whole deal, whatever you can share with us on this.
Well, so our whole thesis of really powering and enabling commerce, I think there are 2-3 key problems that we see we need to solve. Right? So what is it that the businesses are looking to do? They are trying to reduce their cost per transactions. They are trying to improve the customer conversion cost. They are trying to get deliveries more efficiently, and they therefore in this process are wanting to enhance the trust of the brand that they are. In this meeting, this whole objective, while we have Profit is engaged in this whole post-checkout phase where we are powering the delivery, shipments, etc. Bigzo fit in beautifully in terms of being able to give a ready tool that all the digital brands can use for their reducing the conversion cost, because they are that's the key big business problem, and therefore we saw a clear straight synergy there, because if there is, our goal is not for example shipments or fulfillments. Our goal is how to reduce cost per transaction. So as Shiprocket, what are we doing? We're trying to reduce returns. We're trying to reduce cash on delivery. We're trying to eliminate fraud. We're trying to do quicker deliveries. This is solving a greater problem. And if you see from that lens, Bigzo fits in beautifully. Yeah, so that was the rationale, and I think obviously more than that, we love working with the founders, the whole fit, the whole their strategy, their thought process. There was a very clear alignment where what we were wanting to build together, and we said, okay, great, let's work together. So that is how it was.
I think that talks about the whole strategic intent that corporates take, when they're looking at any deployment of the balance sheet. Right? The balance sheet is pretty much to the objectives of the organization, synergistic, and that typically helps in whichever way. I think in-house is possible, but I mean, how difficult, any of you can take this, but how difficult it is to nurture talent within a large corporate. Because I've often heard this, I've been part of large corporates in my life earlier. How difficult it is to nurture new talent in the company itself. Like, you're already a behemoth, you're already an elephant in the room. How do you really promote innovation within the company vis-a-vis obviously looking at startups? And that's the reason why some of the corporates probably take this as the second resort, but not the first resort. So first they've tried innovation internally, probably they failed, which is why they are looking at it. Is that the perspective, or is it different? Like, am I missing something here?
I think, and this is rapidly changing in the ecosystem, where there's a lot of decentralization that's happening even in management style. There is a lot of ownership being given, to teams, to product teams, to business teams, to drive results. And entrepreneurship is also, something. It's a big idea, but I don't think that it's been fully explored in India as yet. And I think that's in the making, because finally, how many startups can be potentially invest in and absorb, right, or acquire. At some point in time, your internal culture has to be such that it has to work on its own, right? So I think we are moving towards that, but again, that is still a work in progress. But rapid decentralization and driving an ownership mindset is the only way to do it.
I think it's a lot to do with mindset, and it's difficult, but at some point it becomes easier, and that's how people will take it. So one question to maybe all, and this can start. So what do startup founders, when you talk to them initially, obviously the transaction takes longer, how do they view the whole corporate association? Have you faced, like in your own journeys, each of you, have you faced any hardships when you really wanted to do the deal, it's not really coming to you, the guys are anyway talking to venture funds as well, you are positioning your corporate as saying, fine boss, come with me and I'll add a lot of value. Has there been a challenge in terms of closing a deal and eventually probably you lost it or not important, but some of the challenges that people face in that journey? Any experiences?
I think founders are always worried that if a corporate comes in as an investor, it will become a strategic positioning, and therefore for them to raise independent capital will become difficult, and they co-align with the corporate itself at an early stage. So many founders I talk to will often tell me, boss, don't grab the check from Masala, you personally put it in, right? So I think that is a concern. You have to demonstrate that you will have to talk to the friends like the friend and be supportive of it. And that can only be established over a period of time.
No, I think that's exactly what needs to be done.
Yeah, actually, what I've noticed is that entrepreneurs today are not so concerned about the value of the transaction as much as they are concerned about the long-term value of the association and how they can get that, right? So it's not just an event; it's a lifelong journey, and they have to be completely comfortable in working with you in your ecosystem. They have to know the people, and there has to be ideally a pre-existing engagement. And those are the kind of models that work the best. So one of our successes has been Find, the company Find, which is very much from Mumbai. And they in fact built their first product, that was incubated by Reliance Brands. And that's how the engagement for them started, and the transaction happened much later. But by which time they had enough time to understand the ecosystem, so that always helps.
I think that's a fair viewpoint. Sanjay, any takes on that?
Well, I guess those are the 2 points. Frankly, the comfort of working together, right? Basically, and how we see the long-term value. I think when we talk, I think the biggest thing where you try and draw, the third thing that you try and discuss and understand is, there is this whole meeting of mind that there is value other than money, but they can go and raise money because there is from the people who are specialized in just offering money. I mean, we are offering an ecosystem. And that's where the whole intrinsic value is, and that's where the whole conversation is for us, and that's where the whole discussion is. That's the value we bring to the table, and that's where the engagement is.
No, fair point. And one last question before we let you go. Any preferences in terms of the stage that you guys want to look at when you talk to startups, when you evaluate? Do you have minimum filters that it has to be has already done seed, at the pre-series A? There is a mature team in place. It's not just the founders. Do you really need a team always below the founders? Are there any filters of that kind? If any, I'd love to know that.
Yeah, we are definitely very clear now that we are doing growth stage only. And because we figured at the incubation level, unless you have a proper incubation structure to manage it, you just can't focus on it at all. Yeah. So we are kind of stage agnostic. It depends on the opportunity, but we're very founder focused. Because end of the day, it's more about the founder talent and what we can do together, right? But yeah, pretty much stage agnostic.
For the ecosystem building, I think we really in the seed stage where we are looking at larger number of 20 digital brands that we really support in the spring. I think the rationale is similar. We are beyond the proof of concept and we can work together to grow. And obviously at that stage we see there is a lot more synergy where you can actually bring the value of our ecosystem to really accelerate their growth. So that's how we focus on the ecosystem. Of course, for the examples of initiatives that we spoke about, they are largely.
Because I think Amay's point I do relate to, because of corporates think that when they step in early, they are able to nurture the founders the way they have envisaged the company to be, and founders maybe don't have the resources to do it, and which is what the corporate is going to provide, right? So earlier the better, but that again has its own challenges, as Nitish rightly pointed out. Well, thanks. I think it has been an engaging session. We have to catch up on the time for new sessions as well. But thanks again. I think Amay, Tanmay, and Nitish, thanks for making it. It's lovely insights provided by each of you. Any last notes?
Thank you. It's been great talking to you. Happy to, but overall, I think I'm very on the topic itself. I think we think this is something that's going to grow, and we are very passionate about it, building the ecosystem. So I would just reiterate that we think this whole momentum is only going to grow.
Sure. I think thanks a lot. Thank you. I think we'll invite Vinod for a small. This is right here actually.
For our very last panel today, which is Angels and Sharks, Big Ideas in the Age of Small Investments. This panel discussion will focus on angel investing and the pivotal role it plays in bolstering the startup ecosystem in India and its contribution to drive the real economic value of the country. For our panel today, we have Aarti Gupta, who belongs to the promoter family of the Jagran Group, where she heads the investment strategy and is the chief investment officer at DBR Ventures. Currently serving as the national head for FICCI Flow Startups, an ecosystem that supports women founders and funders. We have Paula Mariwala, who is the founder partner of Aerolis Ventures, which invests in technology-led early-stage companies, focused on creating impact at scale. She's also the founder and president emeritus of Stanford Angels. We have Aditya PT, who is the managing director of the PT Group. Over the years, he has structured the business into 4 verticals, namely realty, consumer, media, and logistics to fuel growth and to establish better synergies. Lastly, we have Dr. Aniruddha Malapani, who is a world-renowned IVF specialist and also the founder of Malapani Ventures. He has won over 20 gold medals during his academic career and is also an active angel investor. This session will be moderated by Padmaja Ruparu, founder partner at AIN Fund and co-founder and president of Indian Angel Network. She is recognized as one of the key players in the Indian entrepreneurial ecosystem and is featured by the likes of Forbes and Business Today as one of the powerful businesswomen in India. I welcome all the speakers as well as Padmaja to take this. I think let's just give her a minute. She'll just join us and then we can.
She's busy closing a deal.
I think we'll be so successful.
That's the right thing to be doing rather than sitting in the center panel, right? Yeah, let's just avoid that. That's a modernity.
I think we
It's a valuable lesson to be learned how Padmaja staged her entry. So you make everyone wait in suspense and then you come in. Guys, there are entrepreneurs in this thing, right? You should be learning from her.
Sorry about that, actually. We were in a conversation and lost track of time. Shall we start? Yes. Okay. So, first of all, thank you, Sanjay, for a great event. Congratulations. And more than anything else, you started the networking rolling. So, I think all of us are getting FOMO of doing our networking evenings. So, thank you and great job, team 100X. Sorry. So I have a very challenging job here. Everybody on my left are people who are very experienced, wise, and they have succeeded in investing. And I'm sure each of them have some failures as well. So this is going to be a more of their talking rather than me talking. So that gives you a heads up that get your thoughts ready. So the way we were thinking we'll structure this is I'd like to invite you to talk a little bit about yourself, but more importantly, what you've seen in your investing experience or years of investing, divesting, and especially I want to focus on one piece, which is something that we are all hearing a lot about, and I think there are very varied opinions, is valuation versus value creation. Right? So we all know the valuation piece. There is also a piece that is on the value side. There are traditional businesses that we all see, which look at top line and bottom line and some other value additions. And then we went through a phase, and now are we coming back to a different flavor of investing companies and building businesses, how we view them, what are our perspectives. So just to put a little bit of focus so that we are able to share a perspective which maybe is unique to this session more than anything else. So I'll start from my screen left, Arti.
Sure. So we start, I'll just give a little bit about, talk a little bit about myself. So I belong to the promoter family of the Jordan Group. We have interests in media, communications, forestry, and real estate. And I head our family office, which primarily started off as any typical Banya family office, primarily in MD. And over a period of 12 years, I've tried to move it from FDs to listed space, and now we've, in the last couple of years, introduced venture startups as an asset class. And it's been a very interesting journey, because when I started investing into startups, it was just to diversify. It was an asset class diversification. But when I started meeting founders and started seeing the kind of work which is happening, I really got sucked into it, and but also realized that this whole space is very, very overwhelming, and there is having just capital is not enough. There are too many startups looking for too much money, and at the same time, there's too much money chasing the good startups. So just having capital was not enough. So took some time, but slowly realized that purpose and value is extremely important. To realize what is your purpose, why is it, and obviously all of us are investing for those higher returns. But in addition to that, and what is the value as an angel you bring into this ecosystem? So that's been my little short journey into this space.
You sound more like an angel.
I am an angel.
Okay. So I'm going to flip to Aditya, if I may. I'm just going to flip.
She caught you unaware.
Correct.
Yes.
Just a couple of quick lines about me. So I'm actually an entrepreneur. I have a consumer distribution business and a media business. Became an entrepreneur 6 years ago, and since then, I've scaled our businesses to new heights, and I'm looking forward to doing a lot more. That's a quick two-line introduction. But coming back to the point that why the panelists come together, you speak about value versus valuation. I think it's interesting that you did that, because at the end of the day, the word valuation comes from value. Right? So I think this whole debate about valuation being more important in certain businesses versus actual value, I think it's a little debatable, because I think the inherent valuation of a business comes from the value it generates. Obviously, in certain businesses, the gestation of that value creation can be longer. But I think that, I think whether you're an angel or a VC or a CVC, or any level of investment, I think you have to look at real value if you have to, create valuation. So I think that's one of the topics that I think you were raising. I think from my experience in some of the few startups that I've invested in, I think that I personally prefer a slightly more shorter gestation rather than a longer gestation. But again, I think it depends on the nature of the business. I think if it's extremely innovative and more about invention and where the product market fit is not necessarily available at the moment, but you may see some long-term value where the founders are ahead of the curve. I think there's value in that as well in the long term. And then obviously, and for VCs, I think they have a mandate, they have a return period, and I think some of the so they obviously have to play within that mandate. I think with some of the family offices and angels, we have a little bit more flexibility. So I think those are some of the points I think when it comes to value versus valuation.
No, good point. And if I may sort of make it a little interesting, when I was just looking at you, I saw the screen at the back. It's talking about angels and sharks. And all of us are investing in equity, right? We are investing in shares. And therefore the price per share becomes a valuation issue, right? And our business as investors is to get returns. The company's business is to do whatever it's doing, but our business is to get returns. So are we sometimes charged to push the valuation up because we have our own returns? And in case of VCs, it becomes even more aggressive because of the life of the fund, etc. You want to go for it?
Sure. Valuation is what the investor wants.
Paula, introduce yourself.
Sorry, I can Paula Mariana. I've been a VC as well as an angel, so I've been part of trained as a physicist, became a business woman in deep tech, and then crossed over to the other side and started a VC fund back in 2006. Ecosystem was very different at the time, but I've been a VC, and then in 2015 I started Stamping Angels and Entrepreneurs, which is an angel network. So I'm very much the angel, not the shark. But having seen both sides, three sides actually, as an entrepreneur, a VC, and an angel, and now I have my own family office where we do largely early stage, but also some late stage, Series A+. So across all this and across these 16 years or so that I've been in the ecosystem in India of venture capital, and I've also done a lot of work in the Bay Area. But I think this is a very common topic that one has debated over the years and over geography. I've been on panels also at Stanford or in Bay Area, the same thing is being debated. As investors, we are creating valuation. As an entrepreneur, we want valuation. But in the end, the valuation is what the investor gives. So I think we take the responsibility of creating valuation as well as the hype around valuation. The valuation is created because we believe the entrepreneur is going to create value. If we believe that it is because we will get a higher price per share eventually and we will be able to return capital or get our multiple, I think that's a fair belief. We should push for that. However, in search for valuation, which really drives the next round of valuation, we completely lose sight and we make the entrepreneur lose sight many a times of the fact that we are really betting on this. We're putting our money or our investors' money to create long-term value. And however quickly you want to create a unicorn on paper, in the end it is a distribution. It will come only if you really created a value, it will come. So while valuation is derived from the word value, I think what is valuable is not valuation. Because valuation is fixed in time. Value is over a period of time. So, long story short, we need to focus on both because, like you said rightly, we need to focus on what price per share we will get. As an investor, particularly early stage investor, whether as a VC or an angel, I focus on the entry valuation because that is going to change and rest is all on hope. We will all dilute, so will the entrepreneur, so it's all important to get in. But I often say that's like your 8th grade report card, which nobody really remembers. It's your 10th, 12th grade, your exit valuation, which really, honestly, will only come through a created value.
So what you're saying is valuation is on paper, but it's when you get the cash in the bank that you create value for yourself.
If you create value for yourself, you will get cash in the bank.
Anirudh?
Yeah, hi, I'm Dr. Anirudh Malpani. I always tell everyone when introducing myself, when my wife is not with me, I have the best job in the world. I get women pregnant, and their husbands pay me to do that for them. So my full-time job is an IVF specialist. And I actually, one advantage of having white hair is I've been an investor for much longer than most people here. This was in the 99 dot-com boom days. I don't know whether maybe some of you guys weren't even born. So we've seen a lot of these cycles come and go. And sometimes people ask me, why is an IVF specialist an angel investor? And I actually think IVF specialists make great angel investors for multiple reasons. For one thing, a lot of IVF cycles fail. In fact, most IVF cycles fail. So we're used to dealing with failure. We're used to dealing with multiple attempts. We're used to telling people, hey, this is going to be something which takes time. So I think that's helpful. And just because one cycle has failed or one startup has failed or whatever else, there's no reason for you to give up. There is success around the corner. You need to be persistent, perseverant about it. I think the second thing is, as an IVF specialist, we were one of the first IVF clinics in India. A lot of what we did was patient education, because no one even knew what IVF was. Oh, where do you get these eggs from? We've actually made them in test tubes. Might sound funny now, but at that time there was a lot of it. And I think that's equally true of the startup ecosystem. That we spend a lot of time, often because we're writing the first check. These are first-time founders who really don't know much about what is involved with valuation, how do you create value, what your long-term perspective is. So we spend a lot of time on educating them, and we think that's important because we don't think of it as a transaction, it's a long-term relationship. We think if we spend enough time and energy creating that long-term relationship by educating, that's going to help. I also think as an IVF doctor, I am an entrepreneur. I have to run my own practice, and one of the things we take pride in is taking care of our patients and making sure our patients are delighted with us. And that's something we emphasize to our entrepreneurs. I said, yes, I may be an investor, but I should be fairly low down on your rank of priorities. As long as you delight your customers and your users, everything is going to fall into place. So I think these are all the reasons, and I think finally, I think as a doctor, you're taught to be empathetic. You're taught to understand what it's like to be a patient, what it's like to go through the pain of not being able to have a baby. We understand a patient's emotions. And trust me, an entrepreneurship ride is full of emotions. There are the highs, there are the lows, it's a roller coaster ride. But because as a doctor, you're taught to be empathetic, I think you can use some of that empathy when you're talking to entrepreneurs and explain to them. And I think we must emphasize that angel investors are not poor cousins of VCs. Because a lot of first-time entrepreneurs don't understand the difference between VCs and angel investors. Angel investors, we're putting our own personal money in, which is great. Because the way we look at life is very different. Like you quite correctly said, VCs have major constraints. They need to be raising the next round every 3 years, 4 years, lots of issues. As an angel investor, the only person I need to answer to is my wife. She's been married too long to me now to, give about whatever happens. To question about, and so I have no success stories worth talking about, and she's okay with that as far as the angel investing piece goes. But you know what? I don't measure my angel investment on a financial return on investment. I measure it on a learning on investment, on an emotional ROI. And that might make sense or may not make sense, but I think beyond a particular point where you have enough money, you're looking for stuff a little more beyond. And as an angel investor, I think I have that luxury. So it gives me great pleasure to be an angel investor. You get to hang out with young entrepreneurs, bright, intelligent, full of hope.
No, I must say, Anirudh, I learned something today, a different perspective and a different metaphor for angel investing. And I'll remember it. If I ever have to change or switch careers, I'll come to you. But you're very right, and I think this is something I would completely endorse. One is that when you invest, yes, there is a focus on returns, financial returns, and all of that. But I think the bigger game is really to the learning curve. I mean, think about it.
each of us have to go and learn the sector that these entrepreneurs come and pitch to us. It would take months and years to even read and research. But here are these entrepreneurs who are actually collating all the information, collating all the research, putting the data together, slicing and dicing it, and then presenting it to us in 45 minutes. I mean, it's the best learning capsule that you could ever get. And then they lace it with their own disruptive thoughts, innovative thoughts, to say how they can change. I mean, I can't agree with you more on that one, to be honest. For a change, I agree with you. That this is
Very few people agree with me, so I'm glad I'm on this panel and you agree with me. Thanks.
No, I think that's a huge learning that actually excites one to be in this. But I think the other piece that we have seen, just to add a perspective, is one is while we create value and valuation, I think what we've seen at Alien is value preservation, right? This is an asset class which is so high risk. I mean, it's the highest risk asset class that one can ever think of. And that's exactly why it gives high returns if it succeeds. And a lot of family offices, HNIs, and VCs punt on that, right? But what we do, we look at it slightly differently and we say, how can we create and preserve value and increase it by risk mitigation strategies? Because I think that's the other way of creating, ensuring that you're getting successful hits and not too many failures, because failures can be a very high number in this space. So we've adopted a very different strategy. I shouldn't say different, our strategy, because I'm sure some others will be doing the same, is to look at a very well thought through risk mitigation strategy for each of the investments that we make. And as we build a portfolio. So be it in terms of how we invest in different companies of different sectors, different geographies, different stages, whether they're post-revenue, whether they're IP, I think that allows us to create a much better portfolio, because and that's reflected by the fact that we've had about 15-18% of our companies fail. And that's a pretty low number compared to what we have seen. And the other piece that I think IAM will see, which is to talk about a little bit of more on the non-valuation part, is to always be talking about gross margin, unit economics, and therefore we've been a piece, a platform which is, whether it's a fund or an angel network, which is looking also at paths to profitability. So that's been another piece on the value side, just to give a sense. So that is what I thought was also important as we speak to this audience to say this is what we thought.
I think sometimes we need to ask entrepreneurs, are we as investors really adding value to your life? Or are you the guys who are adding value to our portfolio? And I think sometimes maybe, the view from the other side of the table might be slightly different. Because I think all of us, at least I like to think of myself as being a non-inclusive investor who's giving the entrepreneur the freedom to run his business because he has the domain expertise. But I'm sure the perspective must be slightly different. I wonder sometimes.
No, I think we had such conversations, and I think Paula would see that much more than me.
Yeah, sure. I think when you have a whole portfolio like an IN has, or VC fund has, or even an individual angel, and I think it's very important for an angel not to have one or two companies, right? Because by nature you must have a certain percentage of failures, and then you must have your bell curve and slice out not only in terms of returns but also in timing. Because as we all know, we all punched all our investments in 2008 or now or whatever, you would have all sort of not had the same thing. So having a portfolio, having a diverse set of entrepreneurs, and I want to really bring in the software aspect of being an angel, because I want to also be mindful of our topic, which is angel and shark. And I think the shark is a glorified version of angel, if you please, because that what adds a little bit of a gusto to this whole thing. Actually, being an angel has a lot of empathy, is very important. But I think what's also important is being a true mentor without really asking the entrepreneur. And that's a fine balance. So like she mentioned, we must point them out to unit economics. Most of the founders, and that's why we fund them, are very passionate. They're very passionate about the product, who want to build something. Usually I find very mission-driven entrepreneurs who want to change the world, but we have to guide them to say, after all, business 101, right? What's the path to profit? What's the guarantee you will raise the next round? So we get caught up in the fundraise and hence the valuation. I think where as good angels, early stage investors, we can play a role is to really keep them on track of building something. And I think most investors really at early stage like to learn. I think we also like to see something being built. And that's where I think we need to be a good investor, give the money, but also give a hand.
True. And I think what you're saying is very true, that for investors it's also very, very important to keep the differentiation between captain versus coach. Angels or investors are coach. They're not the captain. It's the entrepreneur, the founders who are really backing on the field, and we are being able to just keep the focus in people. But your point about entrepreneurs, how do they perceive it? Opening this up to come to Aditya, so that how do you perceive it? You're building your own business, and you're also investing. You have both perspectives.
Yeah, and thank you, because I do actually have a different perspective than what they're saying. So I think in an organization that's already slightly mixed scale, you have, say, as a founder or as a leader, you have a leadership team, right? And they are usually your sounding board. So, for example, in my companies, if the leadership team feels that I'm making the wrong decision or they feel differently, they are sort of my sounding board, right? We have a discussion and we have a debate, and then obviously not every decision is right, but at least it's well thought out and well debated. I think in the case of when I'm investing, actually I don't want to be angelic. I think I want to be the person who's asking the tough questions. I think I want to be somebody who's trying to poke a hole in everything that they're assuming. And I think I want to be somebody who's the devil's advocate, somebody who's who comes across as objective, and somebody that they can come to when they want to make a tough call or when they need to be sort of told that they may not be making the right decision and be given a different perspective as opposed to always just being encouraging. Obviously, the emotional quotient has to be there, where you need to respect the founder's original idea. And I think it's interesting because not many of the most successful startups, if you look at their original pitch deck to what they are, what business they are in today, you will see that it's completely different. So I think in that journey, I think investors and in larger companies like for example, my board members, right? They always make it a point to question, what we're doing, even though they may not necessarily have a strong reasoning to do that. And I think as an entrepreneur, as a leader, that allows me to take a step back and make sure that I'm, an introspect to make sure that I'm doing the right thing, at least at that moment. So I think I would like to add a similar kind of value to them.
So then we come to Arti. Arti, you're investing from your family office. You're also investing with a group, so you're investing in diversified sectors. You built a portfolio. So what's your perspective? How do you interact with entrepreneurs? Which ones do you choose to invest in and be a passive investor? Why does it? How does it work for you? You're the perfect person for a lot of family office guys here.
So, Padmaja, at least my belief has been that once you've met the founder, you've invested, you've done your initial due diligence, you've asked those questions, you've made the decision and you've invested into the company, then for majority of the time I leave it to the founder to reach out to us to ask for help if they need. So I let them know that we are here for you. If you need a sounding board, if you need a mentor, or if you need network connects or whatever you need. In addition to that, you have those monthly, quarterly meets where you get to ask that tough question. But like you said, we are not the captain of the ship. This is not my vision which I'm trying to fulfill. I'm kind of aiding and helping that founder realize their own vision and helping them, that company come forward. So that's been our policy about how hands-on we want to be. The choice is up to the founder on how hands-on does he want the investor to be. And that's the beauty about being an angel investor as well, right? That you have the patient capital and a mentor.
So, you've been investing for 20 years. I'm sure your portfolio, there are successes and there are not so good successes.
Most failures.
So, and that's fine.
like I said before, I'm a big boy. I understand that this is a complex adaptive system. I understand that most people are going to fail. I'm very happy to invest in one of my entrepreneurs who's failed earlier and then wants to start a second startup.
If you're seeing a company which is failing, right, in your monthly or your whatever your frequency, maybe quarterly, if you're seeing a company go south, do you itch to get in? Do you get in? How much do you get in? I mean,
I don't tell my kids what to do. They're grown up now. I would never tell an entrepreneur what to do because honestly, if he's going to listen, he's going to listen. If he's not going to listen, there's very little.
Founders out there, he's your man.
No, wait. It's not that simple. I always tell people, I just had the easy job. I just signed the check. The due diligence is done by the team. And they're the ones who will ask all the hard questions, play the devil's advocate, all that stuff before we sign the check. After we sign the check, yes, it's not like we're hands up our feet and jo karna hai karo.
So the check is on the basis of reps and warranties, which the team has to decide. Founders, yeah.
But even afterwards, when it's like this.
Yeah.
Before you sign the check, the entrepreneur is a different animal. After you sign the check, the entrepreneur is a different animal. And we're big boys, we're willing to accept that. We're hoping that we will be able to identify entrepreneurs who remain the same after they've got the check from us. But in reality,
what you're saying is that before the check is signed, entrepreneurs are angels, and after the check is signed, entrepreneurs are sharks.
I love the way you're mixing the metaphors, but honestly, I think some of that is true. I'm sure you've been through some of that. The thing about investors and sometimes about entrepreneurs is you don't want to call out in public some of the people whom you've had bad experiences with. And I think sometimes that's a tragedy because people who've shafted investors once will shaft another set of investors the second time and you don't call them out. This is actually how the entire startup ecosystem starts getting a bad reputation.
But on that note, Paula, you've been around the block investing as angel, as VC. And let's talk about some of the reasons why some companies have failed. What are the key reasons and how do you start detecting them early? And what are your steps?
Well, that's a great question. So, when you have a large portfolio, a lot of stories to talk about, and a lot of them are like this, that they started to fail. Very few, don't you know, right? And very few, though, are the ones which have gone down and then they're selected. And that's for also a variety of reasons. And that primarily is the resilience of the entrepreneur. And I must say, a supportive board, which is whether from investors, advisors, whatever. So, to your point, I think definitely as a responsible investor, when you coach the entrepreneur, if he or she is willing to, I think the reality has to be brought in front. I think the companies which have failed, if I can pick a common reason across most of them, is because they're in denial of what is happening. They don't realize the business model is really not working. My customer doesn't want. The company we were talking about, the entrepreneur just wouldn't believe that the customers are never going to pay for this, and they go on without changing course. So early course correction, as angels, as early stage companies, I think early course correction can prevent this. But what happens most of the time is we all also fall in the false sort of a hope that, oh God, 100th customer will come, though you're only at the 5th customer, but you keep sort of, because you believe in the entrepreneur too much. I think if you're a good investor and if the entrepreneur is responsive, then I think you both have to really come to the conclusion certain things are not working. Usually it is you're solving a problem which really doesn't need your solution. There is no customer adoption. So you have to, the real stakeholder is the customer who's going to pay or who's going to adopt your solution. And most of my companies which have not done well, early on, we've seen that this is not working, but you sort of let them try. At some point, you have to bring it, you have to be hard. And like you said, you have to ask the hard questions and then ask, nudge them to an alternate strategy. And usually the entrepreneur box, and you need to, help get him out of that and see course correction. Now, the 4 companies I can think of which have done exceedingly well in my portfolio had all gone down, primarily because of external reasons. 2008 happened, e-commerce things were not working out. But they responded to the changes in the ecosystem. And you have to help them at the time change your milestones, that expectations from them.
No, true. And I think to your point, honestly, for the last 2 years, pandemic years, I think has been a very, very tough period, specifically for very young startups. Because they don't have a cash runway, the whole ecosystem collapsed for them. Customers suddenly disappeared. So it hasn't been easy. And I think that's where some sort of support to the entrepreneur, just guidance, because it was a real gut impact to them. So Aditya,
Yeah, so I wanted to just add,
perspective.
no, I just want to add one more point. I think it's a little tricky, just to sort of try to summarize a little bit, because when you see a founder and a young entrepreneur, you want to see conviction. So on the flip side, if you are going to, when you're being devil's advocate or you're questioning the business model, and if you have a founder who's constantly wavering on what they want to do, and perhaps take your advice even too seriously, then that's also a red flag. So I think to sort of balance this debate a little bit, I think that it's important that like Shivek said, that to have a good balance between the two, because you don't want an entrepreneur to be changing his strategy very, very early or too often. But that's also something that I think can be a reason for failure.
So you want an entrepreneur who's mentorable but who has a backbone.
Yeah, and I think it comes with maturity, I think it comes with age, and that's why sometimes you see younger founders struggle a little more, and I think that as an entrepreneur, I think that you may be extremely high IQ, extremely talented, very good developer, but I think that certain things can only come with age, honestly, and I think that so it depends on who the founder is, what the experience is. That's why you see, and one of the points that we wanted to debate was, if I may, was about how to arrive at that value, right? And I think moving into that part of the conversation, I think that the credentials of the you see a lot of founders who are 40 plus now, right, and able to raise much faster capital and higher valuations. So I think you have to sort of balance the two in that sense, and then decide from there.
But on the earlier point, I think you want entrepreneurs who are persistent but ready to pivot, right? I feel that sometimes entrepreneurs operate in ceteris paribus, they are so focused on their own thinking and their idea that they forget that they assume everything around is not changed. They kind of lose track that their business model needs to evolve, and that's the reason a lot of times startups fail. So that's at least something which I have noticed. So you want entrepreneurs who are ready to pivot and don't believe in this ceteris paribus.
And if they're younger startups, then they also need to understand that just a product is not enough. They need to have a business.
No, absolutely. And I see a lot of it. I'm an alumni from IT Control, and I work very closely with their incubation cell. So I see a lot of it from startups coming out of your IITs, that they're so focused on that product, that they don't see the business behind it.
True. And that is a real hard climb for them. Anil, you wanted to share something?
I think also as investors, we need to earn the respect of the entrepreneur. If the entrepreneur thinks of ourselves as bean counters and they only care about an MIS, they only care about numbers, they only care about top line and bottom line, he's not going to respect it. Whereas if you've taken the time and trouble to understand the operations and the levers of his business, what his key metrics are, what his North Star is, what he should be focusing on, and we preferably do that before we sign the check so that we understand what we're getting into, so that just like we need to earn his respect, he needs to earn ours as well. And that's where the relationship comes in, where he understands that we're adding value. We're not just focused on money and vice versa.
Yeah. And I think that's where investors, angel or VCs, they spend a lot of time before investing. And I think the other piece that they spend time on is chemistry. I mean, for young startups, chemistry between entrepreneurs and investors is very important. You want to first of all make sure you like the look of the guy, otherwise nobody's going to listen to each other. So I completely agree. Paula, you had something to share?
No, I actually was going to say the same thing, that it's early stage investing is not so much about the math, because math is really a hope. It's all about chemistry and alignment. So as early stage investors is a little bit different than a late stage. But if you harp too much on the math and the first business model that you bet on, you know that it's actually going to change. I mean, the 3-year projection has been nothing, by and large. In my 15 years, I don't think any first business plan has actually delivered the same, even for the next 2 quarters. So I think we have to be very aligned with the fact that, and you usually want the winners that you want to bet on or you get excited about are sometimes in sectors we don't even exist today. When we did Red Bus back in 2006, 2007, I had no idea what bus ticketing as a sector was. When e-commerce started, nobody who's going to buy books online. So you're betting on sectors that you don't have data on. So where are the numbers that you can say, okay, X% of this can. So it's really about chemistry. It's really about understanding the commitment of the founder, and like you said, you need resilience in the founder, but you also need that conviction in themselves that they will go on with this no matter what. So I think the role of an angel, if you really want to be a good early stage investor, is that of empathy mixed with a really sharp acumen to see where this company is headed. And provide a balance in terms of people.
I'm just going to stop here for a minute because, we have people here who've been investing from 1999, 2006, and now I don't even wager how many years you've been investing over here. But we have almost 50 plus years of investing sitting on this table, just like me. So, is there anybody out there who would like to ask them anything, because this is a great time and I'll still continue. Anybody? You're very fortunate.
We put them,
founders pitching to you.
no, we put them all to sleep. What else can I say? Yeah. All we did
all the questions. We answered all the questions.
I like your optimism. Better.
No, but what I'm finding, no founder has pitched.
I thought they'll come to get a check from Dr. Balka.
So anyway, how much time do we have to? Oh, okay. 1 minute over time. So we have a question.
I have thought a lot for entire debate about how to go about investing successfully, how to pick the founder. But can anyone of you share about your experience in a startup that did not work, which you had like high expectations, just like the founder, like the market, that is smart, but somehow just went south?
We have high expectations from every company that we invest
Yes,
in. Let me make that very clear. But let me sort of question, Paula,
I mean, 85% actually don't deliver on what you bet on. But I'll give you an example of a company which was really, we raised Series C very quickly actually. And after that, something went wrong and we were not able to figure out what. So I think what happened is it was an e-commerce space and it was a vertical e-commerce, much like a Nykaa is doing. It was ahead of its time because everybody was going on a platform approach. We tried to pivot to a platform approach, put in more money, but we were late to the party. And that company which had actually was tracking top of our portfolio became the bottom very quickly, and none of us realized. And it was a combination of external factors, but also the founder, all the investors not recognizing what is really happening in the ecosystem. So it wasn't like a pandemic or crash. It was the ecosystem evolution that you didn't keep up with. Another company which failed because the founder just lost track of tracking the expenses. Unit economics went out of that. Yeah, these are very typical examples.
And what we've seen from your question, I think one of the major factors that companies have failed is the entrepreneur. He's just exhausted and just gives up. Because entrepreneurship is very difficult. It's very challenging. Every day is a crisis. There are very few days when you have a high. So I think on that note, I'm going to stop. Sanjay's right here, making sure we all get off the. Sanjay,
You've done a very good job. You kept us on time, so full marks.
Thank you. Thank you so much.
Thank you.
This is wonderful. Thank you.
This is second one.
I think we're taking away from that.
This is Thank you.
Finally, I would like to call upon Ranu Vora and Harish Mehta for launching Decoding the Market Effect, a book on the untold story of India's IT revolution, authored by Harish himself. Ranu Vora is the CEO and MD at Avendus Capital. He has spent the last 20 years in the Indian financial service industry, concluding several marquee transactions in investment banking and private equity. Prior to co-founding Avendus, Ranu worked with the Tampa Fund in the US, based on technology and media investment bank, communications, equity associates, and individual finance. We have Harish Mehta. He is the founder and executive chairman of Onward Technologies Limited and the director of the Indian Angel Network. Mr. Mehta was the driving force behind galvanizing the Indian IT industry by co-founding Nasecom, the IT Industry Association in India. He was honored by our very own Prime Minister, Mr. Narendra Modi, for 25 years of exemplary contribution to the Indian IT ecosystem. I welcome Harish and Ranu both for the book launch and today's words.
Thank you. Can everyone hear me? Okay, good. It's a privilege here to be here around the time of launch of your book, The Maverick Effect. So I want to kind of start out by asking you a question which, when I saw the book, the first thing which was there is the name of the book itself, The Maverick Effect. What does it mean? How did it come about?
So this book is about the untold story of how the fortunes of billion people changed. If you go back 35 years, India was known as a snake charmers country, a third world country. Today, we are all bullish about India's growth. How about that change came in? I believe that change came in because of the revolution that IT industry drove in India.
And IT industry could grow the way it grew thanks to Nasecom, is what I believe. And then I inquired about a few years back about what changed the fortunes of billion people. 1,000 years of downward spiral of India suddenly got arrested. And answers I found were very strange. Nobody gave any credit to technology industry. I read a number of books by bureaucrats, IBI governors, politicians. No one talked about giving any credit to technology industry. And so then I felt that this job has to be done, and I'll take up the responsibility of telling the public what I believe is the true, what I believe is the story, which is how Nasecom changed the IT industry, how IT industry changed India, and then within Nasecom, how Nasecom started, what were the initial struggles, and how it continued to change. And within Nasecom, we had stalwarts, large number of entrepreneurs who were competing with each other. But they worked on the Nasecom as a neutral, independent platform that collaborated with each other and made a change. So this collaborative effort of all these entrepreneurs using Nasecom platform, what I call Nasecom effect, is what the Maverick effect is, which changed the fortunes of India.
Fortune of India, it did change, and I agree. I think it gets talked about a lot less than it should be. So Nasecom as an organization, intriguing because the impact it had on India and on the IT industry was huge. I just wanted to ask you, what was so unique in the DNA of Nasecom? What was special about Nasecom which actually created, a foundation for the IT industry? Who were the chief protagonists, and how did it come about, and how did it kind of evolve and scale to something which has even maintained relevance today? After so many years, after the IT industry grown, it has still maintained relevance. So I would love to know what was in the DNA of Nasecom, the protagonists, and were there any values which helped it scale up?
Ranu, that's all in the book. There are a few chapters on it about what these various points are. Let me start by saying, going back in 1988, software was something to be given free by the hardware manufacturer. There was no value for software in those days. So for the software, that was software products. And what about software services? That just didn't exist. Software was not defined anywhere with the government, from IBI to any. Each had its own definition of software. And I put a number of stories in the book about what it meant to all of us in the business who were in technology industry. For example, you want to export your software on a floppy. Now the customs officer would staple the floppy. Wow. So now you understand that data is lost. So that was the knowledge of software industry or software services with the bureaucrats. Once an excise officer, excise tax was levied on software. So they argued to the excise officer, how can you have an excise tax on software project work? It's a development work, it's going in the milestones. I'm excited at the end of the all, not in between. He understood the logic. Then he said, young man, don't argue with me. What can be where you can put excise tax or not? The air you are breathing in, that also can be taxed by me. You want it 0%, I'll give you 0%. And he made it 0%. So those were the kind of challenges that our industry had. And at that time, we studied all the associations. Very clear that there were hundreds of regulations strangulating the software industry. And only solution was to have a platform to be created like Nasecom. So we looked at all the associations. I was a member of many of them from CRI, SOGM, ILC. We studied their constitutions. We looked at all the, you can say, pros and cons of each one of them. We had people like Ashan Desai, K.V. Ramani, Saurabh, Dr. Kanodia, and many others who were in the software. There were 40 companies in business in software. Mr. Kohli, and we all sat together and looked at the pros and cons and said, what do we want for software, for our Nasecom? And what are things And that's where major differentiations came in. The first major differentiation was we decided to focus on building the entire ecosystem of the industry, not just doing volume work. I used to be frankly.
That's by the way, a great definition. A great definition. Look at the ecosystem. I think a lot of people have forgotten that viewpoint, when they build these kind of organizations.
So that was a starting point for us to focus on it. Now, within the building the ecosystem, there was a major trust deficit between the bureaucrats, the policy makers, and the business people in general. They were very suspicious of us. No matter what you do, they would go back and tell us, the business people, they allowed Britishers to come to India. So whatever change we want, they will not just listen to us. So how to build a trust with the bureaucrat is where our major challenge was. And so when we started Nasecom, we asked all the bureaucrats from different ministries who were connected with us, finance, electronics, software, export council, they would come and attend our meetings without any invitation. They were open to come. And they were shocked. You want us to attend your meetings? Because the brand of business people was very poor in their eyes. They always want to buy, they always want to play, and so forth. So we started building trust. I'll give a great story about it. Today we talk about Russia. So it's a story about visiting Russia.
Yeah.
We had taken a delegation, the PMO had taken a delegation to Russia to promote both software industry and pharma industry. So when it came time, there were about 300 senior, you can say, CEOs of Russia in the audience. And from Nasecom side, we had Som Mittal, who was president of Nasecom. So normally he is the one who would give presentation to the outsiders or any other third party group. Then when Som looked around, he saw Harsh Malik, who was chairperson of Accenture India at that time, and also the chairperson of Nasecom. So he said, if Harsh is present, Harsh should give a presentation. So he approached Harsh. Harsh said, he looked around and said, Chandra, who is now the chairman of Tata Sons, that time he was CEO of TCS. He was present. He said, TCS is the largest company. Why not he give a presentation? You can see how people not grabbing their own, brand to take advantage of the presentation, passing on to somebody else which is more suitable for, let's say, India. They approached Chandra. And they asked Chandra, would you give a presentation? So without blinking, he said, yes, I would give a presentation. So then they said, Chandra, there are 4 your competitors' case studies in the presentation. Would you talk about it? Again, without blinking, he said, I'm speaking on behalf of India, and I would, and he did. So that's the difference probably between us and other associations. Keeping India first was the absolute priority, and today also same priority exists. There are many such values which I talk about in the book about how the Nasecom differentiated itself and why it still continues to remain vibrant and agile as we move on.
That's very inspiring and a lesson for a lot of industries because in this case it was stellar entrepreneurs coming together, giving time. All these entrepreneurs gave time, all the professional CEOs gave time to this organization and kept their personal brand behind and putting the country in front. Very inspiring.
I'll tell another story here again. One is that part. So in a conference room, you will have CEO of TCS, Accenture, IBM, Genpact, NIT, everybody in that room and discussing about industry issues. That was a very normal way of doing it. Like tomorrow we have retreat starting in Goa, again same way. You will have 35 CEOs of competing companies, fiercely competitors in marketplace, put it together and look at the industry issue, India issue, and discuss and come up with solutions and whatnot. Now seeing this, Forrester, who was the research organization in those days, later acquired by Gartner. So they also saw the way Nasecom is working. They were asked by the Chinese government, that we also want to build an equivalent industry like the IT industry in India. As you know, our industry earns the last 20 years has done $1 trillion of foreign exchange. Just imagine how many foreign
Let the numbers sink in. Let the numbers sink in. It's huge.
Huge. Last year we earned $180 billion, out of which is equivalent to what Saudi Arabia's oil exports are.
Yes.
And the difference is that oil export revenue in Saudi Arabia, their population is 3 crores, ours is 1.3 billion. Plus, in our case, the money flows through hundreds, thousands of companies in India versus it goes in one account. The big difference between the two. But you can see the impact this dollar earning to the country. Or you look at our industry today employs 5 million people. These are high disposable income jobs. Now, each high disposable income job creates additional 4 to 5 jobs in the society. So if our industry employs 5 million people, we end up employing roughly 25 million people. And that 25 million people, an average family of 4 or 5, whatever you take, we talk about directly and indirectly our industry touching the lives of 10% of India. And that's a huge change. 37% of them are women now. You can imagine the freedom that each lady or woman got by joining a company and the kind of change, cultural change they would bring in when they go back home. So you will, in fact, you will see 4 to 5 years. So China was seeing all of this. He said, why not we also replicate Indian industry?
So there was a city also, I believe, Dalian, or there was a city they created specifically for the purpose in
Gansu.
Okay.
So we were invited there by them. So there were 40 of us in the bus. And they showed us 10-story empty buildings, all done. Until like 15, 20 buildings. They asked each one of us, which building you want to take? For 3 years, take it, no rent, no charge.
Wow.
So that is the way they were trying to push it. The forest, they asked foresters to come up with a master plan to compete with or to build Chinese technology services industry to partly competing with India. And the foresters said, sorry, you cannot compete with India till you create Nasecom equivalent organization.
That's fantastic. What a validation.
That's the, and just imagine now that if startups world also creates equivalent association, and then whether it's Israel or whether it is China or whether it is Silicon Valley, you can take on any piece. But we need to come together on a platform and follow the Nasecom type of model for the startup world to go through.
That's again amazing. I wanted to take on one of the chapters in your book about a very specific event, which was Satyam. Now, it was a specific event, and I have memories of that because as vendors, we were also involved in selling Satyam when the scam broke out and it became a huge international and domestic problem. In fact, I remember the very first day I went to meet the board of Satyam, they told me that the erstwhile Prime Minister, Dr. Manmohan Singh, had got a call from the Premier of Australia, who told him that Qantas pilots, their daily rosters were created by Satyam.
Okay.
The ministers of Singapore, their salary payrolls were processed by Satyam.
Right.
So you can imagine the kind of furor it created, not just in India, but globally. So the one thing which doesn't get talked about much is when that scam broke out, the crisis of confidence, brand, and how did Nasecom come into the picture to retrieve something where one of the top companies in IT was getting tainted, scam tainted?
Thanks, Amali. It's a great story, frankly. I think there's a full chapter on Satyam because it's a story which has not been replicated anywhere in the world. It's a very unique story, and we are very proud of what we did for Satyam. So the day Raju's letter came out accepting his fraud, Som Mittal read that letter, and then he came back to Nasecom saying, should we do something? Now, as a neutral, independent organization, we don't want to get into individual companies' futures. They collapse, they collapse. That's not our job to protect them. But then we all discussed among ourselves. And we realized that if Satyam collapses, exactly the example that you gave of Singapore, or they were running millions of customers around the world would be on the road if Satyam collapses. And how do we prevent that? So we all agreed that we have to somehow find a way to keep Satyam alive and not leave these customers to run. And it was a tough call. So the first thing then Swam did was to talk to Mr. Gupta, who was the corporate affairs minister at that point in time. So he said, I want to come and meet you. Then he called Kamal Nath and some other ministers also in the meeting. And Swam presented that we need to save Satyam. So Kamal Nath said, "Bharme kya? हम क्यों प्रोटेक्ट करें? शेयर होल्डर्स को प्रोटेक्ट करना चाहिए ना, उन लोगों का जवाबदारी है, हमारा थोड़ी है वो सब करना." So then Swam says, "No sir, I agree with you. It is not, my job is not here to protect shareholders. I am not even here to protect employees' jobs. I am here to protect India in pride. If Satyam collapses, these are the repercussions. And about, maybe say we were at $75 billion, the industry would go down. And so many jobs would be available, X, Y, and Z. You understand? So then they say, come back after their internal meetings and whatnot. And they came back to Som again and say, yes, they have decided to sell Satyam. But then they talked to Mr. Bhave, who was the SEBI chair. And then they said, we need to bring in certain changes in the laws. And they have to call a cabinet meeting. It will take about a month for us to put our house in order to take over Satyam. So you please help us keep Satyam alive for a month. So we had a call. Satyam made a call. So 25 of us who were in the executive council, chairman's council, attended the call. Som said, here is what the government wants. What do we do? So we all agreed as a group to protect Satyam for next 30 days. We will not recruit the senior managers and we will not proactively go after their customers. At that time, I remember one of us said, this is marketing 101, golden opportunity for me to kill Satyam and great business for me. When will I get such an opportunity to take such a big business that it's so quickly? Why would I miss that? But collective wisdom prevailed. I'm assuming they didn't do much proactively for the next 30 days. By that time, government changed all the laws, brought Kiran Karnik as a chairperson for the took over Satyam, making a chairperson, Deepak Parekh, Mr. Damodar, who were brought in as an independent directors to find a way to save Satyam. Just can you imagine competitors seriously here a golden opportunity and still controlling themselves, behaving in a very mature fashion, and that's where the Nasecom differentiation was in saving Satyam.
Yet again, a great example of how collaboration prevailed over competition, and kind of the basic elements of trying to make it a small victory. Very few industries actually have been able to emulate that and being involved in such a process. India is very hard, incredibly hard, and Satyam became an example of how corporate scams globally need to be handled, given that it was concluded in less than 100 days, fewer than 100 days. The whole sale process, everything went through, and the reputation of the industry is retrieved. The biggest thing being that after the buyout, the situation still went well, and kind of Tech Mahindra did well on that. So, given that we are here in a very kind of esteemed forum with a lot of startups, entrepreneurs, and thanks to 100X for doing this, I wanted to switch gears and ask you a question around startups. First, the kind of startup themes you think are looking interesting in today's world for you as an investor. And I just wanted to also get any final views from you in terms of how does what you have included in the book and what you have put forward, I believe with 3 years of effort, which your daughter Natasha kindly mentioned to me, 3 years of intense effort. What is your specific advice to startups, from the book itself, from your insights in the book?
There are lots of lessons in the book, frankly, from leadership to business strategy to working at an association level, all that. So the number of lessons are there in the book. However, the one which I would like to highlight to all of you, see all of you are very young, I would like each one of you to spend 10% of your time beyond your own company and look at the industry and contribute. Whatever segment you're in. Even it can be a social area if you feel. if you want to build, change India now, we are at $2,000 per capita income. We need to create 100 million jobs. If we come up with a strategy to solve these issues, poverty, health, all that will become history for India. But that can happen only when all of us together again start spending time, have a strategy for India as a country from a startup perspective, and then focus on the areas that would help change. At the same time, make money.
That's amazing. So I just wanted to leave you with all the best wishes for the launch of the book. I believe it's pre-ordered already on pre-order basis. It's become a bestseller, and so
thanks to all of you.
Whoever can, please lay your hands on this book as soon as you can find. I hope you don't get fully sold out so quickly. And there is enough left.
Just a very interesting comment here by just few days back, Chris Gopalakrishnan, he read the book. And he called me, he was so excited. He said, Harish, last chapter of your book, you should print millions of copies of that. Give it free to colleges. All the young leaders of the country must read that. That will be the great starting point for them. If they start focusing on it and start contributing to the selflessness for the India's future, India will change dramatically. So that's the kind of impact this particular chapter hit on the kids, for example. But in terms of, so I would like this book to reach as many hands as possible, as many young leaders as possible. I would like, none of us read books these days. So please read chapter 11, last chapter of the book. If you like it, if you feel inspired, at least you find 10 other young leaders who can give the book to them and let them read them. That's how the cycle will continue.
That's great advice. Thank you again. All the very best for the formal launch of the book. And I think, if anything, the one big thing to carry for all the startups and entrepreneurs here is how to build something, how not just to build a company, but to try and spend your time building an ecosystem, the way Nasecom did. And if that can be replicated even in 10% or 20% of that format, I think the startup industry is going to see a very different direction and very different tailwinds. So thanks again.
Thank you, Ram. Thank you all of you for sharing. I must thank Sanjay for inviting me to come. Thanks, Sanjay.
Yeah. Anyone all are. Everyone has a maybe all of you can you think of maybe we can go down and maybe some closer. Let's say just 1 minute here. I wouldn't get such an opportunity to promote the book. Yes. Thank you.
I'd like to thank Ranu and Harish. Looking forward to the meet, and I guess everyone get seated. We'll be just wrapping up with some.
Thank you all, guys. It was a pleasure hosting you. Thank you, AC, for giving the day. And thank you, 100X team. Thank you, Harish Bhai, Ranu, for making it for the closing. Thank you so much. Guys, have fun. Hopefully, next year we will have larger and bigger 100X investors. Thank you all.
We have set up a table here, so in case if anyone wants to sign copy, they can get it done by Mr. Harish here, and he'll be happy to have the signed copy for you.
स्टॉप करने से ज़्यादा स्टॉप
नहीं
I think this is better. New studio.
all one side, all one
चालू चालू
thanks to you all
न्यू चैनल यहाँ पे वो हाई